we're still alive and kicking. By Monday morning, we'll know whether we make it to the next round or not. And, I think on the geopolitical front, at least, there appears that things are at least cooling off. So that worry is a little bit behind.
It looked like flip-flop last night, right? Oil prices were up 3, then they fell. And looks like more talks, basically, on some of the... And I think this seems like we're closest now to we've ever been with regards to US-Iran. If it goes somewhere or not, we don't know. But that's the hope. Well, let's just take it from the top, right? I mean, so US equities were lower and on large cap technology. S&P was down 0.5%. NASDAQ was down about 1.25% or so. And, the semiconductor stocks, which is your Nvidia and a bunch of other names, were all lower. Nvidia, by the way, was down 5.5%. It had reported numbers the day prior. And numbers were good. Commentary was good. The Jensen Huang's interview to CNBC, he kind of said that the AI capex cycle is here and here to stay in that sense. But the stock ended 5.5% lower, and that was not just Nvidia, but a bunch of other names as well. And the contrast was quite amazing. So while the hardware and the semiconductor stocks all sold off a little bit, varying degrees. The application stocks, which is the software companies, which had all been sold into, they rallied. I think that contrast is perhaps the most severe it has been last night, I think in at least a year and a half or so. I mean, the relative outperformance to underperformance of the semiconductor stocks and the software stocks. So there you go on your screen. Infosys was up about 3%. Wipro was up about 2.2%. And the others, right? Globant 5%. Accenture 8%, Cognizant was up 8%, and EPAM was up 6% or so as well. By the way, I think Globant reported numbers last night, and there has been some commentary from the company. We can go into the details a little later. But for now, I think this is just an unwind on both sides. It's been one way up for the semiconductor stocks, one way down for the software stocks, and it's a bit of a reversal in that sense. I mean, I think maybe some of the pressure we've seen in Indian IT services also comes off. I mean, maybe small bounces, small recoveries. We'll see how this one goes. But it's not as if suddenly, we are presented with some dramatically new information which will change markets' thinking on software in that sense. It's still an evolving debate rather than, a big discovery, a eureka moment which turns the trajectory for all these names on the upside. So mind that. But in a tactical kind of environment, in a trading kind of setup, I mean, I think these moves can be meaningful after, sharp one-way rallies and sell-offs that we've seen on both ends. Now, the macro markets, 10-year yield was down 5 basis points to about 4%. Oil prices, absolutely little change, 71. But behind that unchanged $71 on Brent, you had first a 3% rally because there were reports that the US-Iran talks are not going anywhere. There's a deadlock. And then there were signs of progress between US and Iran. And then news came that talks will continue next week as well. And we've also heard from the foreign minister of Iran, who's essentially said that talks now focus on some specific technical areas, which the markets kind of sort of, understood as he's saying that this has now reached a stage where you're talking very, very specifics, and some of the bigger, broader directional view is now aligned. So we'll see how this one goes. More talks next week is how this is set up. Now, gold nears 52, just under $52. There's gold futures. And silver is just under $90 odd, so not very much by way of change. Now I'll just tie in the levels here and the trading action. It's been painful. So no follow through on the upside, one day up, one day down, but no follow through on the on up day +1, no follow through on the down day +1. So, and that's the reason why I'm saying it's been painful for both bulls and bears and those who are trying to get it right in either direction. And by the way, the trading channel that we put out, and we put that out for almost a week and a half now, that remains. That's the bigger channel in that sense, but that also has narrowed. So there's a channel within the channel, and the very near term, very, very immediate setups, because the range has become so tight, I'm just kind of sort of compressing levels on both the upside and the downside. So 25,570 is the resistance on the upside, and 25,275 is the support on the downside. Because if you look at consider the wider levels, I mean, then you're looking at 25,700 kind of levels on the upside and about 25,100 on the downside. But that's a slightly wider band. This is the more immediate levels that the market's got to take out and give a direction. Remember, I mean, the point is in the very near term, what we've had price action-wise is lower highs and lower bottoms. So that lower highs and lower lows, and that usually typically signifies perhaps a little bit more weakness. But the point is, on down days, there is no follow-through. So you've got to be open to the idea that perhaps the market doesn't want to fall and it wants to bounce from here. So keep that in mind as we go through this Friday. Gift Nifty will give you a quick sense of how we're likely to start, and we'll pick it up from there. So yeah, there you go. 90 points down as the indicative open as far as the Gift Nifty is concerned. Nigel has walked across to the wall with the F&O setup. Nigel?
Well, hopefully that Gift Nifty soft start that you're talking about, Prashant, doesn't turn into something like an ugly trading session, because a 100-point downtick and maybe, in fact, seeing some kind of basing out around those levels will be on the bulls' wish list. Now, in yesterday's trading session, the flows were actually mixed, but going by the high gross volumes, the FI flows could have been impacted by some large trades, some rebalancing, or maybe an element of weekly expiry as well, because yesterday the FIs, they turned actually sellers. For February, though, the big takeaway is that the FIs appear to be leading more in than out. And I think that's positive itself, because they have been selling lock, stock and barrel. Not too much movement on index futures, though, from the FIs. They added some mild longs. They continue to remain net short. We're close on 78% of their positions on the short side. On the stock futures, the FIs added equivalent amount of longs as well as shorts. But moving to the index options, well, yesterday's trading session, they were writing more calls than puts. In the ratio of closer on 2 calls were written for every 1 put, though the PCR is holding at around that 0.88 odd mark. And there were a couple of strikes that were very active. 25,500 call. That saw a good amount of open interest build up. And on the downside, the 25,400 level, that as well did see a good amount of open interest build up, with the premium now at around 75 rupees. Just plugging this in and looking at the technical levels, I'll give you a tight range just in the near term. The 20 DMA on the upside, that'll be a level of resistance. Remember, in the recent past, we've gone to around the 25,700, 25,717. We've done a bit of a U-turn. But if you're looking at simple moving averages, well, the 20 DMA at around 25,610 approximately, that becomes the first level of resistance. While on the downside, the 200 DMA, you don't want this mark to break. This 25,300, 25,350, you want that level to hold out. The Nifty Bank, the price action there is quite interesting. It's gone through a bit of a consolidatory phase post the big run that we have seen. Last few trading sessions, 60,800 appears to be the level which is getting bought into. So even in today's trade, I think 60,700, 60,800, that's going to be very, very important to hold out, because last few trading sessions, that dip has got bought into. The IT index, well, the recent low is important that it holds out. Salesforce, remember, overnight it was higher, though the 2027 guidance came in softish. But despite of that, you did see the stock end higher. So I think if this holds out, you'll be saying that a bit of a relief rally, a little bit more from here on, could be on the cards actually for the Nifty IT index. So let's see how that goes.
All right, thank you very much for that. Sticking with the theme, Globant, you said, right, came out with numbers. Stock was up 5%. But this is a stock which has gotten butchered, down 25% on a year-to-date basis. And Globant is seen as a proxy for many Indian IT companies like a Persistent, Coforge. So just a quick recap. Q4 numbers were fine, in line with estimates, maybe even better on the top line, which is what drove the rally. But here's the moot point. For FY25, the company's revenues grew only 1.6%. For FY26, revenue growth stands at 0.2 to 2.2%, which basically means that IT services companies, whether Indian or global, they're still struggling for growth. But Globant is making a shift. So it's shifting away from the traditional hours worked billing towards AI pods. What are AI pods? So basically, instead of hiring a team of, say, 5, 7, 8 engineers and paying for every hour that they work, instead, you're going to be paying a monthly subscription fee to access that AI pod. What is an AI pod? They're basically AI agents, and they're driven by, they're supervised by a few Globant experts, but you're basically moving towards an outcome-based model, and you are paying for AI pods. Now, these AI pods, because the company is in transition, it contributes nothing, less than 1% to the company's total average revenue as of now, but it's growing very fast. So as a percentage of the pipeline, it is about 8% of the total pipeline. So the This transition period has been painful for Globant, stock down 25% year to date. But yesterday, stock moved up close to about 5% odd. Well, that's the latest there. Let's invite Jeffrey Dennis, independent market commentator, on the show. Jeffrey, can't not ask you about AI. Market is still split. Some investors remain bullish. Some are cautious about overvaluation, potential AI bubbles, AI capex being too high to sustain. And Nvidia price action seems to suggest maybe some fatigue is creeping into AI stocks. Where do you stand?
Well, I'm kind of somewhere in the middle. I think that it is not a bubble that's going to burst dramatically. I also don't think it's going to be something that's going to run on dramatically like it did in 2025. And of course, we're seeing that so far this year already. There's a lot more volatility. But where I stand is that, for example, with Nvidia, I think essentially what this was sort of sell the news. Now, buy the rumor, sell the news. Of course, the rumor was probably not as bullish as the results would have indicated. So it was a bit of a surprise that the stock sold off today. But on the other hand, it's had a very good run, and Nvidia, probably investors are saying, look, can it get any better than this? And this is probably why you saw some profit taking. Overall, my position here is that the earnings growth is very good across this sector generally. The valuations are high, but then the earnings growth is good as well. And although there is a lot of capex coming, I think that will contribute to growth down the road. The one thing I worry most about the AI sector and these specific major AI stocks is the way in which one company seems to be buying a little bit of another company or taking a position, and that other company is taking a position in, a third company. And there's a lot of cross holdings, which is kind of unusual. But generally, I think this is not going to turn into a big crash, but I think it's going to be volatile. And I don't expect necessarily the AI stocks to be the big winners in 2026.
AI stocks not to be the big winners in 2026. Got that, Jeffrey. This U.S. Iran. It's. I think this is the longest that we've had these talks running, at least with this current administration in the U.S. Right, and that comment that now in the next week talks will focus on some of the technical stuff. Do you think? How do you read this? Significant for oil prices, one way or the other?
Definitely significant for oil prices, and we've seen that already because oil prices are up 10% basically in the last month. Brent's gone from the low 60s to around 70, and I think that reflects concern over supplies, oversupply of oil, whether or not there's actually an outright conflict. There has been the story, as you will know, that Iran is trying to squeeze the Straits of Hormuz, which will, of course, limit supplies. Again, mind you, I got the Ukraine war wrong as well. I don't think there's an imminent attack on Iran coming. I think they're going to let these talks develop. Iran doesn't want to go to war. The US doesn't want to go to war ostensibly. And the only argument against that would be there is so much hardware and so many people now in the Middle Eastern area close to Iran. People are going to say, well, why have we got all that stuff there if there isn't going to be some sort of attack? But I think what President Trump wants to do, and I would applaud this, is let these talks play out. And so if there is a conflict, it's probably not now. It may be several weeks down the road. It depends on how the talks go. But obviously, oil is where you see the biggest impact, I think, in terms of financial markets over this risk of confrontation between the US and Iran.
Hi, Jeffrey. Good to see you. This oil price cooling off is actually a positive for India. And, I think in the last couple of months, whenever we have interacted, you have been talking about that possible rotation back into India, post the time-wise and a bit of a price-wise correction as well on India. It appears that's taking place because in the month of February, it's been an action-packed one. We had the budget, you had a trade deal, you had so many cues coming in on the AI front. And in spite of that, you have the FIs that are net buyers. Do you see the trend turning in favor of India with the flows coming back and maybe the Indian markets getting back to its outperforming ways?
I think so. It's just that, I've been saying this for a while and it's not been correct. I think there are some triggers out there, and you've obviously mentioned some of them. And the other one that I would see out there that's important is that the China trade has clearly gone flat and is basically doing nothing in 2026. And I've said on this show before that I think there's a sort of debate going on within emerging market investors and investors generally on China versus India. Now, I think the only doubt there might be, or one of the doubts there could be about India doing well and outperforming going forward, is there's still so much money pouring into a particular Korea where you're seeing corporate reforms as well as obviously some benefit for a lot of technology stocks and other stocks, and of course Taiwan, which has done very well over the last year, still doing reasonably well. So I think India is not necessarily front and center for investors right now, but you are beginning to see some developments, notably a softer China, which I think ultimately will pull money into India. India benefits from lower oil prices. You've got great growth. The market's re-rated downwards, especially on relative terms, despite the pickup in inflation, which of course simply took inflation from an artificially low level because of food prices. You've still got real interest rates around 2.5%. There's probably a bit of scope for the central bank, the RBI, to do something there. So I think we do have conditions for India to do better here. But I think once again, we need a really good catalyst. And I'm not sure we've had the really good catalyst yet. But I don't want to change that view because I think India does look good here for the long term.
All right. Thank you very much for that. Really appreciate your time here and look forward to our next chat. Richard, really great speaking with you. Well, let me just quickly run you through the interactions which are lined up here on the next 2 hours or so. 8:35, the Hexaway management talks about what the company is doing on the AI side. It's an interesting chat. You don't want to miss. Lots of interest still there, of course, on this issue. 9 o'clock, we have Viral Shah of IIFL Capital, puts the spotlight in the NBFC space. 9:20, Gargi Chaudhary of BlackRock will be a market master of the day. 9:35, the management of L&T Finance joins us to discuss the tech-driven innovations. I mean, they've been sort of ahead of everyone, I guess, at some level to adopt AI, etc. Mr. Roy has, of course, spoken about this in the past. Exclusive conversation with the management of Marico at 9:45. 10, we'll get you a discussion with the Motilal Oswal alternates Rakshit Kapoor. They've closed a private credit fund. I mean, we'll talk about that, but of course also about the broader private credit space, which of course is booming. And towards the end of the show, Lata speaks with economists Samiran Chakrabarti of Citi, Dheeraj Lim of ANZ on AI impact and rupee, the upcoming new GDP series as well. Stay tuned.
Welcome back. It's time now to talk about stocks which you should have on your radar. Our research team is standing by with the top stocks for the day. And first up, Vishal Mega Mart. Mangalam, there is going to be a block deal here.
There was a block deal which was long coming, and now we understand that it has been launched already. Promoter entity Samayat Services will sell stake in the company, and Samayat Services obviously is the investment arm of Kedara Capital, which is the promoter entity of Vishal Mega Mart. Now, what's fresh development after last evening is that the block offer, which was earlier at around 3,500 crores, 6.5% stake, has now been upsized to 7,500 crores, which is over 13% stake in the company. So that's the fresh development that has happened this morning. The floor price at 115 rupees compares with the previous close of 128, so that's a near 10% discount. So to that extent, you expect the stock to react on the obverse side, adjust to the floor price. But because the block size is upsized, it implies that there is strong demand out here as well. The business has been doing well, but it'll be this supply-led issue which will continue to cause a bit of a flutter on Vishal Mega Mart going forward. Promoters own 54.09% stake in the company, entirely PE-led. Now this is 13% stake that they're selling, but after this, whenever there's a cool-off period and it ends, we can't rule out possibility of them selling more from here on as well, because that's the nature of PE-owned businesses. So that supply event, barring aside, the business is strong, but this morning itself, nearly 7,500 crores worth stocks or 12% plus stake will be traded today.
Thank you very much for that. They'd sold about 20% in June of last year, and now another 10% is coming. Thank you. Moving on, Ria now joins in for some more stocks which are in the news.
Well, good morning. Let's start off with Coforge first. They have secured a strategic partnership with VHS Health, which is based in the US, to transform their provider experience. Brigade Enterprises has signed a strategic pact with Primus Senior Living to launch 3 senior living communities in Bangalore and in other South Indian geographies with a total GDV of 750 crores. Capacite Infra has backed a 537 crore rupee project in Thane from Raymond Realty. NBCC as well has backed orders worth roughly 775 crores from the Delhi Development Authority for the redevelopment of the staff quarters, and Jindal Stainless will also remain in focus today. The promoter entity has bought 0.11% equity via the open market on the 24th and 25th of February, and this follows their earlier purchase of 0.1% stake, and the current total shareholding of the promoter stands at 16.56%.
Got it. All right. Thanks a lot for that, Ria. Let's go back to Mangalam. Mangalam's here to tell us about Cancer Nerulac and the takeaways from their meet. Mangalam?
Well, so, they spoke to a bunch of analysts. This is the parent entity, and they said that the focus remains on accelerating non-auto industrial offerings and also increase their offerings in the auto space. Kansai Nerulac obviously is the leader in the industrial paints and the auto paints, and as a result of which they want to focus on their strengths. The 5-year decorative growth outlook is 2 to 4%, but what they're doing right now there is prioritizing profitability as against growth, and they have no plans to divest the decorative business. In fact, in the industrial business itself, auto, which is doing well, the other leg of growth for the company will be non-auto industrial, and that will be the third pillar. The impact from competition in decorative paint, they said, will take time to materialize. Brokerages have neutral to underweight rating on the stock, so Macquarie has a 220 rupee target price, Morgan Stanley has a 191 rupee target price, and Nomura has a buy, the only buyer in the stock, with a target price of 285 rupees. The comments have been positive. It's all about execution. Let's see where that goes.
Right, now in point one, and we'll watch for the reaction. Mangalam, thanks very much for that. Now, the government will unveil a new GDP series today with FY23 as the base year versus the current base year, which is 2011-12. A CNBC TV18 poll sees 7.7% growth this quarter. The new series will have more informal sectoral data, real-time GST, and other data, and of course also includes a double deflation. So that's of course later today. The number usually comes out post-market hours at about 3:30, 4-ish or so. So that's the GDP numbers that we will be watching out for. We'll take a quick commercial break here. We come back with Siddharth Khemka of Motilal Financial Services and others on the other side. Stay tuned. Coming up.
Welcome back. You're tuned in to Bazaar Morning Call. Well, it's that part of the show when Sudarshan joins in to help us out with some brokerage notes that he has read up earlier today. Good morning, Sudarshan.
Good morning, guys. So one segment where we have mixed views from brokerages, that is OMC. And today, Investec has come out with a note reiterating sell on all three names, BPCL, HPCL and IOC. It's saying peak earnings and risks are rising for all three names. So BPCL target at 330 rupees, HPCL at 425, and for IOC, it's 145 rupees per share. It said that Q3 was a strong set of earnings, and that was supported by healthy core performance and support that they have got from subsidy. But since the downgrade that Investec had made in the month of November, stock has been largely range bound. Now, stock move has been reinforcing its view that valuations are the binding constraint, and even on the bull case assumptions, OMCs traded 10 to 30% above 5-year historical average, and it believes that risk reward has turned now negative, with Brent rising above $70 per barrel and refining margin remaining elevated at $9 per barrel. So risk of renewed marketing margin compression is rising as well. To play refining upcycle, they are preferring Reliance Industries over oil marketing companies. Next one is Tata Motors commercial vehicle. So everyone knows that commercial vehicle has been in the upcycle, and most of the brokerages have the positive view, not only on Tata Motors commercial vehicle, but also on Ashok Leyland. Today, CLSA has initiated on Tata Motors commercial vehicle with outperform call, and target here is 673 rupees per share. It says India and Europe have entered a CV upcycle, setting stage for a strong volume and margin rebound. It expects robust free cash flow over next 2 years and balance sheet to turn lean by FY28 despite Euro 3.8 billion Iveco acquisition debt, and Iveco volumes likely to accelerate ahead of Euro 7 transition in FY28-29, and EV adoption in India and ULCVs to drive scale and supply chain synergies for TMCB as well as Iveco. So these two things can be very positive for Tata Motors commercial vehicle.
All right, thank you very much for that. Let's talk about AI then. Is AI going to hurt or help Indian IT companies? Many stocks like Hexaware have gotten hit. Hexaware as a stock price is now trading at a fresh 52-week low. The stock is down 38% in this year, 42% in the last 1 year, and it listed about 1 year back, and at that point the issue price was 709. Stock went to hit a high of 900, and now the current market price, as you can see, is 472. So the stock has taken a knock of more than 30% from the issue price. Sanjay Salunke, President and Global Head Digital and Software Services of Hexaware Technology, is now joining in. Sanjay, thank you very much for joining in. I remember the conference call. I was attending the conference call, and you were specifically asked about revenue deflation, to which you said that on an average, I mean, the CEO Keech had spoken about 20 to 40% for, as is. If a deal comes up for renewal without changing the contours, as is, we're seeing a 20 to 40% deflation. There are mitigating factors, but tell us a little bit more about what is happening on the ground with respect to revenue deflation and what is going to be the impact.
So there's not real revenue deflation. What is happening from that angle is that with Gen AI, there is a decoupling of billable hours from productivity. So now customers are expecting much more higher productivity for a temporal time, for a shorter time. People will say that give me that revenue productivity with deploying AI into your organization or AI into my projects. I do believe that there is significant, much more software to be developed. Increasing productivity is going to create room for many clients with monies to be deployed for more software to be built. So from that angle, I feel eventual inflation in the amount of work to be done with improved productivity, with people in the software industry building software much faster, much better, producing much more software at a higher rate there.
Are you striking partnerships with companies like Anthropic? We had Anthropic Infosys. Anthropic themselves have released various agents which can be integrated with existing software. What is Hexaware's strategy?
Hexaware's strategy is to partner with some of these players like Anthropic, like Replit, which you have seen some time back, many of the hyperscalers, and a few other LLM companies also, code generator companies, because these are going to be this is the future of programmer today, or this is the future of software engineering itself. Software engineering is the most profoundly impacted area with Gen AI. This is the place which we are seeing the most impact today, especially when it comes to India also, because we have the largest number of IT services companies also there. So I do feel that it is the new tech which is going to increase efficiency. It is the new tech which is going to change the way we work with things there. There are many things which were not possible in the past. There were a lot of things which you could not do in the past because of the tech limitations. Things like modernization of legacy technology in bulk. Gen AI is allowing that. Gen AI is allowing things like zero backlog in your systems. So you have a lot of backlog of bugs to be cleared, a lot of backlogs of features to be built. With the speed and acceleration which we can get with Gen AI, a lot of those backlogs are going away. To do that, you need to partner with some of these companies which can allow you to be more efficient, more faster. So this is definitely coming. You'll see that from Hexaware also in a big way.
Sanjay, Globant just came out with numbers and they're pivoting towards a subscription-based model, which is sort of unheard for a services company. They have those AI pods, very small right now, but clearly that seems to be the future. And this subscription model is what we see, say, in companies like a Netflix. Is Hexaware going to go down that road? Do you see that as the eventuality?
There are different names given to this model. This will be a combination of a platform, a team of engineers or architects, and a team of agents. So when you combine things which are physically describable like a human effort with a combination of a platform, that's where we combine these things to call them as subscriptions. So we do believe that subscription models will come into play. This could be a subscription model. You could call it as a combination of a platform model with an agent coming into play and with an high-end architect combining it together. So yes.
Yeah.
We have our own platform called RapidX and Tensai, which we combine with. RapidX is a software development lifecycle platform. That's what we combine with our teams and engineers there.
Yeah. Sanjay, good morning, Prashant here. For companies, and this is the fundamental question, for companies which have legacy systems, maintenance, etc., that kind of work which is on, that continues because you can't suddenly, because some new technology has come up and it perhaps has potential, you can't, stop mission critical work, which Indian IT services companies do, right? But for new projects and all the new stuff, if all these new, and everybody's catching up to all these new AI technologies, right? Every day you wake up to something. So if you're a company, if you're somebody used to decide on budgets and what to allocate and where, one would imagine that you'd pause, right? You'd pause and see, well, what's going on? And then instead of sort of, continuing to hand out contracts, etc. So have you seen that? I mean, I would assume that is logical to expect, Sanjay. You're saying, no, nothing has happened.
No, that's, in fact, I felt I've mentioned exactly the reverse. People are reconsidering how you did work in the past, including maintenance. Some of these are holy grails of IT, which were not touched in the past, especially modernization was a holy grail, was not touched in the past because enterprises have built complex systems over the last 25, 30 years. These are spaghetti systems. These systems now can be unentangled with AI. Maintenance is going to become easier because maintenance is a complex problem which involves regression of systems. When you do maintenance changes, it impacts multiple systems. Gen AI now allows you to take that load significantly. It can lift that massive cognitive load of complex systems to be maintained easier, and that will also touch this system. So I do feel that in almost all of these areas will be impacted. It will be impacted positively because now it will create new opportunities. Some of these systems which were not touched will be touched. It will create new opportunities to transform and modernize some of the older systems. Businesses will get more modern. There will be more software being developed tomorrow.
Sanjay, just for us to form a picture, not very specific numbers, but can you tell us the extent of revenue deflation? Is it 20 to 40%? Is it compressed over smaller timeline deals? Instead of 5 years, is it now happening over 3 years? And what percentage of the book is seeing this revenue deflation? And what is the extent of the new AI opportunities? Some broad-based numbers will help to help us frame the picture.
Don't have an exact number to put on this because these are early days of Gen AI. But I think the horizon is 2 to 3 years right now. You will start seeing clients ask for those things. Some of them are a little bit more cautious than others. Early days, I would say, but I see the opportunity to be significantly high again. I do believe that Gen AI based revenues will overpower the deflation which we see today. Most of these older systems will be replaced with Gen AI based systems. Almost every application which you build, every product which you will build will have embedded AI into it, which will power the new revenues.
What I want to do, Sanjay, and stay with us, right? I don't know if you can see the output on a screen there. But I want to just put out the news from last night. This is Jack Dorsey, who, of course, who's the founder of Twitter, now X, which, of course, is now owned by Elon Musk. But his company is a company called Block. It's in the payment space. And he announced last night, and this has basically gone absolutely viral. Now, it's a long sort of read through, but this is essentially what he says. He says, today we are making one of the hardest decisions in the history of our company. We're reducing our organization by nearly half, from over 10,000 people to just under 6,000 people. That means over 4,000 of you are being asked to leave or are entering into consultation. I'll be straight about what's happening, why, and what it means for everyone. I'm just looking at the key portions of this long message that he's put out on X. He says that we're not making this decision, and this is important, we're not making this decision because we're in trouble. Our business is strong, gross profit continues to grow. We continue to serve more and more customers and profitability is improving, but something has changed. We are already seeing that the intelligence tools we are creating and using, paired with smaller and flatter teams, are enabling a new way of working which fundamentally changes what it means to build and run a company. And that's accelerating rapidly. He goes on to say, and I mean, there's a favor for employees in terms of how they're going to be open and details about comp and severance, etc. But then he goes on to say, a decision at this scale carries risk, but so does standing still. We've done a full review to determine the roles and people we require to reliably grow the business from here, and we've pressure tested those decisions from multiple angles. I accept that we may have gotten some of them wrong, and flexibility, and we've built in flexibility to account for that and do the right thing for our customers. So it's a much longer post, but I thought that was, in that sense, pretty dramatic decisions. Jack Dorsey essentially saying that in another portion, he goes on to say that I don't want to be forced into this situation later in the year, and I don't want to be reacting to it. I want to do it on my own, because I want to do it because I see this is coming, and I want to start it rather than be a follower and in that sense reactive. So that was quite something. I mean, there is a fair bit of praise for the for the openness and the mail for what he's put out, etc. I mean, all that is, of course, true, and it's a well-written post, but it doesn't take away the fact that 4,000 people don't have jobs, and of course also the fact that this perhaps has got implications, as many are pointing out, for maybe other companies as well. Sanjay, just your thoughts on this. And of course, I mean, the question is, if you are a US corporation and you see what a successful person like Jack Dorsey has done, won't you be asking the same questions, of internally in boardrooms, etc.? Just your thoughts.
The change which has happened, the pace of change on Gen AI is almost a year or two, which we have seen in the last 3 or 4 quarters. People had hired for scale, and the profiles which you had hired were built for that type of a scale, a different type of scale which was expected in the organization. That has changed. So admittedly, the type of people needed to scale in the future are going to be different. There's going to be AI-equipped people, which have to now be part of the organization. You will deliver more with this team. And I'm sure most of these companies will rehire based on their own skills and how they build a businesses tomorrow. So I feel that this is now a cleanup of what they thought they would be needing as people to what they will be needing in the future. Not necessarily the numbers, but just the type of people. Once they start seeing productivity come out from the current teams which they have, most of these companies might, depending on how they change their pivot their business models, might get back to hiring again.
Yeah. You, Sanjay, did you read
That's
that?
what we see. That's what we see today.
Did you read that piece from the Global Intelligence Crisis 2028 piece by Citrini? Sanjay, did you read it?
Yes. See,
Okay.
might feel that.
Okay, no, let me. I just wanted to get that. My question is this. That came out, there was a lot of pushback, and well-argued pushback that, that is not the case. And I put out a piece as well with some fundamental, flaws in that argument which the piece put out. But be as that may be, we've seen this, right? This is less people, productivity goes through the roof. This basically kind of demonstrates in action what that piece put out, at least the first part. And I'm not saying that the rest of it will follow, and I hope it does not, for all of our sakes. But what's your sense, Sanjay?
So I do feel that there's still a lot of software to be developed. We talked about software-defined systems, right? Software might be, I strongly believe, I'm an optimist, that software will eat AI in a way, that you will need software to meter out AI. Software will be the one which will provision AI out to businesses, to systems, and so on. So the amount of software which has to be built, and I'm talking very specifically to the IT industry itself, and that's the part which I'm commenting on. We do believe that there is so much more software to be developed. AI is going to actually make it easier to produce some of those systems. We have seen maybe 10 to 15% of systems being touched by software. There is much more to be done. I would not call it a doomsday today for this. People will have to change. People will have to change how they operate, how they work, how they learn the new way of AI. I come from a generation 2 or 3 decades back where people would build machine language code. When Java and languages like higher level languages came in, people stopped making machine languages because no one would look at the compiled code. So eventually you start abstracting yourself to a higher level. And here we are now, what we are seeing is we are moving away from linear scaling to intelligent scaling, which is going to power new sets of business models itself.
Yeah.
And these business models are going to connect systems together, which is going to create more software, I feel.
Yeah.
And more jobs for connecting with that. It's unlike the manufacturing industry, which you saw lights out manufacturing, creating more things. But here you will have people building those systems itself. So you will need people to manage, monitor the in-loop system, people to build this new software, which is going to be powering the industry.
Sanjay, a good conversation, and certainly hope that is the case. And that's a belief as well, and makes sense. Absolutely agree with you. Thank you for joining us, and good speaking with you here on CNBC
Thank you, Prashant.
TV.
Take care.
Thank you. We'll take a quick commercial break here. Up next, we will connect with Siddharth Khemka of Motilal Financial Services for some fundamental stock conversation. Coming up, we're about 15 minutes away from the pre-open.
Welcome back. Well, we have Sid Kemka of Motilal Oswal Financial Services who joins us on the show. Hi, Siddharth. Good morning and good to see you in. I wanted to ask you about, this Vishal Megamart. There's going to be a large trade that's going to take place. And, there appears that appetite is pretty large because that book actually has been upsized. What's your view on the stock?
Yes. Hi, good morning, Nigel. Glad to be on the show. I think if you look at the value retail segment that had been under pressure for quite some time, is now seeing some improvement. The GST rate cuts has definitely led to some improvement in the consumption demand on the domestic front. I think going forward, things look pretty interesting from here. This is one of our top picks within the value retail, apart from V2 retail, which is the other stock. The company has shown a strong execution in Tier 2, Tier 3, and continue to look at the structural growth specifically for the value retail model and becoming a physical store format first. I think that is something that is helping them differentiate in this environment. Plus, the management expects to good growth, both in terms of the store additions as well as the same store sales growth, which is kind of inching up. So what we are expecting is at about 20% revenue CAGR as well as about 25 to 28% net profit CAGR over the next 2-3 years. And that reinforces our positive long-term investment case on the Vishal Megamart stock.
I remember chatting with them post the Q3 numbers, and the company said, and I'd spoken to them during the IPO time, and they said we had guided for 20% revenue growth, 25% EBITDA growth, and 30% PAT growth during the IPO, and that trend continues. Siddharth, today Motilal Oswal has written a note on MTAR Tech saying that it's a proxy for data center demand. Can you take us through why is that? What is the key thesis behind this report?
Good morning, Rima. Yes, so we did put a note on MTAR, this being a precision engineering company serving in the niche high entry barrier industries across defense, aerospace, nuclear, as well as clean energy. And the company is increasing its exposure to the global fuel cell technology through it. Decade-long partnership with Bloom Energy. I think what the company is finally positioning itself as the indirect beneficiary of the global AI infrastructure wave. As the world is building more data centers, there is a lot of requirement for a reliable power, and that is where the technology from Bloom Energy that comes in, the solid oxide fuel cell technology that is used to build the battery as well as the power storage system. I think that positions MTAR Tech pretty strongly to benefit from the structural tailwind. I think already this is reflecting in the financials. Q3 order inflows reached a record 13.7 billion rupees, which is up 5 times on a Y&Y basis. And nearly half of them were sourced from Bloom Energy. So we believe that this is a long-term structural story in this current environment where AI data center investments is going to go up. And we are expecting MTAR to post a CAGR of almost a revenue CAGR of 40%, net profit CAGR of almost 80%. And hence, we continue to like the stock. That justifies the premium valuation of about 50 times, on which our target price is based at 4,800.
50 times valuation multiple for FY27? Or
that is, so that is on FY28.
Okay, so 27 would be even higher then.
27 would be even higher, yeah. So it currently trades at about 60 times on FY28. But as I said, the company is growing. So this year, net profit is growing at almost 96%. Next 2 years, CAGR is almost 80%. So that justifies the premium valuation.
And what percentage of the overall company would be a proxy for data center?
So that order book is definitely increasing. And I think currently, if you look at the overall mix, I think that is only going up. So I don't have that number readily with me.
Okay, all right. Sid, what about from the tech stocks itself? You know, Salesforce overnight, that was actually a pleasant surprise because getting into yesterday's trading section, actually Salesforce in after hours trading was down. And then that completely reversed. at first look, the street was disappointed with the guidance. But after the kind of correction that we've seen, some of these stocks are coming back to life. Salesforce was up. You had a couple of other names. Oracle in the last few days has done pretty well. A couple of brokerage notes from global brokerage companies as well have come out. From the Indian basket, the tech index went down, I think, to around 29,800 odd, and it bounced back a little bit. What's the top pick you'll have from Indian IT companies?
So definitely, Nigel, I think markets in this global environment of volatility, and we are seeing news flows coming in every day. Even Nvidia after results went up, and then we saw profit booking. So a lot of volatility is there. But what we believe is that on the domestic front as well, definitely the AI-led disruption poses a risk to the Indian IT services. Largely, I would say it could be limited to the legacy services business, which could be about 15-18%. And in the long term, we need to see how the Indian tech companies adopt AI to leverage their growth and benefit. So I think in the near term, clearly, one needs to be a bit of cautious and look at the volatility. But in the long term, we definitely feel that valuations have become comfortable. It's kind of become a contra play for investors who can digest volatility. What we like Infosys. This is a play where we believe they have invested into the AI stack, and they have now AI services in their business as well. TCS has done some tie-up, but I would believe that within the Indian IT companies, our preferred pick would be Infosys, followed by HCL.
Okay, we'll slip into a very short break and we'll come back with the pre-opening rates. We'll also be joined by Viral Shah of IIFL Capital to put the spotlight on the NBFC sector.
Okay, well, welcome back. There's about 14 minutes to go for the market open. We'll have the pre-open rates start to come through in just a bit. Now, the DGC has notified ticket refund rules allowing a 48-hour cancellation window. Madhya is joining in. Madhya, good morning. How important is this? And is this limited to tickets purchased from the airline website, or this is across the board from OTAs and all?
Right, Prashant, this is not limited to airlines. Even travel agents can issue it. But the responsibility of refunding lies with the airline. So it has to come through the airline. But it's not necessary that the refunds would only be given only if you book on an airline website. And these rules were proposed by the DGCA in November, and now they come into effect. So as you also mentioned, passengers can now cancel or amend tickets within 48 hours of booking without paying any additional charges. The facility does come with conditions. For domestic flights, the departure date must be at least 7 days away from the booking date. And for international flights, the travel date must be at least 15 days away. And beyond the 48-hour window, regular cancellation charges that we pay currently will apply.
Right.
Another significant move.
Madhya, just one minute. Sorry, 48 hours before travel. 48 hours before travel. Is that the rule?
No.
Yeah.
No. Your travel has to be 7 days away.
Okay.
48 hours of booking. 48 hours of you booking.
Oh, so you book and then within the next 48 hours you can cancel. Okay, cancel or amend. That's allowed. Okay, got that. Go on. You were making another point quickly.
But your domestic travel has to be 7 days away, and international travel has to be 15 days away.
Okay.
Then another move is airlines cannot levy any additional charge for correcting the name of the passenger if the mistake was flagged within 24 hours of booking. And this applies to tickets booked directly through airline websites. So if you change your name within 24 hours of booking, there's no action or there's no additional charge there. Then the DGC has also clarified that if tickets are booked via travel agents, like you were asking, or portals, the responsibility of issuing refunds lies with the airline and not the agent. Refunds must be processed within 14 working days.
Got it.
And there is also a provision for medical emergencies if a passenger or family member on the same PNR is hospitalized during the travel period, and airlines will offer a refund or a credit share.
Got it.
The new rules now aim to make the refund process more transparent and passenger-friendly.
Yeah.
And airlines will have now to ensure stricter compliance timelines of the refunds, because in December 2025 alone, airlines received 29,000 passenger complaints, and 7.5% of those 29,000 complaints were related to refunds. Hence the rules by the DGCA.
Madhya, do get in touch with airlines and let's try and get an assessment of what this could mean, right? The amounts which perhaps are involved and whether this is meaningful. Indigo, the stock is opening lower by about almost 2% or so. Thanks very much for joining us. If you're flying, this is important news, and we'll get more as we go along. Well, I think the pre-open has started. Sudeep Shah of SBI Securities and Mitesh Thakkar are with us with technical trading ideas. Mitesh and Sudeep, good morning. What would you recommend? What's the top-down view, Mitesh, first?
Yeah. Good morning, Prashant. So, last many days I've been saying that the market is getting narrower, it's getting into a contracting phase, and I think that is still playing out. Today, the open could be around this 25,400 level, 25,400, 350 being the lower end of the range. So I think in that sense, we'll look at the opening reaction immediately after the gap down. In case we see, no follow through post the gap down opening, then I think it could be a good chance to take a long position with a 60, 70 point kind of a stop loss. And on the upside, 25,800 is the bigger pivot, which the Nifty needs to clear if it needs to get into a sustained up move.
Sudeep, hi, morning. What's the Nifty trade?
Good morning, Rima. What we feel is that from here on, markets, once they open gap down, it will be very close to the 200-day moving average, which is closer to 25,300, 25,400 mark. So this could be a buy on dip zone. Since 16th February, there have been 5 or 6 retests of this 25,350, 400 zone, and indices are not closed below that. So with a 60, 70 point risk around, with a stop loss of say 25,280, I feel closer to 25,380 one can go long. for a rebound up to 25,600, 25,630, which is the 20-day exponential moving average, and which in the last 5 or 6 sessions I have not been able to cross. So this will be a range play between 25,300 and 25,630 on the upside.
Pre-open doesn't seem to suggest a big gap down opening, just down about 30 odd points, so not particularly close to the 200-day moving average. The first support is yesterday's intraday low, 25,375. Go one step down, then the 200-day moving average at 25,346, and then the recent low was 25,327. So roughly in that band. Sudeep, what about stocks?
So from the auto space, one from the hospital space. The one from the auto space is TVS Motors. We've seen a strong breakout on charts in the last few days, and the follow-up also is there. So from here on, what we feel is that the stock is moving up to 4100, and this can be bought at current levels and dips with a stop loss at 3880. The second stock is a hospital stock, SRDM. We've seen in the last 7 sessions, hospital stocks, pharma stocks, they're back in action. And yesterday, SRDM has broken out of its small consolidation. And we feel that from here on, the stock can be bought with a stop loss at 633, and the targets would be 675 and 683.
Got it. Thanks, Sudeep, for that. Midesh, what about you? What are your picks?
I have a host of a mix of buys and sells. Sorry, on the buying side is Fortis. Had a good breakout yesterday. So in case with the gap down, you get it slightly lower, around 960, 955. Then take a long with the stop below 943 for a target of 995. And the second stock is BEL. It's been doing well in a market which has been choppy and it's been more of sideways and yet biased on the upside. So if it clears 450, which is the intraday pivot, buy then with a stop at 443 half for targets around 462, 464. On the selling side is CDSL, sell with a stop at 1312 for targets of 1260, and IRCTC, that's a sell with a stop at 606 half for targets of around 570 on the downside.
Thank you, gentlemen, for those trading ideas. Pre-open, mildly lower on the Nifty and the Sensex, but IT right on top. So Infosys, Tech Mahindra, HCL Tech, Wipro, TCS, all showing you gains of about 1 to 3%. Let's see whether they can sustain and build on that. But for now, let's turn our attention to the NBFC sector. The Bihar government has tightened the grip on MFIs. They've mandated registration, curbing unethical recovery practices. We have with us Viral Shah, Senior BP, IFL Capital, to talk more about this. Viral, thank you very much for joining in. Bihar is important, right, for the MFI sector. I read somewhere, I think the AUM from Bihar for MFI is more than 45,000 crore rupees, and that's about 16% of the industry. Take us through this particular news flow, what's come out from Bihar and the impact.
See, this is in a series of regulations that were put out over the last 1.5 years across the states of Karnataka, Tamil Nadu, and now we have Bihar. Essentially, the primary purpose of these regulations is to basically prevent the unregulated entities to kind of do usurious kind of lending, or basically which leads to leveraging amongst the borrowers. Now, I would say, unfortunately, the impact of this is that you have the regulated entities also that gets impacted, because on the ground level, it becomes difficult to make the distinction. Having said that, I think this regulation specifically has certain other incremental provisions which could be somewhat negative for the NBFC MFI.
So what is particularly negative? Does recovery become a problem, or will lending slow down and therefore affect growth? And tell us 2-3 companies most affected by this.
So, see, basically, it's a combination of all these things that you mentioned. There will be growth that will slow down. That will also be an asset quality challenge that will come through, because there are certain provisions basically restricting the lending beyond 2 lenders, etc. So there is going to be an impact. Now, we have put out this report today morning, which lays out the exposure in Bihar across various players. The extent of impact is going to be predominantly more high for northern focused MFI lenders, and probably it will be then gradually lower for others.
You want to name a few of those companies that get impacted relatively more in comparison to the others?
So the pure play MFIs like your Fusion, Spandanas of the world, they do stand to be negatively impacted. You have SFBs like Utkarsh, you have even Ujjivan, who have higher exposure in those geographies. So they also stand to be negatively impacted. Even L&T Finance has 20% of its MFI portfolio there.
Is the news material to cause EPS downgrades?
Yes.
You think so?
It is going to be. Basically, the recovery that we all were anticipating in MFI, because of this kind of gets pushed back by a couple of quarters.
Okay.
And sorry, go ahead.
No. So just is there a signaling effect here as well? I mean, will you as an analyst will you say, well, where else can something like this happen now? Or is there a risk or?
I think if you go back, this was probably say a couple of years back. The central government had brought out a bill called Bula, which essentially was trying to restrict the unregulated lending in the country. I think these are various versions of those bills being put out by different states. It all depends on how fast the growth in respective state is, or say the so-called borrower distress is, right? Because what unfortunately ends up happening is that there is an over-lending, over-leveraging, then there is actually stress amongst borrowers, and that's when the state governments are forced to act.
How many states have implemented a similar act?
So last year we had Karnataka, followed by Tamil Nadu. Now we have Bihar.
Okay, so 3 so far. And there is a risk that the other states follow suit.
Yes, but I think gradually, as we have seen, the states have also learned from this. So Karnataka was a sudden, in my opinion, out of the blue, followed by Tamil Nadu. I think Bihar has also implemented it, but after in consultation with a lot of the industry players.
And the Bihar MFI portfolio itself has been declining, right, over the last couple of years?
So if you look at the overall industry has been declining, so has Bihar. Okay. The extent of decline for Bihar has been lower.
Has been lower. Okay. All right. Got it. So that's about Bihar. Let's focus on the other sectors then. Yesterday the big news piece was on Chola. Now we know there's not going to be any big rejig at the top, at least as of now. But Chola has always had a big valuation premium in comparison to, say, a Shriram Finance. Now we know Shriram Finance has fresh capital. And that's why that valuation gap could actually narrow. Would you be in that camp? Because some believe that now Chola doesn't deserve that kind of premium. What do you think?
So, it's not just one versus the other,
okay.
Right? If you look at the Indian market, the Indian lending space is basically 250 lakh to 300 lakh crores market. Over there, even if you look at Chola is a 2 lakh crore player, Shriram is a 4 lakh crore player, potentially even going ahead if you look at it. So, it is a very small portion of the overall credit segment that we have. In terms of valuation, see, there are multiple things that go into the what eventually market ascribes value. Chola commands the premium valuation because of consistency, stability, and basically the ability to deliver superior earnings growth.
Right.
So if you look at the earnings growth that Chola has been delivering, it has been north of 20-22% for the last decade or so.
So you believe that it deserves that multiple?
So eventually, and this is in my opinion, a few days back, I was discussing with someone else the same thing. In case of lenders, we have this issue of looking at price to book. Few lenders who are consistent, predictable, they also start looking at it on a price to earnings basis, which is what we see in case of Bajaj Finance or a Cholamandalam Finance, or back in the heydays, even HDFC Bank.
Okay, so the top 2 picks for y'all in your coverage universe as of now. You mentioned Bajaj Finance. That's up more than 10% in just the last 1 month or so. If you could give us your top 2 picks.
So, see, overarchingly as a house, we are more positive on banks vis-a-vis NBFCs. NBFCs, the challenge is that there is a risk of earnings cuts because of the GSEC yields that they have hardened. You will see margins, the expansion that we had, all the analysts and investors built in, that will get cut. And which is why the valuations probably could be impacted because of that in case of NBFCs. Now, in this construct, I think within NBFCs, our top 2 picks are basically Tata Capital and Chola Finance, followed by Bajaj and Shriram closely.
Beautiful.
In 20 seconds, if Apple Pay enters India, I know it's very early stages, but it perhaps potentially can be significant. Who will be negatively impacted?
See, again, Apple Pay payment space in India per se doesn't generate any profitability or revenue, right? You'll have to look at adjacency. In India, you look at any of the digital lenders, there is a certain initial scale-up that happens, but beyond that, it is very gradual. You have to build out branches.
Pine Labs and the MobiQuicks, which reacted negatively yesterday, would those be the ones on your radar?
It all depends on what structure it comes in, right? Basically, whether it's a merchant POS they are entering, consumer side, depending on where the profitability is. But yeah.
Good chat, Viral. Thank you for dropping by. Appreciate it. Well, we've got market open coming up, so let's just look at prices as they start coming through on the air. What do we have? It's slightly lower, nothing dramatic. 25,450, so about 0.25% down. I mean, this essentially been it. 1 day up and 1 day now down with little follow through. The Nifty Bank is blinking red and green, but I think it's red as it settles down. 0.4% lower, 60,915. And we'll look at some of the lenders in just a bit. Mid-cap index is down about 0.25%. The small-cap index will come up. And I think there is a bit of a cut there as well. So 190 points, that's about 1/3% down on the, or actually the broader indices at this stage. Let's just look at the Nifty heat map. Where are the Nifty 50 stocks landing? Right at the word go, and then we will take it from there. We have, 48 odd names which are down. And you've got some tech names which are higher. Infi is responding well to the last night bounce. TechM, HCL Tech, TCS, Wipro. Yeah, I mean, it's like no in between for IT names, either top gainers or top losers. This Power Grid, Trent, Aisha, which are some of the other names which are starting in the green. So that's the open. There's about 90-point cut, so in line with what the GIFT Nifty indicated at 8 o'clock. So right there, 25,400 on the index. Rima.
Well, yesterday we did see a rotation away from semis into software stocks in the US. So Salesforce continued with its rally and many others. And that's rubbing off on the Indian IT names. So right on top, Infosys leads with a 2.5% gain. Tech Mahindra, HCL Tech, TCS, Wipro. In fact, in the Nifty pack, only IT stocks are up in the green. And you go down the curve in the IT space, even mid-cap IT companies are participating on the way up. So Emphasis, Coforge, Birla Soft opening up with strength, 2 to 3% higher on many of these names. Well, now you've got a Jio Financial and Trend also in the green, but the gains are negligible. On the way down, auto sales are retreating. M&M, Maruti Suzuki, weak in trade. Remember, on Sunday and Monday, we'll start getting in the auto sales numbers. And the month of February, seems to have been good. The Vahan data suggests very strong retail offtake, but we will know the production numbers. So that's the next macro indicator for the Indian market. And M&M, Maruti are correcting a bit. Reliance has been a bit of a cloud this week. So Reliance Industries is down 1%. It rebounded also yesterday, but down 1% for the day, down 2% for the week so far. Bharti Airtel has been subdued ever since the announcement of their NBFC push. Dr. Reddy's has been weak. Ultratech Cement, JSW Cement, Max Healthcare, Cipla. These are some of the laggards today. But sectorally, if you have to pin it down, it's IT on the way up. And you've got banks which are underperforming to some extent the frontline indices. The Nifty Banking Index is down nearly 300 points.
All right, let's run you through a few names then that are moving around. Vishal Mega Mart, because of the large trade that's just taken place on the screen, 14% equity changing hands. That stock's down close to around 7%. Apollo Microsystems, that stock is coming for some profit taking. Volumes are quite large for the first 2 minutes, so that's down close to around 5%. A bit of an overhang with regard to what's going on that new regulation coming in from Bihar government on MFIs. That appears to be weighing on stocks like L&T Finance, Bandhan Bank as well. Yesterday they told us they believe the worst of the MFI pain is behind and things are looking up. So after the kind of rally, I think Bandhan Bank is up 30-35% just in the last 45 days or so. That stock's down a little bit in trade. Renaissance Global, we were pointing this out yesterday. Volumes were massive. Delivery was very minimal. Stock is coming for some profit taking. That one as well is up 35% in this month itself. Tejas Networks. The order win yesterday has given it wings to fly. Yesterday it was up close to around 80-90%. Today it's up another 7%. So big pullback for a stock that actually is a third of what it was at its peak. Balu Forge as well, you had some fundamental positive news that came in yesterday. The stock continues to build on to gains. It's up close to around 20% in this month. But the index to look at today is tech, and that one's really leading the way after the kind of selling that we've seen. The tech index actually is surging away. And I'll tell you what, last couple of trading sessions, the Nifty Bank has seen some kind of buying at around that 60,800 odd mark. The last 3 days, the day's low is around 60,800. We're 150 points away from there. The bulls will be hoping that they get the 4th time lucky as well. So keep an eye out on that index.
All right, just look at the indices and they'll come up on your screen now. Let's see, this Friday turns out to be by close a little better, or this is a down day, but it's been. It depends on. It's almost like there's no follow through. That's basically the pain point here in either direction. So you could be right one day but wrong the next one. and vice versa. Gargi Chaudhary is with us. She's Chief Investment and Portfolio Strategist Americas at BlackRock. She's with us here in our studios. Gargi, great to have you with us here. Thanks very much.
Wonderful to be here.
For much of our conversations here over the last 1 year or so, it's been about President Trump and tariffs. But I think this year it's not a new thing, but it's AI and what's happening there across the board. So just, is that the number one conversation you're having with clients, and what's your thought process?
Sure. So, obviously not a new thing. We saw the market starting to move at the introduction of ChatGPT back 3 years ago. And I think the new news now is this rotation within the AI theme. So really recognizing that AI is here to stay. And there's going to be a lot of disruption in the economy as a result of that. And perhaps we're seeing some of that in the software sector now. And what the market is actually favoring, what the market's actually rotating towards, is really the adopters and the builders. So it's still the AI theme that's very prevalent, but it's really where you go. Who are the disrupted and who are the adopters and builders? And obviously that's where power, infrastructure, and energy and materials are doing so well. So,
so do you think it's overdone a little bit? The markets, of course, sell off first and then try to figure out whether this is correct. But because there is this cloud hanging and no one is sure, I guess there is a fair bit of that. And I'm assuming money managers are generally, like all of us, generalists, right? They're not technology people. I mean, there are technology specialists, but there's so much new stuff coming out every day. And you can't model all of this in terms of what the disruption will be. So there are these sell-offs. My question is this a little overdone now from your perspective? What we've seen, this is very near term, what we've seen over the last, it started, if you remember, many Wednesdays back with, sell one industry, next one. It's almost like, so is it overdone a little bit?
So I think it's important to recognize that there is going to be widespread disruption. I mean, you had maybe 100 million people in the world that could write code, and now we could live in a world where everyone that has a computer can suddenly write code. So software is going to get disrupted, no doubt about that. But I think recognizing that not all code is the same. So are there going to be parts of software, of services broadly, where you're going to have something special? So we really think cybersecurity, for example, part of software, part of services could be a little bit better than some of the other broad software services. So perhaps in certain parts it's gone too far, but I think we all need to recognize that there is a very strong transmission mechanism that's going through, a disruption that's going through, and it's going to be positive for GDP, eventually positive for many parts of, again, the adopters and builders, disinflationary, great time to be invested in the markets, but not without some pain along the way. And I think that's what we're seeing.
Yeah, we can feel the pain here out in the Indian IT stocks. By the way, did you guys know that in KOSPI, two stocks, that's Samsung Electronics and SK Hynix, account for 36-37% of the whole index weight. So as long as that AI theme runs, that's the reason why KOSPI has been doing so well. But, Gargi, so tell us, this brings me to the next question about emerging markets. What is the advice now? We've seen KOSPI do well, we've seen Taiwanese markets do well, and capital has naturally gravitated to these indices at the expense of India.
Yeah, I love the EM story for so many reasons. And I think, when I was last here with all of you in June of last year in the studio, we had this conversation about how in the US and broadly in Americas, emerging markets are very under-owned. And for the first time in a long time, investors are figuring out that they need emerging markets in their portfolio, and it gives them that something a little bit different. So you're getting the AI exposure from the Korea, Taiwans, and China, but you're also getting a lot of manufacturing exposure. You're also getting those value names. So we continue to believe, despite the year-to-date rally and the 2025 rally, that EM is where you want to allocate going forward. And one quick thing that I noticed this morning was year-to-date inflows into EM equities. It's like 8 weeks of the year. It's the third highest ever since we've had industry records. So people are flocking to EM. It's very much a trade of AI. So it's a diversification within AI into the builders. So you mentioned South Korea and Taiwan, very much the builders of memory and chip, as well as India, which could be a nice barbell to your AI trade.
Well, and where does India feature then? Because for the last 18 months, we have been missing in action. And prior to that, we were the only game in town.
Yeah.
Do you think Indian markets are back, getting back their mojo? The flows actually have turned around. As you said, just 8 weeks. At least it appears that FIs are leaning in rather than out. which is encouraging from an India market perspective. So how do you place?
Absolutely. So I'd say two things. On the equity side, on the long term, for a strategic asset allocation, Indian markets are absolutely where you want to be. There is the demographic growth. You've got the digital as well as the physical infrastructure. You've got the domestic buyers. On a more shorter term, so on the more tactical front, what I think is more important for investors is a lot of the risk events have gone. So you've got the trade deal in place. More importantly, you've sort of understood for right now that this might not be the AI story, but maybe it's a good diversification for an AI story. And then the third thing is earnings or PE has pulled back quite a bit. Valuation used to be a huge problem for the India market. Now that we've pulled back, especially compared to some of the other EM regions, India's looking cheap. So I think that might cautiously get investors back in. On the bond side, though, that is where the real story is. We really like Indian markets, especially the ability to clip about 2.5% real rate, we think is super attractive in the local markets.
Okay, all right, just one quick point as well. We saw what Mr. Dorsey did overnight. And the fear is he went ahead, he's laid off 4,000 employees. Market capitalization has ballooned by around $6 billion, if I got that number correct. So mathematically, it's around $1.5 million odd for every employee that's let go. The fear is that other entrepreneurs as well could say, let's buy the bullet right now. It aids market capitalization. Hopefully, it aids productivity. And just in the near term, on the cost side, things plateau out. Or what's your take?
I think that we're going to see a lot more labor market disruption. I think especially in some of the major economies where you've had the problem of aging. Not the case in India for sure, which is why we love the Indian market strategically. But in a lot of the other regions of the world where you've had that problem with labor supply, I do think we should get used to a lower number of job creation. And as a result, many companies, such as the one that you mentioned, that might have had a ballooned labor force, might be using this as a good time to create some margin expansion by using AI as a way to right size.
My other thing is, right, the reason why I just go back to what I started with, whether this is all in that sense overdone or I'm not saying this is not obviously this is absolutely it's a technology revolution, etc. But markets are markets, right? They try to price everything as fast as possible, but they're also not always efficient. So that was what I started with. The question about Dorsey, right? What he's done at Block. Some are saying, well, it's kind of wrong to label them as AI layoffs, right? Because this was apparently 2 to 3 times more. It was bloated, and this was coming for a long time.
Exactly the point that I was making, that people are going to use the AI label to get their profit margin expansion. And it's a good time to do so because you're going to have a very positive reaction. But I think the broader, taking a step back, let's not look at that one single company. Let's take a step back and think about what this AI proliferation eventually could mean. Could this mean that many companies become a lot more conscious about the sizing of their labor force? And does that mean...
a fair question
that's a fair question, and I think that means there's going to be a little bit of pain, but I do think there will eventually be that view that, okay, we are seeing effective productivity in the economy, which is good for GDP.
Do you have the Anthropic notification on for you on social media? Gargi?
Listen, I think that
signal?
Claude has made me a much more productive human being. So if there's more of that coming, a lot of GDP to follow globally. Good investing environments.
Is that changing your business as well?
I would say that it's some parts of it. Look, you still need humans. We're sitting here having this conversation. I can't imagine that goes away. So sometimes when people are like, oh...
I was joking, 4 robots sitting here.
Yeah.
Maybe 2 years down.
I think you need humans to understand what's good work and what's not. AI can't do that for you. You need experience for that. But at the same time, if we can all get more efficient, if you can do 2 hours work in 12 minutes, I think that's a really good outcome for the economy. There's so many things I can't focus on right now. Small cap markets, for example, that's not covered enough. Now I can, because I have 3 agents on my side. So there are some productivities there.
Well, it is.
You've got quite a few years to work. I hope you're not at risk, Gargi.
Listen, keep investing. That's all I'm saying. Make the money where the money is being made.
Nowadays, you get up in the morning, what do you read first?
I listen to Bloomberg Surveillance, which is my favorite podcast, and I read Wall Street Journal. I'm a finance.
You should tune into wherever you are. I don't know the time zone difference, but you should tune in 8 o'clock. CNBC
TV.
Don't miss it.
I will never. That's my evening run routine.
Thank you very much, Gargi. Appreciate it.
Absolutely. Thank you.
Thank you. Well, I think that is an interesting conversation with global a strategist, money manager at BlackRock with perspective on AI and so much else. Well, we'll take a quick commercial break here. We'll connect with the management of L&T Finance. Now, L&T Finance management, of course, has been using and perhaps has been ahead of some of its competitors with regards to using some of these technologies, and they spoke about it extensively. We heard from the Bajaj Finance management recently on how AI has improved efficiency in terms of disbursals, etc., at the end of the third quarter. So that's the focus as we come back with the L&T Finance management. Stocks done well. Sudeepta Roy is with us on the other side.
Welcome back. Markets have slipped to the day's low. We're down over 100 points on the Nifty. The question is, yesterday's intraday low has been breached briefly, but will the 200-day moving average hold, which stands at 25,350? We've got about 20-30 points from that key level. But joining us here in the studio now is Sudeepta Roy, Managing Director and CEO of L&T Finance. Sudeepta, in the last night we thought that we'll ask you about Cyclops and Nostradamus and all the AI tools that you are using at L&T Finance to enhance credit underwriting, etc. But now we've got that Bihar news, the new MFI regulations. So just first a question on that. What is your exposure? Could you quantify that? And do you expect it to slow down lending, or will you slow down lending? And will it hurt the collections and therefore asset quality?
Okay, first is it's been passed last night in the Assembly and it's still waiting the Legislative Council, and we're still studying the minuteness of the bill. So probably it'll be too premature for me to comment fully on it. But Bihar is a reasonable part of our portfolio, but obviously we are spread all across the country. It's about 17% of our portfolio. But if you see our collection efficiency, for example, our collection efficiency this month, we're just one day away from the close of the month, we are upwards of 99.7. So overall, I do not expect a major impact on L&T Finance's go-forward strategy as well as our collection efficiency in Bihar. But the fact is that we'll have to study the statute in greater detail together with our and await guidance from the MFIN, our SRO, and then take our according steps.
Can you give a number on the exposure?
In summary, I do not expect any major impact on L&T Finance.
Can you give a number on the exposure?
It's too premature. Exposure is about 17% of our overall.
17%. And directionally, do you think you'll need to slow down lending? I get you can't share a number.
See, the fact is that because we were very dominant in Bihar, right? We have already, over the past 12 months, started diversifying away from Bihar to other locations, including new geographies, right? So anyway, our Bihar moderation was already in play. So that's why and given the fact that our collection efficiencies are almost 99.7% plus, for us, we do not expect any significant impact out of this.
All right, so just to get one more number out of the way, 17% of your MFI book, right?
That's right.
And
That's
your MFI book is broadly around 25% of the mix.
It's slightly lower than 25% right now.
So then ballpark out of the total book, Bihar MFI would be around 4%? That would be a fair estimate.
That would be fair estimate.
We'll just make that change. 17% of the MFI book is Bihar, essentially. Now, Sudhir, morning. Good to see you, as always. You know, the specific provisions which will apply, because there's lots of stuff, but RBI regulated entities are exempt from many, but the provisions which apply: prohibition of coercive recovery methods, borrower protection measures, and fair recovery practices. I mean, in theory, all good stuff. In that sense, you would agree.
Yeah, obviously, you know, any positive regulation has to be made welcome, and the fact is that it will smoothen the go-forward trajectory much more.
What does this because there is no interest rate cap or anything in that sense, right?
Nothing.
So if this is what it is, which will apply to players like you, which are regulated by the RBI, in practical terms, what does it mean? I mean, you said it's very difficult to estimate an impact, but how does this play through with these three measures if they become applicable?
See, what it might play through, you know, and again, the fact is that this is still very premature. We're still studying it. But the fact is that lending will become more responsible. That is how it will play through, right? And probably the risk of over-leverage might become much lower over a period of time, right? So which is net positive for the industry going forward.
What does this not allow you to do, is my question. These three provisions.
Literally, the fact is that, again, MFIN guidelines are already there, right? You cannot lend to more than, 3 lenders cannot be there. So this is max 2 lenders. So maybe it takes away 1 lender from the entire mix, right? So apart from that, there is not much of
Can you just repeat that? What is the lender a bit?
So as of now, it says that maximum to one particular person, 2 people can lend, 2 lenders can lend, right? So, but the MFIN guideline says that max 3 lenders can lend, right? So max, it takes 1 lender away from the mix. So the risk of over-leverage gets attenuated to a large extent.
And then this will be then...
it will lead to a slight moderation in the disbursement trajectory, might lead to a slight moderation in the disbursement trajectory in Bihar. But overall, in the long run, it will avoid the risk of over-lending, and I think it is welcome.
Yeah, in the long run, absolutely. That's that, and we'll chat more when we have more clarity in this kind of stuff. But thanks for answering all those questions. Sudeepta, just coming to the AI-led, and which Rima started by asking you as well. We heard from the Bajaj Finance after the third quarter numbers, them talking about how they've now deployed AI and what that has enabled them to do, and they put rupee crore numbers as well in terms of how this has made it possible. And one interesting thing with this here is that we didn't have these tools in Q2, and they deployed it in the third quarter, and this will start to pick up more. So just your thoughts on that as well, and where we are in L&T Finance's terms. Has that pace picked up? Because you've spoken to us about this. You're using all this over the last 6 months, maybe more.
Actually, we are using for last 24 months.
Okay.
Last 24 months. And before I come to that, there are 3 broad areas that we focus on AI in our organization. First, what we call is efficiency, experience, and education. They're the 3 broad areas, 3 E's we call, right? And the second thing is that we follow a couple of broad tenets. For us, AI is not just, people think it's generative AI. It's not just generative AI. We are focused on, we apply the entire continuum, which is, machine learning, deep learning, and generative AI, right? And the fact is that there might be a solution in which both or a couple of them play together, right? This next thing is that, one thing which the industry must understand, that the generative AI or AI in its own is a very powerful tool, but it requires a serious engineering wrapper around it, right? So you require a lot of software skills to put useful solutions together. Now, for example, Cyclops, which is our like AI-based, again, it has got a Gen AI layer, but it's primarily at its core deep learning based, right? It's been in operation for almost 20 months now, right? And now we are using it in 4 lines of business. Over 1 million files underwritten through it. If you see our two-wheeler business, before Cyclops, headline bounce rate on a normal portfolio was roughly between 20 to 22%. Now it's down to as low as 8%, right? In our SME business where we implemented, our gross non-starter rates are down by, in about 6 months, they are down about by 70 basis points. So in tractors, our net non-starter rates are almost about 1.5%, right? So everywhere it has given its impact. Our AI-based automated portfolio management tool, which we call Nostradamus, is already live for our two-wheeler business and now going live for our personal loans business. On top of it, we have built a copilot called Orion, which actually helps your portfolio managers with real ease of managing portfolios, and it's in a GUI format that automatically updates. So that is giving us good results. In terms of our AI implementations in underwriting, for example, about 3 months back, we rolled out a SME underwriting copilot. We call it Helios. It basically, when you get an SME file, they're large, thick files, Bureau CMR can run into thousands of pages. So average, before we rolled out Helios, an average time to underwrite an SME file was 37 hours. We have dropped it to 16 hours. And 2 modules are yet left to be deployed. So we expect that in the next about 6 months, we should be able to drop our average time of underwriting an SME file from 37 to 40 hours to about 8 to 10 hours. So that is a productivity improvement. So for example, because of this, we have already underwritten 7,000 files of SME through it. It's a well-established solution. And this year, we have not added much of underwriters in our physical underwriting capacity. Is that we are deploying it across the organization. For example, our legal head came that day and said that they have built a legal tool within the legal team, which actually, they built a copilot which actually automates the interpretation of title searches, right, which are in different languages as well as complex. Right? So in a way, it's diffusing throughout the organization, going through all lines of business as well as all support functions.
I have to ask you this. Do you see a lift to earnings because of all this across the board?
See, lift to earnings will come with a lag. It won't happen immediately because one of the things you have to, and this is because we have been at it for a period of close to now 24 months. See, when you start making serious AI implementation, the first thing you will notice is your cost of compute going up, right? So your cost of, actually it's a hockey stick. Your cost of compute, your investment in digital and data science initially goes through an upward hockey stick, right? But over a period of time, the efficiencies from the processes that you are deploying in will come down. But the fact is that if you are not mindful of a cost of compute, it can end up differing a large amount of the goodness that comes out of the deployment. So for that also, we are starting building our private cloud, actually. Our tier 3 and tier 2 applications over a period of time will move to private cloud, right? So it's a mix, it's a journey, but I do believe that over a period of 24 to 36 months, the AI initiatives have the capacity to add about 20 to 30 basis points to a ROA lift.
Have you, in terms of hiring, are you hiring at the same pace or?
See, sales guys, we will have to hire, right? Because the fact is that though the sales guy has tools now to interact with the customer, like for example, in mortgage business, we have rolled out something which helps a copilot, which helps our mortgage guys answer the questions much faster without referring to the product management team, right? But in India, you still require a warm body, especially for a sales-facing role, right? Especially
so what
if you're
about
in
credit underwriting?
But credit underwriting, risk management, right? The risk control units on ground, right? Legal teams, right? Our support teams, more or less, we do not expect any headcount increase.
Have you seen a reduction in the support teams?
We haven't seen a reduction yet, but the fact is that one place where we might see reduction is an outbound call center or an inward call center, right? Like 40% of our collection calls are now bot-driven.
I just had 2 more questions. When you said you've applied this to SME.
Yeah.
Look, retail lending is quite, it's template lending in that sense, right? I mean, there is SME,
to a certain extent.
To a certain extent. SME perhaps slightly complex, and corporate lending perhaps is the
most complex.
But for SME also, you will need to send people to all these, I mean, a factory in Bihar or wherever, right? They want,
Yeah, so as I said, front end, you will continue to have people requirement where, someone sales guy has to go, makes the initial pitch, etc. But once the file comes in, that's where the heavy lifting starts.
Okay, there's one more question. You must work with IT services companies, right? And they must apply, build these things for you. And
no, actually,
you must have continuing...
that is where the difference is. We all build all these things internally, right? So we have a tech center in Mumbai and we have a tech center in Bangalore. Our tech center in Bangalore is primarily invested in building all our AI tools and solutions. And as I said initially, 15% of the solutions is AI. The remaining 85% is a heavy engineering wrapper around it. So what we do is that our data science team builds the AI front end, but the engineering wrapper around it to make it useful in the front end is made by our Bangalore tech.
Was L&T Finance always doing all of this in-house, or
we have set it up in the last 24 to 30 months. We have set it up.
Before that, you were dependent on?
Before that, we were dependent on some of our tech service partners.
Have you quantified the amount you've spent on AI?
Okay, so individual tool-wise, I can say. So Cyclops, till now, we have probably spent about 80 crores, right, overall. But that is not only on AI, that is the AI and the engineering build around it. Nostradamus, as of now, we have spent about 30 crores. So between these two large tools, and they're the two most impactful tools, it's about 110 crores. So overall, this I can quantify, but overall, we see our tech budgets are relatively flat because we have done a lot of optimization last year on the cost of compute, but it will remain in that flattish phase for the next 2 years.
And the cost of compute is over and above the 110 crore, right?
Yes, the cost of compute is over and above the 110
crore. How large is it?
It's pretty large. It's pretty large. Before we started plateauing it and before we started putting serious focus on containing the cost of compute, the growth on a year-on-year basis was upwards of 50%. So that's when, the bell really rang, saying that, look, the fact is that all these tools are good. They can do a lot of heavy lifting. But if you're really not mindful of the cost of compute, you do not get carried away. If you're not mindful of the cost of compute, will undo the goodness.
When you say cost of compute, what is this going into?
See, basically, if you are relying on, say, for example, there are certain processes that might not require hyperscaler level of efficiency. But if you put all your processes on hyperscalers, that means at times there is idle capacity.
No, I get it. What I was saying that when you say cost of compute, the spending, what is it going into? Or what are you buying? Or what are you spending on?
You're spending on your virtual machines and your cost of compute on the virtual machines on the hyperscalers. So, for example, if you're running a query, for example, and when you lose this query, like when you push these tools into the hands of people, at times people do lots of things which might not be productive also, right? Which might be sort of leaching on the margin, right? So that adds to this overall compute consumption, right? And suddenly when you start deploying these solutions at scale, you will see compute consumption explode.
Yep.
And if you are putting everything on hyperscalers, you will find your cost of compute also explode. Then you start peeling it and saying that, does this require really hyperscaler level of efficiency and reliability? Or can I do it separately in my own private cloud? And that's where, so we have optimized. For example, our people, we have built a tool now, when a particular product manager or a particular data science manager, if you find that his cost of compute has suddenly shot over the last week, he gets an email saying, explain why your cost of compute this week has gone up. So in a way, it is employee sensitization plus also structurally moving a part of the sort of the non-tier 1 applications to private cloud.
If I call the L&T Finance call center, will I be speaking to a machine or a human being?
As of now, probably from March, for the less complex queries like how much you want payment due, etc. March, April, you might be speaking to a machine, but for 40% of our outbound collections calls are now done by machines.
Outbound collection calls, and they're polite?
They're very, very polite. In fact, the fact is that is the best part about using AI bots is that they never lose their cool, right? They might take some time to respond, but they never lose their cool.
Very quickly, just to get a couple of numbers out of the way, you told us last time around 20-25% growth is what you're looking at. Do you stick to that? The NIMs plus fees, I think you were explaining that will stay more or less constant, 10-10.5%, I think. So you could just retrade that. And ROAs, when we talk by the end of FY27, 2.8 to 3%. Is that correct? 3 numbers.
Absolutely right. We'll be announcing our Lakshya numbers in April as part of the Lakshya 31 numbers, target numbers. But the fact is that those guidances remain. NIMs and fees in the range of 10 to 10.5%. ROAs exit FY27, quarter for FY27 in the corridor of 2.8 to 3%. and credit cost paring down to the range of 2 to 2.2%.
Sudipta, thank you very much. Great conversation, and really, I mean, you helped us understand some of the nuance of how this is really done. We talk about AI, but of course, applying it requires, as you put it, the engineering wrapper around the core technology. Thank you.
Thank you so much.
Here. Okay, well, let's just shift focus to the FMCG space now. And my colleague Mangalam spoke with Marico's Managing Director and CEO, Saugata Gupta, and started off by asking him about the shift in product portfolio over the years. We just want to play out a slice of that conversation. Listen in.
See, I think we realized sometime in 2020 that the current core, given the fact that most of the categories we are in had high penetration, doesn't have the legs to grow, say, double-digit year after year. And that's the time we started the diversification journey. Food was one leg of it. The other was, of course, in premier personal care. So it's been a very, very energizing and a fruitful journey. Today, the portfolio is completely different, and that has perhaps, ensured that we have been on a high volume and a revenue kind of a trend for the last couple of years.
Major announcements that have been made. There was obviously 4700 BC. There was the announcement of an acquisition that you did outside of India. And then there was one in cosmetics as well. What else is on your cards right now?
We started off in India where we first took Beardo, then took Just Herbs, then True Elements, and then we have recently made 2 more acquisitions. I think Plix has been a very, very, something which is very exciting journey. It started off as a nutraceutical brand, pivoted into hair and skin food, and it's perhaps the first brand sometime next year will hit 1,000 crore kind of a mark with a double-digit EBITDA. I think most of the spaces are filled. We still have 1 or 2 gap areas, but I think most of them are largely filled, maybe in personal care or... See, I think it has evolved. For example, initially we were in wellness. The reason we went into gourmet snacking 4700 BC is we thought that the TAM for that is around 24,000 crores. Wellness TAM is slightly lower. So therefore, I would say it's largely done. Having said that, there could be opportunities in foods and the mass scale in India. Internationally, we just started it, and the reason I think it started off is in Vietnam. It's following a trajectory of India where BPC is nearly 40 to 50% e-com. We wanted to replicate this model, and we want to continue to replicate this model even in UAE and Saudi, which is the next step, because that is where again internet penetration is high. We believe that this digital business, organically or inorganically, we can replicate this model.
Let's go inside. Let's sit down and have this conversation at a deeper level about Marico's thought process when it comes to making these acquisitions, growing these companies, and then ensuring that at a consolidated level, your growth is top quartile. Let's talk about the sizes. The last 3 acquisitions that you made. Cumulative ARR would be around 350, 400 crores. That's roughly 4 to 5% of your sales. The legacy business is so large right now that these incremental bets that you're taking will still be small. So at what point does the inflection point come in?
So here? Not really. If I look at it, as an organization, we want to double every 5 years, which translates to, say, a 13.5 kind of a percentage CAGR. Okay. Yeah. And I think our core has the legs to grow, say, high single digits. Okay. Some part of the portfolio, like a value-added hair oils, I think we are extremely confident of delivering double-digit growth, which is good because it's a high-margin part of the portfolio, X of Shanti Amla. Okay. What we need to do is the diversified portfolio to grow at 20%.
Got it.
Which is not a very difficult task. And if I look at it, if I add all the brands together by 2030, there will be 4,000 crores, which is sizable. Yeah. Out of 20,000 crores, which is clearly 20%. And if you look at the diversified business, sometime in 2020, it was 6%. Now it's around 20 to 23%. So it is significant, and it's contributing a significant part of the incremental growth.
So immediately, if I was looking at scale, what are your targets that you've set on 4700 BC as well as cosmetics?
So all of these brands, I think 4700 BC, given a higher TAM and the fact that it can perhaps utilize our GT the best, the Marico GT system the best, and plus it's available in multiple institutions. The channels of growth are completely different from some of the other brands. I think can do a 3.5x in 3 years. The others can do 3x in 3 years, which is a fairly
And
kind of a great
what would
by
the margin
2030,
synergies be here?
2030. See, I think one interesting thing which we have done is, as you know, Beardo is already in double digit.
Yes.
We expect Plix to hit double digit next year. The last two actually are high margin.
Yes.
And so Cosmix is sustainable high teens EBITDA. The one which we have in the Candid brand, which is Kinetech, which we have acquired in Vietnam, is a mid-20s EBITDA.
Yeah.
Now, with that, I think our acceleration of our bottom line is firmly in place. I think there are two brands which does a little bit of a kind of a cash burn, minor, which is True Elements and Just Herbs. We have to get it over the next 2 years into break even.
So if I'm looking at Marico in 2030, when you're talking about the 20,000 crore top line, 4,000 crore of which comes in from the diversified new age digital portfolio brands and food brands, etc. What would the margin of that 4,000 crore portfolio be? What would the overall margins of the company be?
So I think it will. I think there's scope for the creeping growth in the margins. As an organization, we operate in emerging markets. For us, volume growth is the most important thing. So I think margins will automatically come with scale. There are certain places like food, for example, has already shown. Say the masala oats, the oats and masala oats, the business already makes company-wide EBITDA. So I would say that obviously they will be significantly profitable. It will take time, but it's okay because as long as it continues to drive high growth rates, but I think it will be significantly profitable with some parts of the entire pool, which is the digital business 4,000 crores, and of course the Saffola Foods also will grow into a certain number. Can hit a company EBITDA because, as I said, Beardo is already in a double-digit kind of an EBITDA.
So what does this mean for the very near term now? The next, you've given us the 2030 targets. Now let's talk about the next couple of quarters, next 3-4 quarters. What's the business looking like?
So I think, as I said, that we would like to continue to deliver. I think for us as a base case is a high single-digit volume growth, continue to diversify. I think it also offers us space to expand margins now that we are we had a lot of input cost, inflation, which is behind us. And I think the steady state of diversification, we have a very, very stable and healthy international business, compared to a lot of other players where we have not had surprises. We have been extremely resilient in certain countries where it has gone through, some kind of an upheaval. And I think we continue to be what I call boringly consistent, but at the same time continue to deliver top quartile growth.
Okay, that's an interesting chat, and we'll play out more of this conversation a little later. But let's move on to our next chat here. Motilal Oswal Alternates, the alternative investment arm of Motilal Oswal Financial Services, the listed companies, closed their first private credit fund. It's called the India Credit Excellence Fund 1. They've raised 1,700 crore rupees. The fund will primarily look to give money in terms of secured lending and customized credit solutions for mid-market businesses in India. Rakshat Kapoor is head and CIO at Private Credit, Motilal Oswal Alternates. Rakshat, good to have you with us here. And,
thanks,
congratulations.
Prashant. Great to have you here.
Huge amount of interest in private credit, as we were just discussing before we hit air. So what should investors? Who are the investors first of all? I mean, who are the people who've given you money?
So I think pension funds, corporate treasuries, family offices, high net worth individuals. So that sort of comprises most of the supply side of it. I think I would say that the initial years of private credit in India, you would have seen more family offices and high net worth individuals. But as the asset class is maturing, people are running their second, third funds, and more capital is getting returned. So you've seen now, larger institutions coming into some of these funds. And I think
has it been an easier sell and easier raise in that sense? Because I mean, secondary markets have been struggling for the last year and a half.
So I think, I think from an investor standpoint, they look at consistency in returns, which probably the private credit or the overall fixed income space really sort of gives you. It's sort of less correlation to public markets. And I think, obviously there is a yield pickup over a standard corporate bond. So, I think that sort of also helps in managing and, hedge against the inflation and probably, maintaining an overall returns. And obviously, as long as public markets remain a little bit more volatile. So to that extent, raising money in private side becomes a slightly more easier comparatively.
So for our viewers, you would give money to corporates, right? You would charge them an interest.
So Prashant, this is very simplistically a corporate lending product. So, you lend to corporates, you lend to mid-corporates, and I think...
and then when you receive that interest, you pay that out as dividends to your...
It's exactly a par with how lending to corporates works in very traditional financing shops like maybe banks and NBFCs. Well collateralized, well secured, covenants backed, proper credit conditions, and tightly run and docs, etc.
So here's the question, Rakshit. Why? And this is, we get this all the time. I mean, if you... we covered this as well, a bit of a wobble in the US credit markets, private credit markets, which is, of course, humongous, right? It's grown 10 times in the last 10 years.
Yeah.
Here, of course, we are not picking up. It's pretty large now, and there's a lot of interest, as you said. Who are the corporates who are coming to private credit funds to borrow? Because the general assumption or it's perceived to be that these are lower-rated corporates, right? Who can't access bank credit, because why would you go anywhere else? I mean, no one can. I'm assuming no one can beat the rates of interest that a bank would charge. So talk to us about that.
No, so I think fundamentally private credit doesn't really compete with bank credit at all. I think it's the nature of risk. I think the traditional banking is more towards day-to-day banking, normal working capital, supply chain, trade finance, and project financing and general capex type of loans. Whereas I think private credit sees an opportunity where there are maybe some dislocations in balance sheets, right? I mean, you sort of expanded capacity, but your revenues are not in line with earnings. So what do? So you probably will have to refinance some of your loans and, to realign your capital structure. And that doesn't fit into your central bank guidelines around where the banks function. So to that extent, you will probably have to step out of banking day to day and go to a credit fund and sort of borrow that interim. Second, I think one of the very important points is that private credit is not like a 10-year money. We are not substituting a long 10-year straight bank capital, right? These are more interim financing solutions. Second is, if you look at, I think a lot of corporates will raise equity for all the current credit cycle that is currently there. And not all sometimes capital comes from equity. So sometimes corporates do try to think, let's try to raise this private credit money, get the catalyst and get the growth triggers in order. And probably after 1 or 2 years, let's go out and raise equity at a better valuation, at a better multiple and things like that. So these are more interim solutions and which is much more bespoke and sort of you try to structure it for a corporate. So it doesn't compete with bank credit at all in a way, if you ask me.
How large is the private credit market in India?
Oh, startling. I think it's surging very well. So I think just to give you numbers, I think in calendar year 25, I think the incremental assets were about 12 billion in India, give or take about roughly between 160, 170 transactions. The same number for calendar year 24 would have been incrementally about 9 billion. $9 billion. So I think if you look at...
This is new credit given
This is new incremental...
So the total stock would be how much, Rakshit?
I think about 30-35 billion at this point of time. And I think the transactions that you see, I mean, there's a lot of deal activity. There's a lot. And obviously, if you look at, there's a fundamental credit growth in economy, right? I mean, you look at the credit growth on quarter is also 11-12%. Not all capital comes from bank credit and public equities. A lot of traffic does flow towards private credit funds.
Now, the big one, right? The RBI and the regulation, it's unregulated in that sense.
No, of course, look, it's a lending activity, but lending, and we have a regulator, which is SEBI, and I think it's a very tightly governed structures in terms of...
Because the size has become very large. Some seasoned people have said that eventually they will the RBI, would it look to...
So Prashant, yeah. I would say that I think depends on institution to institution who's sort of running these funds. And I think more institutionalized frameworks, everybody has a credit policy, everybody has an investing framework. And I think if you follow that governance and framework and disclosures, and I think you follow both in terms of, try to see the best of both the regulators. But it's a very well-governed structure in terms of the approval process with SEBI and even the quarter-on-quarter disclosure that you have to do with your investors and unit holders.
1,700 crores, how many loans would you be making approximately?
So I would say that our first fund is about 3,000 crores. We have announced first close at 1,700. We probably would think about 2022 investments would probably come in this fund.
In the total 3,000 crore?
Yeah. Sometimes also, what happens is it's a 6-year duration. So you do end up recycling some part of your capital. So to that extent, it sort of gets to a little bit higher size and number of deals are higher.
All right. Rakshit, we'll chat more. Thank you very much. It's an evolving space, as you said. It's a big one in that sense, right? Yeah. Thank you for joining.
Thank you so much, Prashant. Thank you.
All right, we'll take a quick commercial break here. We'll come back and we will focus on Vishal Mega Mart, which is under pressure. There was, of course, that block. Kedara, I think, is selling out a little bit more. Highly profitable, one of the biggest exits for any PE fund when Vishal Mega Mart listed. But, of course, they are in the market selling more. 6% lower. More on that in just a bit.
Welcome back. The 200-day moving average is gone in the Nifty. The Nifty is hurtling towards 25,300. Mid-cap index down 1. Advanced decline ratio at 1:2. And one stock deep in under pressure is Vishal Mega Mart. Mangalam joins in for more. Mangalam, 14% block deal?
There was a 14% block deal that took place today, 14.2% to be precise, and this was done at around 119 rupees. Remember, this was a lot lower than what the stock closed at yesterday, close to 128 rupees, so there was a discount. What we understand is that it's the promoters who've sold it. So Kedara Capital's investment arm has offloaded about 14% stake in the company. As of December, Kedara Capital held about 54% stake in the company. Remember, yesterday when the offer was launched, it was about 3,500 crore rupees. But now in the morning itself, it was upsized to around 7,500 crore rupees. And it was in June itself that Kedara had sold 20% stake in the company for about 115 rupees. So we have, after nearly over 6-7 months, another 10 to 14% equity which has changed hands. So participants will obviously be confirmed once the data comes by in the evening. But as of now, we can tell you that promoters had launched an offer for sale in the market, the block, and now that block deal has taken place, promoters are the likely sellers, the stock under pressure.
Thank you very much for that. But the stock still holds on to its issue price. Issue price was 78, so well above that. 120 now on Vishal Mega Mart. Get into a break. On the other side, it's a special segment. It's the economy. Lata chats with Samiran Chakraborty of Citi and Dheeraj Lim of ANZ on the AI impact on the rupee and the upcoming new GDP series.
Fly Emirates, fly better.
Welcome to the economy, a very important day. The Ministry of Statistics is going to unveil a new GDP series, changing the base year from 2011-12 that prevails till today to base year 22-23. It will hence recast the GDP data of FY23, FY24, FY25 and give us the advance estimate as per the new GDP calculation. The MOSPI will also give us the Q3 GDP, the quarter that just ended, and an estimate of the full year GDP for FY26. Now, the CNBC TV18 poll done according to the old series forecasts that the Q3 GDP will come at 7.7%. That compares with, of course, 8.1 last quarter, second quarter. The full year GDP is expected to come at 7.6% compared to 7.4, which was the first estimate of the MOSPI. All these are old series data. Separately, the other issue which I'll try to discuss, some appreciation of the rupee post the trade deal has been, again wiped out, and rupee has become an underperformer because of the fears that software earnings will begin to be hit by AI. To discuss both these GDP and rupee, I have with me two economists, Samiran Chakrabarti of Citi and Dheeraj Nim of ANZ. Gentlemen, good morning and thank you very much for your time. I know I'm biting more than I can chew. But Samiran, first up, this GDP, two questions. 7.7, is that a downward bias? You think it could be more than that going by recent lead indicators? And the second question, the changes. But first, 7.7, your guess.
Yeah, so Lata, thanks for having me. And clearly, our bias is towards the upside. We think it's possible to get a GDP print even more than 8%. Given what the high-frequency indicators are suggesting. We know that the rural was doing very well, but there are some early signs that even the urban indicators have started doing slightly better. And let's not forget that this was also the quarter which got the benefit from the GST cut, which affected the festive season. But to us, the biggest surprise was that across the board, the investment side indicators also for this quarter was reasonably much better than what we have seen in the recent past. So almost all the cylinders were firing for the economy in this quarter. And that's why we think that the number could be in excess of 8% also. But all this is with the caveat that this is under the estimation of the old series. In fact, with the new series, the base number for FY25 itself will get revised. So that means the growth rates could vary quite meaningfully after the new series release.
Yeah, I guess, if FY23 is revised, then FY24 will look different. If 24 actually gets revised a lot, 25. So we are really in no man's land. But before I come to Dheeraj, okay, Dheeraj, what's your number anyway?
Well, a low confidence, low conviction number, 7.4, slightly lower than the poll. Okay. But I do want to clarify, look, we have a nowcasting model where we track, economic signals from about 40 high frequency indicators. There is no doubt that the economy turned a corner in the December quarter. In fact, the model shows a number of about 7.2%, which is about 40 bips higher than it showed for Q3. So the underlying economic activity in the economy certainly has strengthened.
Okay, fair point. Actually, my poll was also deeply divided. Samiran, there are 50% of the people who have 8 and 8.1 and 50% who have 7.5 and 7.4. And that's why the average is actually closer to 7.8, 7.75 thereabouts. But Samiran, the more important question, and it is very difficult, I know, is it likely that our entire series is going to get revised upwards because they're including so many things and they are changing to double deflation? Given all this, will nominal and real actually get revised higher?
So I don't know whether you were asking me the question on whether the growth rate will be revised higher or the size of the GDP will get
both
revised
actually. Both actually. I mean, from FY23 onwards, will 190 trillion become 195 trillion and so on and so forth?
Yeah, so obviously it's almost impossible to answer whether the growth rates will change or not. I would assume that the growth rates will not be too different because the so-called proxy indicators that we have taken for the growth rates, they will typically hold. But the size of the GDP will become a very interesting question. If you recall, when the last time this base year revision happened, the size of the GDP in the new series was slightly lower than the old series. Yeah. And this happens because the informal sector over the time of that, when we don't have the base year revision, is proxied by the formal sector things. And that's why the informal sector is slightly larger. But this time around, we could see other things coming in, like you mentioned the deflator point. One doesn't know that whether a good deflator reduces the size of the GDP or increases the size of the GDP. There's no way of knowing this till we see that. So everybody is going to look at it very closely on the size of the GDP, because it has implications for all the ratios that we calculate on fiscal deficit to GDP, debt to GDP, current account to GDP. All those numbers could meaningfully change if there is a substantial revision in the size of the GDP. The growth rate numbers, I would presume, would not be too different from the old series.
Yeah, just for the benefit of my viewers, the budget had assumed a GDP for next year at 399, I think 399 trillion, and last year was, I think, 357 trillion. So that 357 last year, as in this year, would be FY26 would be 357 trillion. If that changes, then the percentage of fiscal deficit, all that changes, and that's what Samiran is trying to tell us. Maybe governments will be able to borrow more, for all you know, if the overall size itself increases. Okay, now let me come to the bigger point and the more immediate worry. Dheeraj, what's your sense about, the course of the currency or the course of first BOP in FY27? I mean, AI has not hit us, but there are so many worries that it will hit us. So do you see lower software services or lower services exports and therefore lower balance of payment surplus next year?
Sure, Lata. I do worry about the current account trajectory from here on for two reasons. One, India's exports have been sluggish, of course, quite clearly so because of us missing the broader technology super cycle that is underway for most other economies in the region. And secondly, a very strong domestic demand generally means higher import intensity. And on the services export side, look, when you smooth out the data over the last 12 months or so, you already see that they have been weakening, possibly because of base effects, so it's just a cycle playing out. And it is clear that they haven't yet found a bottom. So I'm a bit worried about current account trajectory from a fundamental viewpoint of where export trends could lie. Of course, where the global growth heads, where the US growth heads in the next year is important. But the broader theme to me suggests that the current account deficit could be slightly higher than what we have seen in the recent years. Now, coming to the bigger BOP point, look, I think India is clearly facing a global capital flow problem. And I, for one, do not think it is completely an India-specific problem. I mean, in the kind of ecosystem we are seeing playing out globally today, whether it's the long-term increase in the long-term real yields across both ends of the world, or you have very concentrated growth themes, and then you have consistently high geopolitical risk premium, I think it makes for a very difficult backdrop for capital flows, and especially for economies like India, which do not have specific growth themes to which investors could be attracted to. There is no doubt India's pull factors are very strong at the moment, but for them to shine, I think the global push accommodation will have to be there. So I think this funding challenge could remain there for a while, and BOP also therefore could remain a bit challenged. So we'll have to really rethink what really is the fundable or sustainable current account deficit level in this environment. And we do maintain that the rupee does have a bit of a depreciation bias going forward into 2026.
We have your report, and you're saying that we should aim for a current account deficit of 0.5% of GDP versus the 2.5% that we could manage in the past 3 decades. And your rupee target of 93 is also flashing by. But Samiran, let me play devil's advocate. Services exports, the way IT services, Nandan and Chandrasekharan spoke, it looks like IT will have business, but they may have to do it with fewer or different people. So is it possible that revenues are there, but there is a social issue? And secondly, we've also signed a lot of FTAs. And if I looked at the exports to the total FTA countries, EU and Oman and Australia, New Zealand, etc., that is double the total exports we have to the US. So is it that goods exports may actually end up doing better? So will these two kind of underplay the BOP worries we have?
Yeah, Lata, we are in a very fluid situation now with a lot of moving parts on the BOP. So let me start off by saying that there is already a big gap of almost 10 percentage point in the growth rate of the software service exports in the BOP data versus the earnings growth of the sales growth of the top 4 IT companies. So there seems to be that there's a big bunch of private unlisted type of software companies also, which are now contributing very substantially to software exports. That's why I think it's premature to just extrapolate the headwinds that the top IT companies are facing to the entire software service exports number. Let's not forget that this is one component in the BOP, which has never ever seen a year-over-year decline. So clearly, it will be a historic day if we actually see a year-over-year decline, especially when we are already running at more than 12% on software exports, even for the current fiscal year. So I'm saying that it's important for us to track this, but it's probably too early to think that it will be a precipitous drop of this kind, which can by itself take the BOP to negative. But your other point about how much can we get back on our exports, yes, especially with respect to the non-dollar currencies, our exchange rate has been tremendously favorable for exporters. So some of these markets we can go on and increase our market share for those exports, particularly Europe. But we have to also understand that there's a lot of fluidity around these FTAs right now. So to what extent that creates some bit of headwind for exporters in terms of uncertainty, that's also we have to see. Plus, we have to do our basic things right about more deregulation, more infrastructure development, etc., which will improve the productivity of our exports. Finally, that will be the thing which will make our exports grow and get a better global market share than what we have today.
Fair point. Rupee target?
Well, I think in the sort of best possible scenario where the BOP turns positive in FY27, we think that rupee should revert to its earlier pattern of tracking the inflation differential. And that way, maybe a 2% depreciation is more reasonable to assume rather than the 5-6% depreciation annually that we have seen last year. I think that is probably where our baseline view would be.
In that case, you would be very close to what Dheeraj is saying of 93. There are some 94 also. But, you know, of all the reforms that you said, the one big reform which we have completely ignored is we don't have cutting-edge technology. I mean, China replied with a DeepSeek in weeks of the US AI challenge. That's where we have been seriously let down by our leading educational institutions. And finally, one thought to just wrap up everything we said. The GDP series have been revised, say, because our nature of consumption and production has changed. Looks like the next GDP series will have to be revised in 2 years. The way in which it looks like AI may challenge the fundamentals of how we produce and how we consume. I hope it is not that dramatic. Dheeraj,
but on a lighter note, Lata, but on a lighter note, AI will make GDP estimation also easier. So that way we can actually do a GDP revision in 2 years' time without too much trouble.
You know, if it is going to do that based on existing data, it may be hallucinating more. I mean, that throws up many questions. I take your point. Things may be much faster. We won't have so much of a lead and lag in getting the GDP number. Thank you very much, Dheeraj and Samiran. Let's hope we can touch base after the GDP numbers come out. We have to wrap up on Bazaar. On that note, Chartbusters coming up.
We start to trade on Dalal Street. Nifty opened sharply lower, breaching 25,300 briefly, even as IT extends rebound. Broader markets weak in tandem with large caps, broad-based selling across sectors. FMCG, autos lead decline.
4% equity changes hands in Vishal Mega Mart via block deal. The seller is likely to be Kedara Capital-led Samayat Services. It's also upsized its offer from 3,500 crores to around 7,500 crores.
Bihar introduces a microfinance lending bill more stringent than the Karnataka ordinance aimed at increasing oversight. Ujjivan Finance, Utkarsh SFB, Credit Access Grameen all slump. L&T Finance tells CNBC TV18 they don't foresee significant impact from the move, even with a 17% exposure.
Kotak Institutional Equities initiates a sell call on GAIL. Kotak cautions projecting a 14% downside, citing multiple areas of concern. The company lowering their marketing PBT guidance to around 3,500 crores over FY27 and elevated capital expenditure, to name a few.
You're watching us here on Chartbusters. We come to you live from the CNBC TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Nigel D'Souza. It's turning out to be a freaky Friday for the markets, with the Nifty actually just hovering around the 200-day moving average, briefly breached that for a bit as well, below that 25,300 mark. The Nifty Bank lower by about 2/3% as well, and portfolios not feeling particularly good because we have two stocks declining for every stock that's advancing, Nigel.
Well, that's right, Mangalam. And I'll just go across the wall and, in fact, do a quick check in terms of, all the action that we're seeing. So let's get the key indices first up for you on the screen. You have the Nifty that, as Mangalam mentioned, that's under pressure. The Nifty Bank, that's the culprit today. But the point is that the last three trading sessions, we've gone to 60,800 and we're bounced off that mark. So as of now, we're hovering in that vicinity. The bulls will want us to come in there and bat for the bulls yet again. But the one that's seeing a relief rally is the tech index. From the recent low, it's up close to 1,000 points. So the index itself is down 20% just in the last 1 month or so. The problem is the broader markets. There's a lot of selling out there in individual stocks, and the advanced decline ratio is favoring the number of stocks declining. Close to 2 stocks are declining for every 1 stock that's advancing. From the Nifty pack, the top losers are from different sectors. So you have Ultratech that's losing out, Nestle as well as seeing some selling pressure, and Shriram Finance as well, all of them down between 1.7 to around 2.1%. There are a few gainers though, and most of those gainers are stocks that actually have got hit in the last few trading sessions, and they're pulling back. Case in point being in Eternal. The stock's been getting hammered actually on rather large volumes. That's pulled back a little bit, 1.5% higher. And the tech names, they are seeing some kind of a bounce. Remember, the trend continues to remain under pressure. But otherwise, from those oversold levels, there is a bounce that's expected, and that's precisely what's happening. But in the broader markets, individual stocks, though, they're doing well. Some of those stocks have seen a sharp correction, but they're pulling back a goodish bit. Tejas Networks, in a matter of 2 trading sessions, that's up more than 20%. Remember, the stock is a third of what it was at its peak. Reddington is moving up on very, very strong volumes. That stock is up close to around 10%. And Polyplex as well as Praj Industries, both of them are up between 5 to around 7%. But a few names in the broader markets are under pressure. That MFI scare is there with what's going on in Bihar. And that's why Fusion Microfinance, the stock is down close to around 8%. Vishal Mega Mart, large trade being seen out there, so that stock's down close to around 7%. And otherwise, a couple of other names as well are seeing some selling. Go Fashion is down close to 5%. And Renaissance Global, after the kind of run that we have seen in the last few trading sessions, that stock's under some pressure. Remember, yesterday as well, it moved high on very large volumes, but delivery was lacking on that front. So, Mangalam, mixed trends coming in as of now. The bulls will hope that the Friday doesn't get freakier from here on. And at least as we speak, we're closer to around the 200 DMA. But good news on the cricketing front. And our boys are on set, I think so. Yesterday's form was good. And hopefully when we come back on Monday, we'll be cheering the boys.
We do that on Monday as well. But Nigel, I take your point on any sort of recovery from current levels, because if it has to happen, it has to happen from current levels itself. The Nifty Bank at an important support zone. The IT index is up around 0.8%, closer to 0.9%. And just moments ago, if you look at Reliance as well, while the stock is still in the red, it has recovered a significant amount from the lows. And in fact, it may just move into the green if it continues its trajectory at the momentum that it has shown so far. So if IT index and Reliance continue to do well, then maybe the downside for the frontline index would be limited. We'll watch out for that. And for the Nifty Bank, around the 60,750 to 60,800, an important support zone as well. Good time to welcome Dharmesh Shah of ICICI Securities for a quick technical check on the market. Dharmesh, it's been a painful sell-off over the last few trading sessions, there was consolidation, then grind lower. Today, it went below that 25,300 mark as well after seeing some sort of recovery from there. Chartically, today's decline and then subsequent minor recovery, do you think it is in the process of some sort of bottom formation, or do we see further lower levels from here?
Good morning, Mangalam. Yes, absolutely. I think so. If you look at the market behavior for last 3 weeks, we have still been consolidating in this range of 25,200 to 26,300. We believe, I think, so the way the things are formation on the charts, it looks like if you look for the 3-week structurally formation of the Nifty, it's something the formation of falling channel formation where the stock trading Nifty has been trading in this range of 25,200 to 26,000. We believe the way the market breadth is improving, if you look at the market breadth of total CNX 500, and the percentage of stocks trading above the 50-day moving average, it looks to be improving from 20% from the starting of February to currently at 50%. Also, to talk for the advanced decline ratio, I think so in today's trading session, 290 stocks of total CNX 500 are up. So we believe, I think so, things are not so bad. Yes, the move which we've seen in last 2 weeks or post the US trade deal has been too sharp, and market has been looking at a slower pace of a retracement, which too indicating a very healthy consolidation going forward. We expect market to see a bottoming out formation in this range of 25,200 to 25,000, and eventually I think so month of March should be much better compared to Feb. So yeah, buy the dip should be the strategy with strong support placed at 25,000.
Got it, Dharmesh. You're saying buy the dips and hopeful for a better March. Got that. Give us a couple of your trading ideas then.
As Nigel, as we are moving towards the summer, I think so the seasonality plays, and I think so thanda, cool, I think so AC is something the one which should be back in action. So AC stocks looks more promising from the current levels, and Voltas remains to be our topic. And if you look from the as per the media sources, the company expect a very strong set of growth in the home ACs, and I think so the way the 25% projection of increase in sales is expected in the coming quarter, it looks like overall I think so the way the early onsets of heat demand looks to be in not even in Bombay but across the states, it looks like AC stocks should be back in action. Where Voltas, again, the way the things are formation on the monthly chart, 12 month of consolidation breakout seems to be witnessing for Voltas. So we remain to be positive for the Voltas with a strong breakout happening above 1530. Looks for a target from 1648, keeping a stop loss of around 1459. So apart from Voltas, again, defense space as a whole looks positive from the current levels, where Bharat Electronics remains to be our topic. Now, BEL, again, if you look at the index level of Nifty Defense, is still 16% away from their lifetime high. The stock seems to be trading at near the life high. So it looks to be a relatively outperformer from the BEL perspective. Apart from that, the stock has been trading above the 20-week EMA in this current correcting phase. So we believe, I think, so the formation of higher top, higher bottom formation augurs well for BEL. Looks for a target from 484, keeping a stop loss of 415. So Voltas and Bharat Electronics remains to be our top pick.
I will keep an eye out on both those two. Dharmesh, thanks a lot for joining in, and wishing you a good remainder of the trading session. Let's shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Anant Chaudhary of moneycontrol.com joins us to talk about a stock that he's tracking rather closely. Anant?
So PVC pipe manufacturers are back in the limelight after the domestic PVC resin prices increased by about 8 rupees a kg in December, followed by a multi-year low seen earlier in 2025. The price recovery has been driven by China removing export rebates, lower import inflows, and some ongoing industry consolidation. This trend is clearly positive for domestic players like Prince Pipes, which is among the largest PVC pipe manufacturer in India with around 5% market share. So the benefits comes on 3 fronts. First, better volume growth as dealers typically stock up when they anticipate further price hikes. Second, improved realization since higher PVC prices are generally passed on to the customers. And third, margin expansion supported by inventory gains during a rising price cycle. So overall, we believe all 3 levers, volumes, realization and margins are well aligned for the company to deliver strong growth in the coming quarters. Management has guided for double-digit volume growth in Q4 FY26, and that momentum is expected to continue in FY27, with the margins rebounding to around 10 to 12%, excluding the bathware segment. At 17 times on FY28 earnings, the stock appears reasonably valued.
All right, thanks a lot for that. With that, we'll take a short break, come back, focus on the markets. A lot of stock-specific action on the other side. The Nifty now still, above that 25,300 mark, but below the highs that we saw just moments ago. So at higher levels, there is some selling which is coming back, and that's coming on the Nifty Bank, which is below that 60,800 mark, now closer to 60,750. We'll focus on the indices, individual stocks. Stay with us.
Welcome back. You're watching Chartbusters. You're on CNBC TV 18. Well, let's focus on MFI stocks. They have slumped after Bihar introduced a microfinance lending bill, which as per IFL Capital is more stringent than that was introduced by Karnataka. Ria joins us to break that down. Ria?
Well, yes, Nigel, IIFL has come out with a note on NBFCs post this announcement. Now, they have highlighted that the Bihar government has introduced a bill regulating MFIs and small lenders that is on similar or more stringent lines than the 2025 Karnataka ordinance, like the loan waiver, prohibition of coercive recoveries, capping of interest rate and loans. They have also talked about the fact that RBI regulated entities are exempt from this bill, like in the case of Karnataka, but not from provisions relating to the prohibition prohibition of coercive recovery methods, borrower protection measures, and fair recovery practices. Now, Bihar constitutes roughly 15% of the MFI industry, which is the largest, with its share rising by around 110 basis points in the last 2 years. And this is despite Bihar's MFI portfolio declining by an 8% CAGR in the last 2 years as well. Now, in terms of NBFCs, small finance banks and banks, they have between 5 to 45% of MFI and MSME exposure in Bihar that is at risk of sharp rise in delinquencies as per IIFL, and they remain structurally cautious on lenders with high MFI exposure. Now, if you take a look at the exposure of Bihar in percentage terms of the MFI AUM, for Utkarsh Small Finance Bank, it is the highest at 45%. L&T Finance and Fusion MFI are at roughly 17% each. Ujjivan Small Finance Bank is at around 11%, and Credit Access Grameen has the lowest exposure at 4.6%. In terms of the stock moves today, all of these stocks are taking a hit in the intraday's trading session. Ujjivan Small Finance as well as Utkarsh Small Finance Bank are down roughly 2 to 3% each. L&T Finance also down around 3.5%, as well as Credit Access Grameen down by around 4%, with Fusion Finance taking the biggest hit, down around 8.5% today.
Right, we take that point, Ria. Thanks a lot for explaining that to us. In fact, we also had IIFL Capital's Viral Shah, who joined us to tell us about the impact of this bill on microfinance institutions earlier today. Let's hear him out. And thereafter, we'll also listen into what Sudipta Roy of L&T Finance said to us. He did say that Bihar is a reasonable part of their portfolio. It's about 17% of their share in MFI, but they don't anticipate a big dent for them on account of these norms. So listen into what Viral Shah says, and thereafter, L&T Finance.
So the pure play MFIs like your Fusion, Spandanas of the world, they do stand to be negatively impacted. You have SFBs like Utkarsh, you have even Ujjivan who have higher exposure in those geographies. So they also stand to be negatively impacted. Even L&T Finance has 20% of its MFI portfolio there. Basically, the recovery that we all were anticipating in MFI, because of this kind of gets pushed back by a couple of quarters.
Bihar is a reasonable part of our portfolio, but obviously we are spread all across the country. It's about 17% of our portfolio. If you see our collection efficiency, for example, our collection efficiency this month, we're just 1 day away from the close of the month, we are upwards of 99.7. So overall, I do not expect a major impact on L&T Finance's go-forward strategy as well as our collection efficiency in Bihar. But the fact is that we'll have to study the statute in greater detail together with our and await guidance from the MFIN, our SRO, and then take our according steps. I do not expect any major impact on L&T Finance.
KYC registration agencies of NSDL as well as CDSL have revised their charges. Sudarshan is here with all of those details. Sudarshan?
So we have two major securities depository companies in India, and those are NSDL and CDSL, and they have KYC registration agency. For NSDL, it's NDML, and for CDSL, it's CVL. So recently, both these companies have gone ahead and revised or say rationalized tariff charges. Remember, if you either download the KYC data or you upload the KYC data or you go for the new registration, for everything there is a charge. But the maximum thing that is being done is the downloading of KYC, and that is also called fetch. Now, earlier charge was rupees 35 for every download. Now that has been reduced to 28 rupees. So that is the reduction of almost 20%. So what will it lead to? It will lead to an impact on the revenue and the EBITDA. So we have the listed company CDSL. As per the analyst, on the revenue, the impact can be seen in the range of 4 to 5%, and on the EBITDA front, impact can be seen in the range of 5 to 7%. But we'll have to see if that can be offset by volumes. But as far as the changes are concerned, these changes will be effective April 1.
Take that point, Sudarshan. Thanks a lot for that. As a result of which, those stocks lower as well. CDSL down about 1.8% on a potential hit of 5 to 6% on their EBITDA. Let's step into a short break, get you more on the markets. A lot of stock-specific action. Stay with us.
You want to talk business? Meet me in the Onboard Lounge.
Welcome back. Markets under pressure. The Nifty is down 180 points. The breadth of the market, 2 stocks declining for 1 stock that's advancing. A few stocks, though, are staging a bit of a comeback from the lows of the day. Reliance Industries is one such name. Jai Balaji is another stock from the broader markets I think we should pull up. That's building onto some gains as we speak. But as we kickstart this 2-day Rising Bharat Summit 2026, which is a global forum that reflects the confidence and capability driving India's rise. Let's quickly cut across to the panel, which hosts market veterans like Ramesh Samani, Madhu Kela, as well as Vijay Kedia.
The market point of view perhaps is going through a bit of a speed bump. How do you think market right now sits in a Rising Bharat context?
I thank you, Anuj. Thank you for inviting me to this beautiful hall and this beautiful discussion. Thank you so much. I think the last few weeks, the market has been dominated by AI concerns, and is that going to take away the love affair we've had with tech from becoming a leper? So let me just address that first. Contrary to popular opinion, Anuj, a lot of people believe that NSE started the computerization program in India. But actually, in the middle 80s, the BSE started the computerization program. What happened was that there was an election, and the people who wanted the computerization to go forward lost the election, and the jobbers and the old-time brokers gained power at that time, and the computerization was pushed aside. But the lesson in that story is that at that time, on a busy day on the Bombay Stock Exchange, you do 400 crores worth of turnover. Today, India does collectively about $14 billion worth of transactions in a single trading session, just in the cash market itself. The point is that the market opportunity expands as new technologies come into place, as computerization happens, but the old people get left behind. So my feeling is that there's nothing to fear really about AI. I think the market is at this point just throwing the baby out with the bathwater. I don't think there's... but there will be new winners and new losers, but as the Honorable Minister suggested, there's a multifold of opportunities coming up. And I'd just like to say what Charles Darwin said when he wrote the book of Evolution, The Origin of Species. He said it's not the strongest species that survives, it's not the most intelligent species that survives, it's the one that is the most adaptable to change. So if Indian tech industry adapts to change and don't ostracize, and there's some reason to believe that they are changing, I think the tech industry will come back bigger, stronger, more vital, as happened in so many industries before us, whether it's music or whether it's hotels. Digitization has been a huge power changer. So I think there is something to fear. It is a profound change. But I think the market is throwing the baby out of the bathwater. Having said that, other than the tech sector, whenever I go and visit companies or knock on doors, I see no reason to be bearish because people are expanding, people are optimistic, and people are happy.
Oh, absolutely. So let's discuss a bit more on that. Madhu, is the risk that these companies are now fighting for survival? This is a question of existence. Astitva ki ladai. Where do you stand on that? Because since Ramesh, started with that topic.
Anuj, first of all, thank you for having me. I deeply appreciate you remembering and calling. Anuj, I think, first of all, in a lighter way, all 8 billion people have a view on AI today. There is no one in the world who doesn't have a view on AI. And everyone, the pace at which these changes are happening, every week something new is coming. So we have to be very alert and really monitoring these changes in a very careful manner. The other thing, as Rameshji said, I would say not only one example of BSE, NSE, but if you look at the 50-year history of civilization, technology has never made societies poorer, right? But at the same time, there will be Apple, Nvidia of the world which will come up, and there will be Blackberries and Kodaks of the world also, which will shrink, even though they being such significant large companies. So there will be clear winners and losers in this game, even within the IT companies. People who can really adapt to this change. And the change is coming much, much faster than we can emphasize. Because see, AI is generating AI in itself, right? So the pace of change is very, very fast. So I'm sure there will be winners and losers. So you can't paint everyone with the same brush. However, the one, let's say, the short-term worry, in medium term it may get sorted out, is employment is a real issue. That, because of the pace of change, the training which is required to get to the new jobs might take time, while the disruptions may happen in the short term. So these are things that are very dynamic, Anuj, but I remain very optimistic in the medium to long term. We have a fantastic skilled labor force, and as the so many people who are much more knowledgeable who came in the AI summit, and the normal consensus was that India has the capability to become kind of the AI layer provider and the solution provider to the world, and that opportunity is gigantic.
Okay. Vijay sir, what do you think? ऐसा एक सेंस बन रही है एंथ्रोपिक जैसी कंपनी 2700 एम्प्लॉइज और उसका मार्केट कैप, एंथ्रोपिक जैसी कंपनी 2700 एम्प्लॉइज के मार्केट कैप के साथ आज हमारे पूरे आईटी सेक्टर से ज्यादा मार्केट कैप है उसका. इट्स लाइक इट वाज आई ओपनर फॉर मी आल्सो. व्हाट्स योर व्यू? आईटी में एंथ्रोपिक 2700 कंपनीज के 2700 एम्प्लॉइज के साथ आज मार्केट कैप इंडियन आईटी, पूरी इंडियन आईटी से ज्यादा. तो इज इट सम काइंड ऑफ वार्निंग साइन फॉर अस?
No, I definitely seen that what you are referring to Anthropic and all. Yeah. So what I read somewhere that they are having 2,700 or 800 employees.
Yes.
And the market cap of this company is the, combined all the IT company in the world.
Yes, yes.
More than that.
Yes.
So of course it is a wake-up call for India. There is no doubt about it. If you will shut your eyes, that means you are still sleeping, So this is certainly a wake-up call, and I think that obviously we should also do. Manoj, there is it is like a catch-22 situation. I read somewhere, like if you are not investing in AI and all, then chances are that if you are investing, suppose blindly in AI and all, chances are that you will lose your capital. At the same time, if you do not invest in AI and all, chances are that you will lose your company. Then you have to decide whether you are happy with losing your capital or you are happy losing your company. So this is certainly a wake-up call for India and for the entire world, and mainly for India. But I personally feel that ultimately we will rise to the occasion. I think we will also find our own way and to deal with this situation.
Okay,
let me just add one point to what he said. Sure. The interesting stat I found yesterday was we all talking about Anthropic and how it's dominating the world of computing now. Yeah. But what does Anthropic use for its CRM system? It uses Salesforce, which is an old enterprise-level software company. So they will coexist. I think both these AI will be used to make enterprise software much better. I think AI software, because of the scalability, auditability, and importance, will not be taken over. You're not going to get a 20-year-old kid to wipe code an enterprise system. And the fact that Anthropic itself uses Salesforce probably tells you that.
Yeah, overnight Jack Dorsey's company sacked about 40% people. So there's a bit of a risk that are we looking at some kind of jobless growth going forward? So
I think it's just headline news. I don't think that's going to happen.
Okay. Ramesh, you've seen many cycles, right? 2003, 2007, then we had the post-COVID bull market. Post-COVID bull market is when retail investors really came into the market. And this is something that you always envisage, that, you want to see a bull market where retail participates. That happened. But when I walked in this room, a lot of people were disappointed, despondent, because, they have not made money in last 2 years. The market's been very tiring. And the Nifty might be at 26,000, but people's portfolio here might be at 22,000 if they're lucky, and some people's portfolio may be around 18,000. What's your message in that case?
Yeah, Anuj, first of all, the idea that in the equity markets you get linear returns, like 15% a year, go into fixed deposits if you want to do that. The returns are by definition lumpy. They will never be linear out there. So you'll have 4 good years and maybe 3 bad years. That's part of the game. But what is the CAGR over 7 years? You have to look at it from that perspective. Secondly, I believe there's some rotation going on in the market, that we're moving from the favorites of the market to other sectors. So I think sectors that are still performing well are defense, perhaps, materials and mining, all the physical goods that are being manufactured. Because the two trends that are very obvious to me, that all countries want to localize the defense. We can't rely on a rules-based America hegemony defining the world. So whether it's Europe, whether it's Japan, whether it's Asia, or whether it's America, each one will promote their own defense industry, and B, everyone will promote their own local manufacturing. So local mining, metals, local sourcing of supply will do good. So I think they're disheartened because perhaps they're looking at some wrong stocks, and we start looking at metals, pharmaceuticals, defense, you're probably seeing some appreciation.
Oh, absolutely.
You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me, Hormaz Fatakia. It's turning out to be a freaky Friday for the markets. The Nifty down 160 points. The broader markets a lot more. Nifty is actually led lower by a lot of the frontline sectoral indices, be it, the Nifty Bank, which is down about 0.75%. We have the IT index, the FMCG index, and the auto index. The IT index actually is the only one which is holding mildly in the green right now. So over the last few trading sessions, we've seen some respite coming in on the IT pack, and that's supporting the Nifty, which is ensuring that it's not breaking the 25,300 mark after breaching it once. But all the other sectoral indices are taking it lower, and that means that we're below the 200-day moving average as well. Nothing particularly good in the broader markets either. Two stocks declining for every one stock which is advancing, Hormaz.
Yes, indeed. And that's the kind of week that we have had, right? Every time we see some kind of recovery, the recovery gets sold into. But today, at least for the first couple of hours, the one important level that the Nifty was defending for the better part of this week, it has failed to do so. That is 25,400. And now it has moved below its 200-day moving average as well. Of course, it is still hovering around those 200-day moving average levels. But it remains to be seen whether it can claw its way back in the second half of the trading session to at least hold off above the levels of 25,400 as it has done so for a better part of this week. Just a couple of stocks before we try reviewing the month gone by. Of course, Vishal Megamart down 7%. That's been the one underperformer, of course, after the block deal. But the MFI names are the ones that are taking it on the chin today. Credit Access Grameen is down 6, Fusion Finance is down 10, and the others being Utkarsh Small Finance Bank and the others, L&T Finance, all of them after the new draft laws in Bihar. That is why all of these names taking a hit. Utkarsh now down 4.5%. Fusion Finance, Utkarsh, all of them trading significantly below their IPO price as well. But the month gone by, as volatile as it has been, the Nifty has gone nowhere all through this month. The index had closed at 25,320 on the 30th of January, which was the day before the union budget, and it is still at those levels as we speak. So the returns have been zero, but it has had a very broad range of over 1,000 points. It made that 26,341 high as well after the trade deal was announced the next day, that 1,200 point gap up. But all of that has just fizzled out as the month has gone by. The best performing stock this time around on the Nifty this month is Power Grid. And for a stock that is not known for moving much, the 18% return that the stock has had has turned out to be the best month it has had since 2009. The other movers as well, like Max Healthcare, Eicher Motors, all of them have seen a decent double-digit return. But on the downside, no prizes for guessing here. The top 5 losers are IT names. And Tech Mahindra is the top loser on the Nifty this month. Infosys is having its worst month since April of 2013. HCL Tech is down 18%. The 18% is the worst month since March of 2020. If the stock falls any further, this will turn out to be the worst month since July of 2008 for HCL Tech. Now, TCS and Wipro, both of them down 15% each. The top 5 losers on the Nifty for this month are unsurprisingly IT stocks. So you take a look at the broader universe, the Nifty 500, and you see the returns there. The stock-specific activity, there are certain select pockets that have done very well. Amber Enterprises, look at this, 39%, Apar Industries 37%, Hitachi Energy 35%, Bharat Forge 32%, and all of them have had the best month in a fairly long period of time. In fact, for Bharat Forge, it is turning out to be the best month since 2009. So that's the kind of returns that you have seen in the broader markets. But on the flip side, here too there are no prizes for guessing. If large cap IT is the top loser on the Nifty, mid cap IT is the top loser on the Nifty 500. And First Source, Hexaware is now significantly below its IPO price. Coforge, one of the best performers in mid-cap IT, all of them at least seeing their worst month since the COVID month of March 2020. Hexaware, of course, listed just last year, so it's the worst month it has had since listing. And First Source too, 33% lower, turning out to be the worst month that the stock has had since 2008.
Well, those are some important data points that you've brought about, Hormaz, and when stocks fall from the top, the kind of recovery that they need to make from the bottom to go up is a lot more. That's how percentages work. So if a stock which has fallen 50% from the top, for one to actually make good their money on that, the stock has to actually double from those levels itself and not just a 50% rise. Well, important data points up for you on the perspective here. with regards to the market decline and individual stocks. What we'll do is take a short break. On the other side, we get Manisha Gupta to speak about the bond market and continue our coverage on the market as well.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
CNBC TV 18 and India Bonds presents Bond Street. Welcome to Bond Street. Our guest for the day today is Alok Patel. He's Joint Managing Director at Namara Finance. Alok, hi, thank you so much for joining in. For the viewers who are meeting Namara Finance for the first time, what is it that the company does and who are the customers that you serve?
So Namara Finance actually is part of the Arman Group, which is about 33 years old. Namara Finance is a subsidiary of Arman that specifically deals with microfinancing. So we are at least trying to serve the bottom of the pyramid, underserved customers in the, the credit ecosystem. And essentially we provide loans mainly to women to help their enterprise or start something new to help the households generate more income. So Namara itself is about 15 to 16 years old now. And we are located in about 11 states, 6 lakh customers, about 400 branches. So, yeah, that's...
Alok, when you underwrite a borrower, what are those top 3 things that you must be confident about before you're disbursing?
Yeah, so that's interesting. So we look at a lot of things, and we cannot treat these customers like a traditional bank would, right? So their paperwork is pretty light. If I was evaluating somebody else in urban areas, you would have salary slips and bank statements to make a decision. So the first thing that we typically look at is we try to get a good estimate around their cash flows and what occupation they have at a household level. So a lot of these households will have multiple sources of income. So we have on the street people that go and do that. So number one is that. The second thing we obviously look at is what is the household indebtedness, because there is a tendency for these customers to be over-levered, and you want to make sure that doesn't happen. They can afford the EMIs along with all the other leverages that they have. And, the third part is, a lot of not just quantitative but qualitative factors. How are they placed in their communities? What is their lifestyle like? What are they going to use the money for? Obviously, credit bureaus is part of it. We don't just concentrate on credit bureau scores alone, but that is part of it. And we try to look at their track record and their history and form the best decision that we can. But it's not like traditional banking at all. You have to really go down on your hands and knees and kind of evaluate these customers.
I'm assuming the repayments are frequent, the capital size, or rather the ticket size is smaller here. But your capital adequacy with all of this is very, very strong. So what's driving that? What is the right comfort level for capital for your business?
Yeah, so, I mean, as much as people don't like to admit it, this is a cyclical business. The customers we deal with are highly sensitive to things which are beyond their control, like COVID, for example, or macroeconomic issues, or weather, or whatever you want to say. And so, in an unsecured retail lending, capital is your first line of defense if something goes wrong, right? So, we try to keep our capital well above what is regulatory required, because that is what is required in our business. We have a lot of capital right now, so we are probably going to leverage that and grow the book.
Okay.
Give or take 3.5x is where we try to keep it. Of course, there's no magic number which is right or wrong. It depends on a lot of circumstances. But we try to keep our capital higher than what most people would tend to see,
So what exactly is your current funding mix, and how is it evolving given the circumstances globally and in India?
Yeah, so, when we first started, we were largely reliant on banks, right? And then NBFCs came in, and then there was a lot of off-balance sheet debt that was started being done, like direct assignment, securitizations. We are doing a lot of retail lending at the moment, so NCDs, retail NCDs and things like that. And so I think it's important to have multiple sources of funds, multiple avenues for funding. Cash is our raw material. I mean, we always need it. And there's always some things going on, bank policies, regulatory changes, so it's important to make sure that you have multiple sources available at all time. So, banks remain a large portion of our book. Now NCDs has become a big portion. I mean, we did probably will do about 500 crores of NCD raises this year. But it's evolving, so it's always keeps us on our toes.
Talk to us about your recent NCD bond issuance. How was the investor response? One, your core objective, and the key takeaway for bond investors.
So, it was beyond my expectations overall. We were oversubscribed, a very good mix of institutional and retail investors. The objective is obviously twofold. As I said, we have, cash is our raw material and we require a diverse source of funding. Sure. Getting it at a reasonable pricing remains an objective as well for any company. And for the bond investors, I think they like the fact that we have a good vintage, very conservative lending, good underwriting, zero defaults in the last 33 years. So all that adds up, adding some level of credibility to the company, and that's great.
CNBC TV 18 and India Bonds presents Bond Street.
Hurtling back towards the 25,300 mark is the Nifty. But the other major important development in the aviation space was the fact that the DGCA has modified the ticket refund rules, allowing a 48-hour cancellation window. Madhya is now joining in with more details on this. Madhya.
So there are three things that come as a relief here for passengers. First, it gives them a 24 hours more to decide on the ticket that they've booked. So as per the new rules, passengers can now cancel or amend their tickets within 48 hours of booking without paying any additional charges. But it cannot be for travel in 3 or 4 days. For domestic flights, the departure date must be at least 7 days away from the booking date. And for international flights, the travel date must be at least 15 days away. And beyond the 48-hour window, regular cancellation charges that apply now will apply. The second move, airlines cannot levy any additional charge for correcting the name of the same passenger if the mistake is flagged within 24 hours of booking. This applies to tickets booked directly through airline websites. The third one, in case of refunds, some airlines would earlier give a credit shell in place of refunds, but now passengers will decide whether they want a credit shell or direct cash as refunds. The DGCA has also clarified that if tickets are booked via travel agents or portals, the responsibility of issuing refunds lies with the airline and not the agent. And refunds must be processed within 14 working days because we know there have been so many complaints against airlines for delayed refunds. The revised norms come, as I was saying, amid rising complaints over refund delays. And now we are trying to understand how these rules impact airlines' top line. No, not charging passengers for changes in tickets will definitely hit their ancillary revenue. We now need to study how much of a hit it will be.
All right, Madhya, thanks a lot for that. We need to understand what could the impact be. But, you know, the impact on the market is definitely visible when it comes to the F&O space. It's a big gash that we're seeing on the frontline indices, and a large part of that is actually a function of, the weakness that we're seeing in the Nifty Bank. So if you look at the Nifty Bank, it's down about 0.8%, a little closer to the percent. The Nifty itself has fallen below the 25,300 mark. And this despite the IT index not falling as much. So, you know, the large part of the decline has been led by the Nifty Auto, Nifty Bank, Nifty, FMCG names. All of them have seen a big cut. And Reliance itself is down by about 0.4%. So where does Reliance go from here, which is still not falling as much as the frontline index and the IT index? How do they perform in the second half will be extremely crucial to track, because below the 25,300 mark, there's a fair amount of selling that is likely. Nifty's fallen below the 200-day moving average as well, and the advanced decline tells you that the portfolios are in a bit of a disarray. Nearly 1,800 stocks, 1,850 stocks in the red for sub-1,000 stocks which are in the green. A large part of the decline also could be attributed to all those put writers who have been caught on the wrong side. So look at the 25,450 put. There is open interest coming down out there, which implies that those put writers have been caught on the wrong side and they are panicking, covering their positions. 25,500 put writers also are panicking and covering their positions. On the way up, there is a lot of supply which is expected, which is reflected in the kind of call writing that we're seeing. 25,400, 25,350. And as the Nifty stays below that 25,300 mark, we'll start to see call writing at 25,300 as well. So let's monitor that as we go. The only silver lining from here on is that, the put call ratio has moved towards that oversold zone of 0.7 versus 0.88. So at some point, there could be a bounce. Whether that bounce is sustainable or not, and whether that bounce will get these call writers out of action or not is something that we will be tracking. But as of now, things do not look particularly good for the frontline index. Fresh shots seen on L&T Finance, Angel One. A few long positions added on a couple of these oil and gas names. So we have Oil India, Petronet, LNG doing fairly well. Dixon Tech as well. But remember, Dixon Tech is a stock which has seen a big correction from the top. So the ones which are gaining are the ones which have actually seen a big cut, and the ones which are losing are, the ones which have been consistently losing right now. And the Nifty Bank definitely stands out because 60,800 thereabouts was an important support zone. Now it's fallen below that. It's closer to 60,655 thereabouts with a cut of almost 0.8%. And as the day progresses, let's see how flows pan out as well, because it's turning out to be bad. Because, if you look at the trend of the frontline index, both the Nifty Bank as well as the Nifty, at any point on this Friday, had you made a short position, you would have been making money. So that chart looks a little, more bear-friendly than bull-friendly.
It's a worrisome screen. We had mentioned those two support levels as Mangalam just highlighted, right? 25,400 on the Nifty, 6,800 on the Nifty Bank. It's below, both of them are below those levels now. 6,800 was one level that the Nifty Bank managed to defend for the last 3 days, actually all through this week. But today, for now at least, does not turn out to be that case. Take a short break. On the other side, continue our conversation on the markets with Dheeraj Sachdev, the CIO from Roha Ventures. Stay tuned.
Welcome back. This is Trading Hour. Dheeraj Sachdev, CIO from Roha Ventures, now joins in to discuss the fundamentals of the market, top sectoral picks. Dheeraj, it's been a painful last couple of weeks, if you must. You know, periodically there were positive news flows which were coming in, and those weeks the market did show some signs of resilience. But immediately after, we went back to our selling ways. And now as well, as we speak, the Nifty is at the low point of trade. We've seen a fair amount of consolidation in the broader markets. There have been a lot of stocks, as Hormaz had earlier pointed out as well, which are down 20, 30, some even 40%. What does one do in a situation like this? What is the best way to protect your capital? And if one has left some dry powder, where do you deploy it?
Hi, good morning, Mangalam. Obviously, we have seen a very decent time and price correction over the last 16, 17 months or so, and which is healthy because it has taken a major part of the valuation excesses. Now, the broader market valuation, as you rightly said, across mid and small caps the valuations have normalized or broadly, and majority of the froth is over because 16, 17 months of loss of patience and retail investors panicking, obviously, that also creates an opportunities in several pockets as far as bottom-up stock picking is concerned. Now, small caps or broader market has seen earnings recovery in the third quarter numbers, if you go by. And given that has been because of the favorable policy dynamics, whether it's lower interest rates, GST cuts, and the tax impact will obviously also play out going forward. Also going forward, the global markets like US, Europe have again opened up for Indian companies with competitive tariffs or trade deals. So time has come for small caps to start outperforming with better risk-reward equation. And it can actually start outperforming even the broader market like Nifty. Of course, one has to be selective as the universe of small cap companies is pretty large, and there are variations in the quality of business. So we believe that one can fully deploy selective ideas without compromising on the quality of business, and valuations have where the valuations are reasonable and earnings growth is going to sustain going forward because the market is very, very biased towards earnings growth. So as long as these companies are growing in sustainable fashion, then obviously these companies will get re-rated even in the small cap space. So yeah, opportunities exist across manufacturing as a contra theme, capital goods, banking, financial services, some selective consumption theme, asset management companies. So there are a host of variety of business in small caps to choose from.
So where exactly, so you just mentioned that, will you break it down for us a little more, Dheeraj, within the small cap space, where does your preference lie, particularly from the names that you just highlighted?
So almost we see opportunities in banking and financials. Obviously, when the most of the NPA problems or pain in the NPA quality is behind, even microfinance has started doing well. The risk control norms are in place. So there are many NBFCs, including banks, which are in the small cap category, where valuations reasonable. It could be a mix of both PSU and private banks. Asset management companies obviously offers operating leverage benefit if you are positive on the capital market with a stable SIP flow. And it's a fixed cost business, so the operating leverage plays out in the asset management companies. I think that is one area that we like. Autos, I think especially given the CV cycle, it is at the beginning of an upcycle. So several companies in the autos, which are in the ancillary space offering to CVs, whether it is Axles or other companies in the CV space, are looking interesting. And that will also play out in terms of earnings growth over time. Consumption names, whether it is jewelry, digital music, value fashion, retail, alcohol, beverages, are where we are witnessing growth and reasonable valuations, and both are coexisting at this point of time. Manufacturing is a very long-term theme where we believe that the time has come for India's manufacturing to play out across a number of sectors, and of course with global competitive tariffs as well. So the capital goods companies or manufacturing companies where the capex is done and the earnings growth will play out over time are also selective opportunities in the small cap space.
Right. You know, what are the places which you believe are still in a void, despite the correction and despite the valuation correction?
So, Mangal, there are always points of time where part of the market becomes expensive. We've seen that happening in the past where sector or mini bubbles get created, whether it is, EMS themes or defense themes or healthcare, hospital stocks. At this point of time, while they are very long-term good business opportunities, whether it's EMS, defense, or healthcare, hospital, but the valuations are far ahead of time, and that is where we are avoiding at this point of time these themes. So these sector bubbles are one has to be careful about. We have seen that happening again in the earlier period, where defense or railways were the themes which went ahead of time, and in the last 2 years nothing has happened because the earnings are yet to catch up. So these are some of the selective spaces we avoid. We also avoid majority of IPOs which get too pricey or expensive from time to time, thanks to the investment banking community, where they price to perfection and they're more on the side of the managements than the investors. And a lot of these valuations don't go ahead of time. So a majority of, if not all IPOs which are very pricey, are also avoids from our perspective.
Dheeraj, thank you so much for sparing time and joining us. Short but insightful conversation today. Looking forward to having you more often on the show. Take a short break. More on the markets on the other side. Stay tuned. Well, the Nifty Bank made an intraday low of 66.33. It is looking to stage a bit of a rebound from those levels. It's still 70 points off the intraday low. Of course, still below that 60,800 mark. That is going to be the most important level to watch as we go into the second half of the trading session. But that does not take away from the fact that there are plenty of gainers in the broader markets today. Redington is now up 13.5%, is the second best performer on the Nifty 500 as we speak, following Tejas Networks, which is also up a similar quantum. So Redington is one stock that is doing well in the broader markets, even as the benchmark indices are struggling. And the other one that is doing well is Sarda Energy. There you can see Redington at the highest point of the day. Sarda Energy is up 8% as well. Phenolics Cables is doing well for itself. That's up 6%. So there are pockets of green in the broader markets. But the one stock that has moved to the lows of the day is Tata Communications. Now that stock is down 4%, is among the top losers on the Nifty 500. What has also moved to the lows of the day is JK Tyre. That's down 4% as well. And Karur Vysya Bank, the smaller banks that were outperformers at the start of the week, they are now down to the lows of the day. JK Tyre down 4, Karur Vysya Bank also down 4% as well. All of them at the lowest point of the day. Also hurtling back towards its IPO price is Sagility. The stock was down around 5% in yesterday's session. No respite today, still down another 4%. So 38 now on Sagility, the IPO price being 30 rupees for the stock. Take a short break, back with more on the other side.
Welcome back. The stocks that are under pressure today, among all the others, are the microfinance institutions, specifically the ones which have large exposure to Bihar. Say something like an Utkarsh SFB, L&T Finance 17%, Fusion MFI down 17% in terms of exposure to Bihar. And then you have Ujjivan and Credit Access Grameen as well. This as the Bihar government has introduced a bill regulating MFIs and small lenders that is on a similar or rather more stringent lines than the 2025 Karnataka ordinance that came in, the likes of loan waiver, prohibition of coercive recoveries, and capping of interest rates and loans. So as a result of which, we did speak to a whole host of experts. The analyst from IIFL joined us today as well to give his view, and we also had a management conversation coming in from L&T Finance, another stock which is down 4% on account of its 17% exposure to Bihar. Let's hear out what they say.
Unfortunately, the impact of this is that you have the regulated entities also that gets impacted, because on the ground level, it becomes difficult to make the distinction. There will be growth that will slow down. That will also be an asset quality challenge that will come through, because there are certain provisions basically restricting the lending beyond 2 lenders, etc. The extent of impact is going to be predominantly more high for northern focused MFI lenders, and probably it will be then gradually lower for others.
Bihar is a reasonable part of our portfolio, but obviously we are spread all across the country. It's about 17% of our portfolio. If you see our collection efficiency, for example, our collection efficiency this month, we're just 1 day away from the close of the month, we are upwards of 99.7. So overall, I do not expect a major impact on L&T Finance's go-forward strategy as well as our collection efficiency in Bihar. But the fact is that we'll have to study the statute in greater detail together with our and await guidance from the MFIN, our SRO, and then take our according steps. I do not expect any major impact on L&T Finance.
Time to take your leave on this edition of Trading Hour. Still no respite for the markets whatsoever. The Nifty now fighting to hold 25,300 on the downside. From Mangalam and me, thank you for watching. Halftime report on the other side.
Growing uncertainty about the future takes a toll on stocks, with realty, financials, FMCG behind the big drag. IT, utilities buck the trend.
Vishal Mega Mart sees a near 14% of its equity change hands in a large trade worth around 7,900 crore rupees. Private investor and promoter Kedara Capital is believed to be the likely seller.
Stocks of microlenders slip after Bihar's new microlender rules curb some recovery methods of even the RBI regulated entities. Analysts fear a rise in portfolio risks as seen after the less stringent Karnataka rules kicked in.
The Director General of Civil Aviation has introduced free booking cancellation within 48 hours for domestic travel if 7 days ahead and if 15 days ahead for international travel. The refunds will be processed in 14 days.
Twitter co-founder Jack Dorsey's block is laying off 4,000 out of its near 10,000 workforce to pivot towards an AI future. He says the realization isn't early, rather most companies are late. The block stock fires up and the world gets a loud message.
Well, hello and welcome to Halftime Report. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel and with me is Rima, and we're on today at 12 noon. Hey, Rima.
Hi, it's a tough Friday, right? A little unexpected from, it just looked like it would be another session of consolidation. But today we've reached the range that we've been holding on to. The Nifty went below 25,300, managed to climb above that level, but the low today is 25,270, and that's a break below the 200-day moving average, a level that we've been holding on to for some time now. But we're managing to climb above the day's lows. But let's talk about individual stocks, sectors moving around. Nigel has walked over to the big wall.
Well, that's right, Rima. Let's take, stock of what's going on in today's trading session. First, the Nifty. The Nifty is under pressure because the Nifty Bank actually is out of form today. It's holding on to that 60,700 odd mark, but it's, not rebounding from there. It'll have to rebound from there because the Nifty IT index has actually been seeing some kind of selling pressure. That's rebounded close to 900 points from the recent low. So that's good news. The big moving factor actually is going to be Reliance Industries. That's corrected in the last few days. But if you just take a look at the intraday chart, that's the reason why we've recovered close to around 40 points in today's trading session, because Reliance Industries has come in there and it's fighting for the bulls. Nifty winners include stocks that have actually got hit. So either you look at Eternal, you look at Infosys, or even HCL Tech, all those stocks are doing pretty well. The problem is that Interglobe, Bharti Airtel, as well as Grasim, all those three stocks, they continue to remain under some pressure in trade today. But from the broader markets, actually, there's plenty of action. Supreme Petro, the numbers have been very, very disappointing. But in Q4, it could potentially look better. And, if you're looking at the advance decline ratio, you have close to around 2 stocks that are declining for every 1 stock that's advancing. But the point that I was making, in the broader markets, there are a few winners, few losers as well. So Supreme Petro is a stock. I think it's up close to around 15% in the month of February itself. That's moving up even in today's trading session, up close to around 5%. Numbers have been disappointing, but the street is optimistic that things turn around. Sarda Energy, that stock is in focus in today's trading session because there is a Supreme Court verdict that's gone in their favor. We'll try to get you further clarity on that stock. That's why that stock is holding with a gain of close to around 6%. For Seco India as well, the stock is up close to around 10%, moving on very large volumes, as is the case with Finolex Cables as well. Stock up close to around 7%. But there are a few losers in trade. Sagility, the stock has lost its way actually. Today as well, it's falling on rather large volumes, down close to around 4%. D-Development, a stock that's up more than 15% in the recent past from the recent lows. That stock, in fact, is down 3%. And Fusion Micro as well as Fino Payments Bank, both of them under pressure, are down between 7 to around 10% in trade today. So net markets under pressure, individual stocks doing a thing of their own. And the advanced decline ratio, well, that's in favor now of the number of stocks declining. But Reliance Industries, that's the one that's put its hand up in the last 30 minutes, fighting for the bulls. We'll have to do more work from here on.
Well, indeed, and some more. Tejas Networks higher for the second day in a row. Today surging 14%. Volumes yesterday were large. Today also. Reddington is another one, up 13%. Very large volumes, good price action. NetWeb is moving up. A couple of these sugar companies, Sri Renuka, Bajaj Hindustan, come in for buying. But one stock, it's been weak from start go, and that's Vishal Mega Mart, slipping post the block deal. Mangalam joins it with more. Mangalam, we've been talking about it. I remember asking the promoter as well, the management, when they joined the channel, post the numbers about this block deal promoters selling out.
Well, you know, this has been a conversation which has been going on for a while, and that's largely because that's the nature of PE-owned businesses. At various points in time, there are supply events that come by. And Vishal Mega Mart itself, if you notice, you know, well, the underlying business has been fairly strong. The reported numbers have been good as well. And that explains why the stock too is higher above its issue price of around 78 rupees as well. There have been periodic bursts of selling coming in from the promoter. The last one was in June, where they sold about 20% stake. And the most recent one was as early as this morning, where we saw 14% stake, change hands on the exchanges. Remember yesterday when the term sheet was floated in the market, it was a 3,500 crore rupee block deal, which was then later, in lieu of higher demand, upsized to over 7,500 crore. And that exactly has happened. The reason why the stock is lower is because the price at which the trade took place was at a near 7 to 8% discount to yesterday's close, while the floor price was around 115 rupees, which was a 10% discount to yesterday's close on the stock as well. The promoters, as of December, held about 54% stake in the company. So assuming that the entire 14% stake was sold by Kedara Capital itself, it seems like, their stake will now reduce to about 40%. Further liquidity events are something that we will be tracking, and more importantly, as the market closes today, this evening, a confirmation of the participants of this large trade, which the street by now has understood is the promoter, will be awaited as well.
Okay, all right. Thanks a lot for that, Mangalam. Well, auto companies, they'll be releasing their wholesale numbers for the month of February next week. Sudarshan is with us to tell us what to expect in terms of those numbers. Sudarshan?
Come Monday, we'll have the auto wholesales for the month of February 2026. And like the indication we got from the retail data, we are expecting a strong set of numbers on the wholesales front also. And CVs and tractors will continue to perform. But we'll have to take a look if there is any impact from the commodity price rise that we have seen in the last few months. As far as the expectation is concerned, PV is seen growing by 12%. Two-wheelers may see a growth of 33%. M&HCV is likely to see a growth of 28%, and tractors may increase by 29%. Now, talking about the company-wise, Bajaj Auto sales may increase by 29%. Similar growth can be seen for Hero Motor, where growth can be of 34%. TVS Motor can see a growth of 26%, and even Royal Enfield can report a growth in the range of 13 to 14%. In the four-wheeler space, especially talking about the passenger vehicles, Maruti Suzuki can see a growth of 10%, Hyundai 12%, M&M Auto 17%, and the outperformer will be Tata Motors passenger vehicle. So the same indication we had got from the retail data also, and Tata Motors PV can see a growth up to 37 or 38%. In the commercial vehicle space, Tata Motors commercial vehicle can see a growth of 28%. Ashok Leyland can report a growth in the range of 23 to 24%, and in the tractor space, Mahindra & Mahindra tractor can see a growth of 29 or say 30% for February 2026. So like retail data, February auto wholesales can also be like very strong, and auto companies remain on a strong footing.
Thank you very much for that. More stocks which are in the news buzzing around. Upasana joins in.
Well, first up, let us look at some of the key gainers in today's trading session. First up is Tejas Networks. The company is seeing strong gains in the second straight trading session. Mind you that the stock was up 16% yesterday. Next up is Praj Industries, one of the key volume buzzers. The volumes are 5 times higher than the weekly average. NetWeb Technologies is the third stock on our radar. The company has announced that the company and Vertiv to deliver rack solutions for AI data centers in India. And coming to SpiceJet now, it gains after a big block trades in which Autumn sold its stake, and a slice of the shares are pledged by the promoters is what we know. Now, on the flip side, let us look at some of the key losers in today's trading session. Vishal Mega Mart continues to remain in focus as there is 14.2% equity change in hands via block deals. And next up is the NBFCs with a higher exposure in Bihar, MFI exposure. This is because the Bihar government has introduced a bill regulating MFIs on more stringent lines than 2025 KA ordinance. And lastly, coming to Greenply, Nuvama has given a buy rating but has cut the target price from 412 rupees
to 328 rupees per share. So all in all these stocks are the key buzzers.
Okay, all right. Thanks a lot for that, Upasna. Well, time to slip into a short break. Up next, we'll be connecting with Sheshadri Sen, the head of research and strategist at MK Global Financial, as AI disruption fears continue. Stay tuned.
You want to talk business? Meet me in the on-board lounge.
Well, time for our news segment, and in this one, we get you all that's happened in the world of technology and artificial intelligence overnight. Rachna is joining us to give us a complete roundup. Rachna?
Well, the artificial intelligence story now is not just about faster models or bigger funding rounds. It's about power, pressure, and the very real changes AI is already forcing across boardrooms and workforces. Start with Anthropic. The maker of Claude is in the middle of a visible policy standoff with the US defense establishment. CEO Dario Amodei has publicly drawn two firm red lines for the company's Claude models. First, no large-scale AI surveillance for Americans. And second, no fully autonomous weapons without meaningful human oversight. Now, Anthropic says it remains open to government work and that Claude is already used across defense and intelligence workflows. Meanwhile, the enterprise AI race is now entering a new phase. French AI lab Mistral has signed a multi-year partnership with Accenture to push its models into large companies. This comes as OpenAI and Anthropic both have also been deepening ties with global consulting firms. On the infrastructure front, the AI build-out continues at full speed. Dell is projecting roughly $50 billion in artificial intelligence server revenue for the year ahead. Google, meanwhile, is pushing quietly but strategically at the edge. Its AI Edge Gallery is expanding to iOS developers, powered by a compact model called Function Gemma. The system can interpret natural language and execute actions directly on your device. No cloud, no connectivity required. And then there's the workforce story. eBay is cutting about 800 jobs, roughly 6% of its entire workforce, even as revenue continues to grow. There's also Jack Dorsey's Block that is reducing its organization by nearly half. Headcount will fall from over 10,000 to under 6,000 employees, with more than 4,000 roles impacted. Now, Dorsey says that the business is strong, but argues that AI tools and flatter teams are now fundamentally changing how companies operate. So this is clearly a signal to how the workforce story is going to shape. Block stock jumped roughly up to 25% after this announcement.
All right, thank you. That is the AI Pulse, as you rightly pointed out, and it ends with the biggest story of them all. That's Block looking to fire 4,000 out of its 10,000 workforce. MK Global Financial Services is now joining in, but they are of the camp that perhaps the sell-off in IT could be a little overdone, and valuations now are seemingly attractive. We have with us Seshadri Sen, Head of Research and Strategist at MK Global Financial Services, now joining in. Seshadri, thank you very much for joining in. Rima here.
Thank you for hosting me.
Thank you for joining in. So much is happening in the world of AI technology, and stocks are getting whipsawed in all directions. But tell us at MK, what is your thesis? And then we'll take it from there.
Yeah, so we think the Indian IT services stocks have overcorrected at this point in time. Apology. There is no doubt that AI is a severe disruptive force in the overall world of IT. But to argue that the Indian IT services companies will be rendered irrelevant is, I think, a bridge too far as we are concerned. I think 3 or 4 things will happen. Yes, over time, the applicability of AI in the overall industry will increase. But AI agents are still not at the phase, or probably will never be in the stage where clients can take AI agents and do all the software work themselves and bypass the IT services companies. There is a lot more that IT services companies do than just coding, and I think that is one important thing, factor to remember when formulating the thesis. The second thing is that when frontline clients, etc., they want to deploy AI agent-led software in their companies, they will still need the help of these IT services companies for various parts of that business. If you step back and take a big picture, the IT services companies will lose share of client spending pie to the new age AI companies, the Nvidias, the data centers of the world. They will take away some of the costs. But the overall pie, we think, should also start to expand, because one factor that is missing in this entire argument is that the AI will produce many use cases. So static analysis will tell you that the share of revenues of IT services companies should contract. But If you take the second order impact, that AI will give you many more options in terms of use cases, I think the overall pie will expand and the IT services companies should be fine. They are low growth companies. I think we have to accept that they are sub 5% growth companies. But to build in a scenario where they are contracting into oblivion is, I think, a little misplaced at this point and an overreaction. On the other hand, valuations are, these are 100% cash flow companies. Valuations in many cases are 16 to 17 times. They're very disciplined in paying out their cash. So I think this is a good point to tactically look at this sector. We will start with the large cap because in times of uncertainty, it's a little dangerous to go into a 30 times mid cap company, which may be more AI, may be more ready to serve the new universe. But we prefer to stick to the slightly safer, larger caps at this point and see how the sector behaves from here on.
Take that point on board, Seshadri. We got your point that maybe in the near term, things have got over-exaggerated on the downside. And there is valuation comfort. And you don't believe that IT companies itself are going to lose their relevance. So we take that on board. But I wanted to ask you more from, a broader perspective. IT services as a contribution to, say, India's, exports, service exports, also in terms of unemployment. And the fear is that it will actually, have a repercussion with regard to consumption as well as retail. You put some numbers to that, if you could help us out.
Yes, if you do believe in the Armageddon scenario where the IT services companies, contract from here on a structural basis, then you're right, the macro implications are severe for India. IT services is 6x India's current account deficit. So you can imagine a 20% contraction there would mean to be, more than double India's current account deficit. It's 27% of total wages paid by the top 1,000 listed companies. You add unlisted and government, it's still 12% of total wages paid. If that starts to sort of contract, into oblivion, then we have a very serious problem. It will affect consumption, it will affect the banking sector, asset quality, it will affect the current account deficit. And it could arguably hit the fiscal deficit as well because that will flow into government revenues. But that's an alarmist Armageddon scenario which we don't think will pan out. And it's fairly obvious that if the IT sector goes into a serious long-term slump, then India is hit by multiple fronts. I don't think you need very deep analysis to figure that out. But I think that's an unnecessarily alarmist scenario. This sector has withstood many other technological changes in the past. I agree that the AI revolution is not your regular technology change, stage. This is revolutionary in the way it's changing technology. But we do think that relevance will remain. We don't think that AI will substitute people and this workforce will shrink by 30% because there will be use cases. The type of employment may change. Fewer fresher coders, more higher level people. We'll all know all of that when, maybe a year or two down the line. One more factor that I pointed out in my note is that there's nothing happening right now. I've spoken to recruiters and you look at the recruitment data, there is no pressure on AI or on IT hiring at this point in time, or any accelerated pressure. IT hiring has been sluggish for the last 2-3 years. It will continue to be sluggish, but there's no sharp contraction. There's no panic among IT sector employees. If you see consumption in Bangalore, real estate in Bangalore, none of that is visible. And I do think that, if it was so bad, then you would start to see signs already because, a lot of people look ahead in terms of where we are. So I think there is to some extent narrative overtaking reality in some of this. I'm not arguing that AI is not disruptive, but the extent of disruption, I think, is getting over-exaggerated. So the short answer to your question is yes, if the worst case plays out, it will be very bad for India on multiple fronts, but I don't think that worst case is about to play out.
Seshadri, unfortunately out of time, but point well made. Thank you very much for joining in. Let's hope that ultra bearish scenario doesn't come, because then the implications don't stop at Indian IT sector. It will impact the macros, the Indian economy, and so much more. Thank you very much for joining in. We will get into a break. On the other side, we'll talk macros. Lata joins in as Mosby will announce the new GDP series later today. Stay tuned. All right, before we get to anything, let's just do a quick sneak peek into the stocks that we will be addressing on. All right, we'll get to that in just a bit. But before that, let's get to the markets, because the Nifty has once again breached the 25,300. It had attempted a bit of a recovery courtesy Reliance Industries, and Reliance Industries will come up for you on your screen. It has completely flattened out from the Reliance Industries is flat now, but it's managed a bit of a intraday recovery. So that's not what's pulled the Nifty down to levels of 25,300. The big losers include Bharti Airtel, that's the top loser, down 3% odd. Dr. Reddy's, Grasim, Interglobe Aviation, that's been weak. Banks continue to struggle today. The Nifty Bank is down more than 400 points.
That's right, Reema. From the broader markets, actually, individual stocks are doing a jig of their own. You know, you pull up Bajaj Hindustan, it's only 16 rupees stock, but that's spiked up a little bit. Reddington is moving with very, very good volumes. That's up closer around 15%. So I think we should get that one as well up for you on the screen. IDFC First Bank, from the panic lows that we saw earlier this week, that as well is now at around 74 rupees. I think it went down to around 68 rupees. So a bit of a recovery is what we're seeing. And Praj Industries, for the second day running, stock is up. I think for this week itself, it's up close to around 10%. So big move is what we're seeing on Praj Industries, Reema.
Okay, and now Lata is joining in because today at 4 o'clock, we will be getting the Q3 GDP numbers. And it's going to be a new GDP series where the base year will change from FY12 to FY23. Lata joins in. Lata, what can we expect?
Well, first up, let me just tell you that, the base year changes from FY12 to FY23. That is one thing they will announce, and they will therefore recast. FY23 is what they're going to change. We will get new FY23, FY24, FY25, and FY26 advance estimates. Okay, we will get so that we can compare. So what is new today? We are going to get the Q3 GDP, the normal, which is announced every February 28, the October, November, December GDP we will get, and the advance estimate for the full year, that is including fourth quarter, will also be given by the MOSPI, and that is our poll that you are seeing on the screen. We are expecting, our poll said that it will be 7.7, that is the third quarter GDP, which is a little lower than the second quarter's 8.1, but of course much better than a year ago. And the full year GDP, the estimate we got, the poll said 7.6%, and that's compared to 7.4, which was the MOSPI's own earlier estimate. But, what I want you all to actually see is what exactly is going to change. And for that, can we pull up the GDP numbers of the previous years? See, look at these numbers. FY23, we had 161 lakh crore as the total GDP. Now the government is saying that they're going to add informal data, informal sector data, employment data, and a whole host of other things. So will this number increase? Now, if that increases, what happens to the next number and the next number and the next number? Will those change? Now, this is the nominal GDP that you have in front of you. Again, 268 lakh crore was FY23. If you're going to have a different inflation number and a different, more informal source data, employment data, a different way of calculating what they call double deflation, if the 268 changes, then it will not be 12% growth. It will be something else for the next year. Any of those numbers and all of those numbers can change, and therefore the growth rate can also change. So what is at stake is like almost a complete uprooting of what we thought as numbers and a new set of GDP numbers. Dr. Saurabh Garg, the secretary of the MOSPI, when he came on our channel, he reassured me that the difference will not be too much. But we will have to wait and see, because if the overall nominal GDP changes, fiscal deficit is a percentage of that GDP. That also will change. What you are forecasting for next year will also change when the base changes radically. So today you be prepared for an earthquake on the data front. Let's wait and see what we get. We are not going to understand much today at 4 o'clock. We have to pour through the numbers over the weekend and get more understanding by the time we come back on Monday.
Thanks a lot for that, Lata. Well, time to slip into a short break, but as we do that, here's a sneak peek into the stocks that we'll address on Your Stocks Data today. Don't forget to catch fundamental and technical experts give their views at 2 p.m. today, only on CNBC TV 18. Welcome back. You're tuned into Halftime Report here on CNBC TV 18. Well, we have Ashish Kyal who joins us on the show to help us out with how do you trade the Nifty. Well, Ashish, good day. Good to see you win. The Nifty is down 220 points with the Nifty Bank down 500 points. Do you think we're breaking down from here on, or do you think this is the level that you can see some bit of a bounce?
Hi, afternoon to you and afternoon to all the viewers. If you look at Nifty, what is very interesting is the scenario which happened on 3rd of February. We saw a huge gap up happen post the trade deal announcement. So what was supposed to happen over a period of 3 months happened just in a single day, and Nifty is still trying to digest that. There is a big gap which is left, which is around 25,100 level towards 26,250, and we are attempting to fill that gap to some extent. So as of now, we are on the sell side. Over short term, there is a pressure, but I think we should manage to claw back about that 25,500 mark. So from a trading strategy perspective, if we get a dip towards 25,250, 25,220, that can be an opportunity to buy with a stop loss of around 25,100 and moving back to 25,500. So the risk reward looks more appealing on the buy side, given that there is a gap support on the downside around 25,100 now.
25,100 on the way down. Ashish, what about stocks?
From a stocks perspective, there are specific sectors and the stocks that are still outperforming, and we can clearly see that happening. IndusInd Bank is one such stock which has been there on the radar for quite some time, and this stock has done exceptionally well over the past few days and months as well. It is giving a strong breakout in today's session also, managing to be little biased on the negative side right now, but overall I think the stock should reach towards the level of 1,050 on the upside, and on the downside the support for the stock is going to be around 910 levels. So IndusInd Bank is a buy, and the next stock on the buy side is going to be BPCL. We can clearly see that the oil marketing companies, the energy stocks are the flavor over the past few days. IOC has went up sharply. BPCL is now trying to catch up. So BPCL, one can create long positions, expecting a target of around 420. On the downside, one can maintain a stop loss of around 370 levels.
Thank you very much, Ashish, for joining in. We will slip into a break. We'll come back with more. Stay tuned.
Welcome back. Well, there are stocks that have actually recovered from the low point of the day. I think we should pull up GAIL. There was a negative report that had come in from Kotak. But the stock actually was down, I think, close to around 2%. That's moved into the green. So good recovery is what you're seeing on that one. Apollo Hospitals, another stock that's done very, very well. That one as well has spiked up in the last few minutes. So from the Nifty pack, that's a name that's doing well. We're still down close to 220 points. The Nifty Bank, that's the one that needs to give up its underperformance. 60,700, 60,800, extremely crucial marks. But let's focus on another name, Sarda Energy. Now, if you pull up a wider time horizon of the stock price, it had gone to around 650 rupees and then it corrected to around 500 rupees. There was this fear that the asset that they've acquired, SKS Power, it may not come into their fold. Now, Supreme Court has ruled against those applications that came in from some other companies. That included Torrent as well as Jindal Palm. And Supreme Court has dismissed the pleas that came in from some of these unsuccessful bidders for the SKS Power asset. Now, the SKS Power asset is very, very important. It's already consolidated in Sarda Energy's books. And the street is very optimistic because there is a potential for them to go ahead and double the capacity from year on as well. And that's what could lead to a big surge in terms of the EBITDA number. As of now, the company is already doing an EBITDA per annum of more than 2,000 crores approximately. Going by the fact that SKS has already come into their fold. So SKS Power is important. It gets the green signal. The pleas that were there has been dismissed. And now the big trigger to watch will be what's going to happen and when will they announce the doubling of capacity out there. As it is for their steel business, they are well placed because they have a good amount of exposure to long products. And those prices have surged up as well. So explains why the stock is trading with good gains today and the volumes are very, very large. The street believes that this is a step in the positive direction for the company and any kind of uncertainty with regard to SKS Power is now out of the way. We'll try to get the management next week on the channel and quiz them a little bit more. They're waiting for the official document to come in with regard to this verdict. But good news coming in for the company. Time to slip into a short break. You come back, we'll focus on the markets as well as on some stock-specific action.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. The IT index is holding out one end of the market, notwithstanding the recovery that we saw yesterday and today in the IT names. The Nifty IT index will still go down this week with a cut of about 4%. And for the month, it will be a decline of about 19%, making it the worst monthly performance in the last many years for the Nifty IT index. But just in the last 2 days, we've seen some resilience, some recovery from lower levels coming through. Sectorally, there was a lot of pain other than IT in real estate stocks. So realty has gotten badger too. The Nifty Realty Index is virtually at lows, 52-week lows. Index is down 2% today. And for this week, it's down nearly 4.5%. So that's the other pocket of pain. Well, with that, we're going to take your leave on Halftime Report. We leave you with the news that the Nifty is below the 25,300 mark, a cut of more than 200 points on the Nifty, with the Nifty Bank struggling to 500-point slide. With that, it's a wrap. Business Lunch will take the market action forward.
Growing uncertainty about the future takes a toll on stocks, with realty, financials and FMCG being the big drags. IT and utilities buck the trend. Vishal Megamart sees near 14% of its equity change hands in the block trade window, worth over 7,900 crore rupees. Private investor and promoter Kedara Capital is believed to be a likely seller. Stocks of microlenders slip after Bihar's new microlender rules curb some recovery methods. Even RBI-regulated entities. Analysts fear a rise in portfolio risk as seen after the less stringent Karnataka rules kicked in. The Director General of Civil Aviation has introduced free booking cancellation within 48 hours for domestic travel, if 7 days ahead and if 15 days ahead for international travel. The refunds will be processed in 14 days. Twitter co-founder Jack Dorsey's Block is laying off 4,000 of its near 10,000 workforce to pivot to an AI future. He says the realization isn't early, rather most companies are late. The Block stock fires up and the world gets a loud message. Hello and welcome to Business Lunch, live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan. Hi guys, let's take a look at how the markets are doing. It's red across the screen. The Nifty is down 200 points. It's about 0.8% lower in trade. We've got the Sensex, the mid-cap, all of them falling in tandem with those blue chips. The Nifty Bank also feeling pain over there. If you take a look at the advanced decline ratio, we've got 1,915 stocks declining for 967 that are advancing. And if you take a look at the sectors, it's IT stocks that are now contributing to the upside. They have seen some recovery over the last 2 days. We've got L&T Tech Services, Emphasis, Infosys, all of them trading in the green as we speak. But for the week, all of those IT names are in the red. Now, looking at where the pain is, we've got that realty index, which is the top losing index. We've got Brigade, Godrej and Prestige seeing cuts of nearly 2%. We've got those FMCG stocks also not doing well. We've got Nestle, Marico, Tata Consumer, all of them down between 1% and 2%. So that's how the markets are shaping up this afternoon. But first up on the show, MFI stocks have slumped after Bihar introduced a microfinance lending bill, which as per IIFL Capital is more stringent than that introduced by Karnataka. Ria is here to tell us more on that. Ria?
IIFL has come out with a note on the NBFC space post this announcement. Now, the Bihar government has introduced a bill regulating MFIs and small lenders that is on a more similar or more stringent lines than the 2025 Karnataka Ordinance Bill as per IIFL, and this includes loan waivers, prohibition of coercive recoveries, capping of interest rates and loans. Now, they've also highlighted that RBI regulated entities are exempt from this bill, like in the case of Karnataka, but not from provisions relating to the prohibition of coercive recovery methods, borrower protection measures, as well as fair recovery practices. Now, Bihar constitutes roughly 15% of the MFI industry, which is the largest, with its share rising by around 110 basis points over the past 2 years. And this is despite Bihar's MFI portfolio declining by an 8% CAGR in the last 2 years. Now, NBFC, small finance banks, as well as banks, have between 5 to 45% of MFI and MSME exposure in Bihar. That is at risk of a sharp rise in delinquencies as per IIFL Capital, and they remain structurally cautious on lenders with high MFI exposure. Now, looking at the exposure for Bihar as a percentage of MFI AUM for these companies, Utkarsh Small Finance Bank has the highest exposure at 45%. L&T Finance as well as Fusion Microfinance have about 17% each. Ujjivan Small Finance is at 11%, and Credit Access Grameen is the lowest at 4.6%. In terms of the stock moves, all of these stocks have taken a hit in today's trading session. L&T Finance as well as Ujjivan Small Finance Bank down anywhere between 3 to 4% today. Utkarsh Small Finance Bank and Credit Access Grameen, even Fusion Finance, all down by 6% in today's trading session.
All right, Ria, many thanks for those details. Now, let's also hear out what IIFL Capital's Viral Shah had to tell us about the impact of the bill on MFIs earlier today.
So the pure play MFIs like your Fusion, Spandanas of the world, they do stand to be negatively impacted. You have SFBs like Utkarsh, you have even Ujjivan who have higher exposure in those geographies. So they also stand to be negatively impacted. Even L&T Finance has 20% of its MFI portfolio there. Basically, the recovery that we all were anticipating in MFI, because of this kind of gets pushed back by a couple of quarters.
We also caught up with Sudipta Roy of L&T Finance. He shares that Bihar is a reasonable part of their portfolio and holds 17% share in the MFI book. Take a look.
Bihar is a reasonable part of our portfolio, but obviously we are spread all across the country. It's about 17% of our portfolio. If you see our collection efficiency, for example, our collection efficiency this month, we're just one day away from the close of the month, we are upwards of 99.7. So overall, I do not expect a major impact on L&T Finance's go-forward strategy as well as our collection efficiency in Bihar. But the fact is that we'll have to study the statute in greater detail together with our and await guidance from the MFIN, our SRO, and then take our according steps. I do not expect any major impact on L&T Finance.
Auto companies will release their wholesale numbers for the month of February next week. Sudarshan Kumar is here to decode what to expect. Sudarshan?
Come Monday, we'll have the auto wholesales for the month of February 2026. And like the indication we got from the retail data, we are expecting a strong set of numbers on the wholesales front also. And CVs and tractors will continue to perform. But we'll have to take a look if there is any impact from the commodity price rise that we have seen in the last few months. As far as the expectation is concerned, PV is seen growing by 12%. Two-wheelers may see a growth of 33%. M&HCV is likely to see a growth of 28% and tractors may increase by 29%. Now talking about the company-wise, Bajaj Auto sales may increase by 29%. Similar growth can be seen for Hero Moto where growth can be of 34%. TVS Motor can see a growth of 26% and even Royal Enfield can report a growth in the range of 13 to 14%. In the four-wheeler space, especially talking about the passenger vehicles, Maruti Suzuki can see a growth of 10%, Hyundai 12%, M&M Auto 17%, and the outperformer will be Tata Motors passenger vehicle. So the same indication we had got from the retail data also, and Tata Motors PV can see a growth up to 37 or 38%. In the commercial vehicle space, Tata Motors commercial vehicle can see a growth of 28%. Ashok Leyland can report a growth in the range of 23 to 24%, and in the tractor space, Mahindra & Mahindra Tractor can see a growth of 29 or say 30% for February 2026. So like retail data, February auto wholesales can also be like very strong and auto companies remain on a strong footing.
Auto companies remain on strong footing. Thank you so much for those details, Sudarshan. And moving on, the NSE CEO Ashish Kumar Chauhan has stressed on the importance of having a minimum qualifying criteria for investors to participate in the F&O segment. Yash Jain is here with all of those details. Yash?
Well, that's a very strong statement coming in from the Managing Director and CEO at India's largest stock exchange, that is the National Stock Exchange, Ashish Kumar Chauhan, saying that it's high time that India adopts minimum qualifying criteria for futures and options or derivatives participation. He's also gone ahead and said that minimum qualifying criteria is important so that the lower strata people in the country don't lose their money when it comes to derivatives or F&O trading. Also saying that India cannot allow over speculation by lower strata of economy, and more regulations are expected to come from government regulators to curb this particular over speculation. He was speaking at the FIA conference which happened in Mumbai, and what we've been given to understand from our sources is also the fact that the same proposal of spelling out a minimum qualification criteria for participation in derivatives market has also been shared with market regulator SEBI by the National Stock Exchange.
All right, Yash, many thanks for taking us through those details. On that note, it is time for us to head into a short break, but more news and updates follow on the other side. Stay tuned.
Fly Emirates, fly better.
Welcome back. You're still with us on Business Lunch. The Ministry of Statistics will unveil a new GDP series, changing the base year from FY12 to FY23. It will announce new GDP numbers for the last 3 years as per the new method of calculation. Also, it will announce the Q3 GDP and the estimate for the full year as well. Lata is here with her poll and what today's announcement means. Lata?
Yeah, so they're changing the base year and they're also going to change the methodology. I mean, they're including new data which is now available, you know, quick commerce data, GST data, etc. So method of calculation will change. And on this new method, they will give us new GDP numbers for the past 3 years. And the fresh number will be for Q3, you know, October, November, December. Always at the end of 60 days, you get that. You will get Q3 and you will get full year estimate. Now, Q3, our poll says will come in at 7.7% compared to 8.1 in Q2. And for the full year, the poll that we got was that it will be 7.6%. The first estimate of the MOSPI itself was 7.4. But now let me tell you what exactly we have to be worried about. See, just pull out the real GDP numbers of the last 3 years, including this year, so 4 years. Now, what we knew about the real GDP was 3 years ago, it was 161 trillion, it became 176. Now, all this is going to be calculated in a different way, adding more informal sources and GST, etc. So if that 161 changes, then FY24 will not be 9.2% growth, it will be something else. If 176 trillion itself changes, then again, the FY25 will not be a 6.5% growth, it could be something else. FY26 may not be 7.4, it could be something else. Now you go to the nominal GDP, which is even more important because we base fiscal deficit, etc. on it. Nominal GDP, according to the old currency, why should I say old? Current series, in FY23 it was 268 trillion, in FY24 it was 301 trillion. All those numbers can change because of the new method of putting together the GDP and the inflation, which is what gives nominal GDP. So maybe it will not grow by 8% or 9.8% as we knew. So what we are going to be in for today at 4 o'clock is a statistical upheaval. A lot of numbers can change and therefore future numbers can change. Now, depending on the new method of calculation of GDP, maybe the forecast of next year also will change. So when you say fiscal deficit is 4.3% of something, that something is going to be calculated differently. A lot can change at 4 o'clock when the numbers come.
So we'll have to wait and watch what happens post 4 p.m. to those numbers. All right, Lata, thank you so much for decoding what that means. Moving on, the US and Iran made significant progress in talks aimed at resolving the long-standing nuclear dispute and averting new US strikes on Iran. The two sides plan to resume negotiations soon after consultations in their countries' capitals. With technical-level discussions scheduled to take place next week in Vienna, Omani Foreign Minister Syed Badr Al-Busaidi said in a post on X after the day's talks ended in Switzerland. Iran's Foreign Minister Abbas Araghchi told media that the next round of negotiations will take place very soon. In less than a week, and that a number of topics were discussed at the meeting, including the nuclear issue.
I can say that we made good progress after several hours of intensive negotiation. We have started serious discussions about elements of a deal, both in the field of nuclear issues and the removal of sanctions.
And in the latest on the bid for Warner Brothers, Netflix has declined to raise its proposal to buy Warner Brothers Discovery after the Hollywood studio deemed Paramount Skydance's rival offer superior. Netflix has backed away from its proposal to buy Warner Brothers Discovery, clearing the way for Paramount Skydance to win the months-long takeover battle. And on that note, it is time for us to head into another short break, but more news and updates follow on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. It is time for our news segment. And this one, we get you all of what has happened in the world of technology and artificial intelligence overnight. Rachna Dhanrajani is here with a roundup. Rachna?
Well, we've been getting you updates from the space of artificial intelligence and telling you that now it's not just about faster models or bigger fundraising rounds, but about power, pressure, and the very real changes that AI is already forcing across boardrooms and workforces. We've been doing our top stories since morning. So let's start with Anthropic. The maker of Claude is in the middle of a visible policy standoff with the US defense establishment. CEO Dario Amodei has publicly withdrawn two firm red lines for the company's Claude models. First is that no large-scale AI surveillance for Americans, and second, no fully autonomous weapons without meaningful human oversight. Anthropic says it remains open to government work and that Claude is already used across defense and intelligence workflows. It had even said that the Pentagon has called Claude pretty much irreplaceable, but the deadline is today, 5 p.m. Then the big story that we're tracking from this space is regarding workforce. eBay is cutting about 800 jobs, roughly 6% of the workforce, even as revenue continues to grow. And that's why the concern is, because there's also Jack Dorsey's block that is reducing its organization by nearly half. Headcount will fall from over 10,000 to under 6,000 employees, with more than 4,000 roles impacted. Now, Dorsey says that the business is strong, but argues that AI tools and flatter teams are now fundamentally changing how companies operate. It is perhaps the clearest signal yet of how the artificial intelligence transition is reshaping corporate structures in real time. Because it's the first time that a CEO has openly acknowledged AI efficiency and its impact on the workforce that we can see with the jobs being impacted. So this could set the tone further for layoffs across the sector. So we'll keep an eye out for that.
All right, Rachna, many thanks for taking us through those details. Now, moving on, the DGCA has modified ticket refund rules, allowing a 48-hour cancellation window. If you can see, Interglobe Aviation also fell in trade on the back of that. Madhya joins us now with all of those details. Madhya?
Well, so there are three things that come as a big relief for passengers here. First, it gives them 24 hours more to decide on the ticket that they've booked. So as per the new rules, passengers can now cancel or amend their tickets within 48 hours of booking without paying any additional charges. So 2 days of changes in the tickets will not, and they will get a full refund without any deduction in the additional charges that the airlines otherwise levy. It cannot be for travel in 3 or 4 days. For domestic flights, the departure date must be at least 7 days away from the booking date. Or for international flights, the travel date must be at least 15 days away. So that is the condition for this change. Beyond the 48-hour window, regular cancellation charges that airlines currently levy will apply here as well beyond the 48-hour window. The second move, airlines cannot levy any additional charge for correcting the name of the same passenger if the mistake is flagged within 24 hours of booking. This applies to tickets booked directly through airline websites. The third one, in case of refunds, some airlines would give a credit shell in place of refunds, but now passengers will decide whether they want a credit shell or direct cash into their account. The DGCA has also clarified that if tickets are booked via travel agents or portals, the responsibility of issuing refunds lies with the airline, not with the agent, and refunds must be processed within 14 working days. The revised norms come amid rising complaints over refund delays across airlines. Now, we're trying to understand how these rules impact airlines' top line. Not charging passengers for changes in tickets like names or the date will definitely hit their ancillary revenue, because that is where the additional charges is where the ancillary revenue also came from, like, for example, charges for the seat booking or booking meals, and additional charges on ticket changes also forms a major part of the ancillary revenue of the airline. So we now need to study how much of a hit this will be across airlines.
So we'll have to wait and watch what happens to the airline's top line. All right, Madhya, many thanks for taking us through those details. Now, shifting focus to some updates from the national capital. Former Delhi Chief Minister and AAP National Convener Arvind Kejriwal, alongside other 22 accused, have been acquitted of all charges in the Delhi excise policy case. The Delhi court closed the case initiated by the CBI, saying there was no overarching conspiracy or criminal intent in the excise policy. The acquitted also include Manish Sisodia and Aurobindo Pharma Sarath Reddy. And with that, it is a wrap on this edition of Business Lunch. Midcap Radar takes all the market action forward. Stay tuned.
Good afternoon. You're watching us here on Midcap Radar. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me, Hormas Patakia. Only the show name and the show time has changed. What hasn't changed is the Nifty still around that 25,300 mark. The broader market still selling off, and the Nifty Bank down 0.8% below that 60,700 mark right now as we speak. So there is a fair amount of selling. There is a fair amount of pain with no respite so far. Yes, important levels are being held, at least today's low, etc. But, you know, be that as it may, it's still selling off. We're not out of the woods. There is no sign of formidable recovery from the lows, Hormas.
No signs of recovery whatsoever. And it almost seems as if the index hasn't gone anywhere since we left the studios 90 minutes ago. The Nifty Bank still remains at that 6,700 mark. The Nifty at 25,300. So, of course, it's going to be another down week for the markets as well. And the mid-caps are not faring any better this time around in today's session, although the mid-caps were outperforming the last time around, but that's how it has been. But here's a look at what are the top headlines then at 1:30 this afternoon. The markets continue to trade under pressure. Growing uncertainty about the future takes a toll on stocks. Realty, financials and FMCG are the top drags. IT and utilities are bucking the trend.
Shares of Tejas Network continue their impressive run, seeing a near 14% uptake in trade following the company's agreement to manufacture and supply massive MIMO radios yesterday.
Vishal Megamart has seen nearly 14% of its equity change hands in block deals worth nearly 8,000 crore rupees. Private investor and promoter Kedara Capital is likely to have sold that stake. The stock slips over 7%.
Stocks of microfinance lenders slip after Bihar's new micro-lender rules curbs some recovery methods of even RBI-regulated entities. Analysts fear a rise in portfolio risk as seen after less stringent Karnataka rules kicked in. Well, we've been talking about how the market has weakened, and going into the weekend, we will also see further sell-off. And the last bout of selling has been in a lot of these capital market names. So Angel One is down about 5%. We're seeing some decline in ICICI Pru as well. Wealth management companies and insurance companies, all of them are selling off, and we are seeing PB Fintech as well, which is currently at the low point of trade. Good time to bring in Jay Thakkar from ICICI Securities for a quick technical check on the market. Jay, we're below the 200-day moving average on the Nifty. Is there any other important level in sight on the way down, or do you think this market is now going to close lower from where it is right now?
Well, rightly pointed out by Chalam, and one interesting thing to note, in this entire last what we saw in the February series, or maybe in this February month, is that the broader range has been 26,000 to 25,000. That's 1,000 point range, and that is just because of what happened on the 3rd of Feb, wherein there was an announcement of the trade deal, and we saw that huge gap up. And since then, Mangalam, what we have seen is Nifty was unable to close about 26,000, and India VIX also has gone up since then. I mean, otherwise it should have been at around 11.5, but then it's still at around 13.5, 14 on a closing basis. If you see, it was 15 earlier prior to the trade deal announcement, of maybe very close to the budget day. So VIX is at a higher level. Markets are falling very slowly. I mean, because we are seeing one-day bounce also, and because of which the range has got very narrow now within this 1,000 point range. That it has been 25,200 to 25,800 now. So that's or maybe 700. So 500 to 600 points range. VIX is not pointing or signaling a breakout on the upside as of now, Mangalam. Second is, apart from Nifty IT, most of the sectors we saw were trading with a positive bias for the month of Feb. So far, the FI numbers for Feb, either in the index shorts or maybe net index levels in the futures, or probably in the equity cash segment, has relatively been positive since July 25. So apart from Nifty IT, most of the things were negative, and India VIX as well. And now today what has happened is, for the first time, we are seeing that Bank Nifty is struggling to sustain about 61,000 levels. Still, there are 2 hours to go, and we have MSCI rebalancing as well, so you never know. But if Bank Nifty closes below 61,000 with this kind of pain in the private sector banks, then Mangalam, it's heading lower. So to answer your query, then we are probably heading towards 25,000 initially, and then probably 24,800 as well. I mean, wherein the gap which we had seen will be filled completely. So in order to see a reversal on the upside, on a Bank Nifty, you require a close about 61,000. On Bank Nifty, you require a close about 25,700. Till that doesn't happen, as of now, the trend remains a bit on the negative side.
Important levels there, Jay. But what are some of the specific stocks you're recommending, especially in a market like this?
Sure. There are a couple of stocks, I would say, where the stock-specific movement has been quite there in this entire month, and even getting into February, March series. So, a buy recommendation would be on, Colgate-Palmolive, Colpal. Today it's down almost like 1.5% or close to 2%, but it's a buy on dips today. According to me, it's, the target on the upside could be as much as 2,400 to 2,500 for the March series. So far, we have seen Colgate underperforming the Nifty FMCG sector as well. Right, but then we have seen a good amount of shorts that were built up in Colpal, and now we are seeing some unwinding on the shorts. And because of the short covering, we expect that at least on the lower side, 2150 levels will be held, and hence it's a buy on dips targeting around 2,400 to 2,500 going forward. That's on the buy side. On the sell side, I have L&T Finance, which seems to be accumulating some shorts out there now. So on the upside, I believe that 300 will be the stop loss, and on the lower side, one can target 275. And I would add one more, since you were discussing capital market names, Homer. So I would add, CAMS on the short side. It's trading around the levels of 685 right now with a stop loss of 695. One can target 670 to 660. So even my stance on the capital market sector as a whole is a bit negative in the short term.
All right, take that point, Jay. Thank you so much for joining in. With that, let's talk about some of the automobile companies. They will release their wholesale numbers for the month of February next week. Sudarshan joins in to decode what the street is expecting. So,
come Monday, we'll have the auto wholesales for the month of February 2026. And like the indication we got from the retail data, we are expecting a strong set of numbers on the wholesales front also. And CVs and tractors will continue to perform. But we'll have to take a look if there is any impact from the commodity price rise that we have seen in the last few months. As far as the expectation is concerned, PV is seen growing by 12%. Two-wheelers may see a growth of 33%. M&HCV is likely to see a growth of 28%, and tractors may increase by 29%. Now, talking about the company-wise, Bajaj Auto sales may increase by 29%. Similar growth can be seen for Hero Motor, where growth can be of 34%. TVS Motor can see a growth of 26%, and even Royal Enfield can report a growth in the range of 13 to 14%. In the four-wheeler space, especially talking about the passenger vehicles, Maruti Suzuki can see a growth of 10%, Hyundai 12%, M&M Auto 17%, and the outperformer will be Tata Motors passenger vehicle. So the same indication we had got from the retail data also, and Tata Motors PV can see a growth up to 37 or 38%. In the commercial vehicle space, Tata Motors commercial vehicle can see a growth of 28%. Ashok Leyland can report a growth in the range of 23 to 24%, and in the tractor space, Mahindra & Mahindra tractor can see a growth of 29 or say 30% for February 2026. So like retail data, February auto wholesales can also be like very strong, and auto companies remain on a strong footing.
Sudarshan, thank you for that update there. All eyes on the auto sales that will start trickling in over the weekend and going into Monday as well. Take a short break. On the other side, we get to an exclusive conversation that Mangalam had with the management of Marico. Stay tuned. We'll be right back.
Welcome back. You're watching us here on Midcap Radar. Let's talk about the FMCG space. I spoke to Marico's MD and CEO Saugata Gupta and started off by asking them about the acquisition of the popcorn company 4700 BC as well as Cosmix, the rationale behind that and the scalability in terms of opportunity for all these acquisitions. Listen in.
I think there are two things. One, we thought that if you restrict yourself in food, in health and wellness, are you restricting your TAM and your growth opportunity?
Does this mean there could be other acquisitions which are beyond, what your current...
So it's like this. Having said that, we also want synergies in terms of our capabilities. And one of the biggest synergies is consumer and distribution.
Yes.
So
in that case, you
therefore,
can buy anything then.
snacking, I will not go for say a 5 rupee product which is distributed in a Pan Plus outlet because I don't have that distribution.
Got it.
But if I look at the distribution synergy which 4700 BC technically has with our current distribution, the overlap is quite high. And also, for example, if you look at popcorn as a market, you have a 10 and 20 rupee popcorn today available.
Yeah.
Now, 4700 BC has a 10 rupee, 20 rupee, but they can use the Marico system to distribute. And as I said, that the market has, I think, one lead player with significant market share. Therefore, you can, grow the market and also take market share. The other interesting thing is there in institutions, okay, like airlines and all, which none of our brands. So it gives you a kind of a platform for us to piggyback on. The third interesting thing is we will experiment perhaps this year is that can you have a multi-brand gifting, like whether it's a Diwali or any other occasion, then you have a multi-brand versus a single brand gifting, which is again another opportunity which is there. So I think there's a lot of synergy.
If an investor has to look at Marico, should they look at it as a venture firm which is investing in all these D2C companies, taking ownership of them, then ensuring that they're growing, etc.? Should we look at it as a house of brands? Should we look at it as a pure play consumer company? How should investors approach Marico?
I think the way it should be looked at is how a very well-run legacy company transformed itself into a consumer digital giant.
Yes.
And therefore, it has set, we have secured our future in some way.
What part of your valuations have already been priced into the future? What's the
I think it's a
potential
growth.
upside?
I think it's a growth of the future. And the other interesting thing is which people don't look at is that, see, at the end of the day, there are two models running, okay? One is the core, which is a repeatable model of growth, which is mass market, mass distribution. And there is a second model of digital brands, which is, think big, start small, either scale up fast or fail fast with a high velocity innovation. Now, there is a lot of learnings from each other, which means I'm making the core much more agile and having a far more cost-effective and better governed, process-oriented digital business. So that makes a very, very good combination for growth.
Are there any threats? Are there any risks? Are there any potential pitfalls that one should be very mindful of and you constantly monitor?
I think core growth is very important. And I think one of the most interesting thing is that this inflation and parachute, which we, I think, took on quite well in the sense that I think no brand in the world has taken a 60% price hike and still delivered flat volumes, I think the fact that value-added hair oils, which was somewhere delivering a disappointing performance, has now finally turned the corner. It's delivering consistent double-digit growth. So I think the core growth is important because core deliver the resources for the diversification process to go. And also then the second thing obviously we continue to look at is that how do we continue to stay ahead of the curve in capability building. And I think analytics is another area which we have invested significantly. So today if there is a slowing down of a business, say in South Africa, sitting here I'll be able to say what's the issue or diagnose it quickly. Such is the kind of analytics backbone we have created globally and centrally.
All these weight loss drugs, when they become extremely affordable and very commonplace, the second order impact of that people are saying could be on packaged foods and diets would be altered for good structurally.
So we are in the better space in the sense that we are not in high calorie food. We are in wellness, small portions, I think it has implication. Things like protein, for example, is something which will happen once obviously significant penetration increases happen. I think it has implications also how you look in terms of skin, and also there could be opportunities for kaya, for example. So I think it's a trend which we can't ignore. But fortunately, the center of gravity, and even a 4700 BC is a gourmet snacking, and as opposed to mindless munching. And therefore, I think we are in the better space in terms of our food portfolio, in terms of facing that threat.
And just as you heard the management of Marico, the Nifty Bank is back at 6,800. That's the one important level that we were talking about. They're trying to defend that level all through the week. And it's back at those levels as of now. But still, a 400-point cut on the Nifty Bank. Remains to be seen whether it manages to close above the mark of 61,000, as Jay was highlighting. Take a short break. More on the markets on the other side. Stay tuned. Welcome back. While the index is looking to stage a bit of a recovery from the lows, the one stock that did recover from the lows was Astra Micro, and that's on the back of a news announcement that the company just made a few minutes ago. In fact, it has slipped back into the red. Now Ria is here with more details on what the company has announced. Ria.
Well, yes, Astra Micro has announced the in-principle approval to demerge its space, meteorology and hydrology business of the company. And as per the company, this is expected to be value accretive over the medium to long term. And this will also lead to the adoption of tailored growth strategies and capital allocation suited to the new demerged entity, and also lead to value unlocking for the shareholders. Now, if you look at the revenue split for FY25, the space and the meteorological business will contribute roughly 8 to 9% of the revenue for FY25, and in fact the company has also said that upon the completion of this transaction, Astra Microwave Products, which is the existing company, will operate as a pure play defense and aerospace company, and Astra Space Technologies, which is the demerged entity, that will house the new business and will operate independently as an independently listed company, and it will also mirror the current shareholding of Astra Microwave.
All right, Ria, thanks a lot for that. So that's about Astra Micro. Just keep an eye out on the market once again. It's holding above that 25,319, though we do have a lot of way to go before we cross past that 200-day moving average, and the mid-cap index still under pressure. With that, we'll leave on this edition of Mid-Cap Radar. Your stocks when we return.
and welcome to Your Stocks live from the CNBC TV 18 Motilal Oswal studio. I'm Arundhati Ramnan. Good afternoon, guys. If you take a look at the markets, they're doing slightly better than they were doing at lunchtime. We've got Nifty that's back above that 25,300 mark. Mid-cap Nifty Bank, the mid-cap index 0.5% lower. The Nifty Bank also 0.5% lower. So all of them falling in line, in tandem. And if you take a look at the sectors, we've got IT that's on the upside, that's doing better. And it's been doing well for the last 2 days, but for the week, it's also down. We're seeing a lot of pain in those realty names as well. So there's a lot of pain in the market on the downside in FMCG stocks as well. But right now, all of them in the red, and the IT pack is the only one right on top there today, doing slightly better. But joining us on the show today is Shahina Mukaddam, the independent market expert, and Nirav Chedda, AVP Derivatives and Technical Analyst at Nirmal Bang Securities. Hi, thank you so much for joining us on the show today. But, let's go straight to the first question that we have today, right? Chetan writes to us from Mumbai. He holds 180 shares of TCS at 3,150 rupees and 500 shares of Kalyan Jewelers at 510 rupees. He wants to know if he should continue to hold or sell both of these stocks. So let's start with TCS. I mean, the IT sector getting battered this entire month, right? So let's start with that. Shaina, what's your take for TCS? Do you see, should he hold it? Should he sell it? What's your take for the stock fundamentally?
So TCS, I would say that you could book half your quantity as you sell half your quantity. So you book some losses and hold the remaining half. And Kalyan, I think, which is the second stock that you had mentioned, I think one can actually hold it. Now TCS, there is a non-stop issues for the overall sector. If you see last 5 years, TCS initially it corrected because the valuations were expensive, and last couple of quarters, it's maybe 2 years, it's correcting because the revenues, the growth has come down. Now we have had further problems. Like if you see, AI is becoming a big disruptor for I would say TCS, where and some other large IT stocks which are basically into service sector, into they have legacy services. Their main, I would say, operational revenue. So this could be an additional problem if you see over the next couple of quarters. We really have to see whether growth will settle down. Of course, for this year, it should be decent because we're seeing their guidance, which was slightly up, should be maintained, 3.5% revenue growth for the year and margins also to be maintained. Now, so I would say that in terms of valuation, it still remains uncertain as to what will be the deal when going forward. So I would say book half your losses and review. Now, Kalyan actually has corrected a lot over the last couple of quarters, or I would say a couple of years also, 1.5 years, 2 years. Now, at current levels, it starts looking a bit more attractive because if you compare their EV to their turnover, it is very attractive. It's just about 1 year forward turnover. So to that extent, I think there is value in continuing to hold. And they have shown very good performance also in their quarters. So Kalyan, I would say hold, and TCS, book half your losses.
All right. So Kalyan, hold, book some losses in TCS. But, Nirav, what's your take? I mean, the IT stocks, they're having a tough month for sure. AI disruption, lots of unknowns. So any technical levels for him to watch out for in TCS? And what's also the levels to watch out at in Kalyan Jewelers?
Yeah. Hi, Arundhati. Basically, if you see, the whole market is now negative on IT stocks. And in this month, you've seen, 30-35% crack in the index as a whole. So just, looking at TCS, I see a lot of high open interest, lot of shorts built up. I would suggest this would be a very good time to actually add positions from a short-term point of view because everyone wants to sell. Also, open interest is high. So, shedding of open interest would mean some rally coming in. And even from a technical perspective, very good support is around 2600 odd levels. Look to add some positions here. There is most likely going to be a bounce, which is going to come in up to 2800, 2850 levels. Once that comes in, book certain profits and, look for something else. But right now, at least from a 15-20 day perspective, add positions because I see bounce coming in TCS. You should always keep a stop loss. 2580 should be your stop loss for longs. Looking at Kalyan Jewelers, Again, I also concur. I believe this stock has fallen from 700 odd to about 350, and then very good support buying has come in. I believe from current levels there is likely to be a bounce up to the 480, 500 levels, which is where probably this stock will see some resistance. So one can look to add positions at current levels and book profits once that 480, 500 level comes in.
All right. So let's move on to the next query then. Pavan is writing to us from Andhra Pradesh. He holds 220 shares of Bharat Dynamics at 1,455 rupees. So he's currently making a loss. He's asking whether he should hold, sell, and book the loss. So what should he do? Shaina, from fundamental perspective, what's your view on the stock?
Well, I would say, unfortunately, I will have to say that he needs to book his loss. While the third quarter numbers have shown considerable improvement, still, if you look at it in terms of even FY27, valuations remain still very expensive. Order book is very strong. They've got about 73,000 crores of orders, 70,000 plus crores of orders, and they are an integral part in supplying, missiles and defense equipment to the government. It's a government-owned company, of course. And here, what I believe is that because of the expensive valuations, you may not see a great improvement or a great upside in the stock price over the next maybe 1 or 2 years till the valuations become more attractive. So, I mean, if you compare their turnover, FY27 estimated turnover, it's about 12 times. That is why I'm saying it is expensive. I would say that you should review this in maybe 6 months or 1 year time.
All right. Review in 6 months or 1 year time. Nirav, what's your take on the stock?
I would concur as well. See, this stock has come up from 80 odd levels to 2000 in a span of 4 or 5 years. So such a huge rally, and at the top, lot of volumes have happened. So there are top kind of a formation on the charts, which is not a very good sign from a near to medium term perspective. I believe some amount of selling can come in this stock. It can come down towards the 1000 or 900 odd levels from the current levels. So look to exit the counter once it comes towards that 900 levels. That is when you look to buy again, but not at current levels.
Okay, not at current levels is what you're saying. The next query coming in from Krishna S, who's writing to us from Tamil Nadu. He wants to know if ITC Hotels is a good investment bet for 2 years from now. Please advise. So, Shaina, do you think that this is a good bet in a 2-year time frame?
Yeah, I would say that it is a good bet if you're investing now and hold it for 2 years. One is, of course, the stock has corrected a lot. So at current, the valuations look pretty decent. Even if you compare the EV with the number of keys, basically 13,000 keys, it's just about 3 crores per key, the investment. So that I believe is comparable with some of the other large cap hotel stocks and is pretty attractive for the longer term. Even EV by EBITDA 1 year forward is about 21 times, which is not too expensive. They have got low debt, so sufficient leverage to expand, and they are talking of increasing it by about 50% to 18,000 keys over a maybe 2 to 3 year period. So I would say you can start buying and hold it for the medium to longer term.
All right, start buying and hold it for the medium to longer term. Nirav, the stock is at 177 rupees today. And over the last 1 year, it has gained about 9 to 10%, right? So any levels that he should watch out to enter the stock?
Yeah. So basically, a very important support level for this stock is around 160, 155. I think that is also its all-time lows. So if it comes there, it finishes 100% retracement of the rally. So that would be a very good level to enter this stock. And considering it is only about 10-15% of that levels, one can look to start adding positions at current levels.
So you can start adding positions at current levels. Now, the next query is also for a hotel stock itself. K. John writes to us from Kottayam in Kerala. He holds 500 shares of Indian hotels that he has bought at an average price of 523 rupees. He wants to know if he should hold or exit. Shaina, let's start with you. Should he hold or exit the stock? And what do you say in terms of, Indian hotels and ITC hotels?
Well, so I would say both are looking interesting at the current levels if you are holding it for 2 to 3 year period. In terms of valuation, ITC hotels is slightly more expensive than Indian hotels, sorry, is slightly more expensive than ITC hotels. So if you compare the keys to the current EV, they're about 3.3 crores, which is not too much expensive. And EV by EBITDA is also 24 times 1 year forward. So as you can see, it's slightly more expensive than ITC hotels. But I think in terms of quality, in terms of its revenue per key going forward also is likely to be much better. So you can also continue to hold ITC hotels. I think both are in the similar category. Both have good management, good pedigree, good growth potential. So I would say continue to hold ITC as well as Indian hotels. You can have both of them.
So can continue holding ITC and Indian hotels. Nirav, what would you say to the viewer? He holds 500 shares of Indian hotels at 523 rupees. So should he hold or exit?
I think you should book profits. On the technical perspective, this stock has seen a linear rally, from sub 100 levels up to that 800, 840. In the last 6-8 months, this stock has come down from 840 odd, but major downside hasn't come in. I believe this stock is headed lower up to the 540, 550 odd levels. So probably, it will come to its cost. So it's better to book some profits here. The overall chart pattern is not very good. So let it come towards 500, 550 odd levels. That is when you can look to add again, but not at current levels.
All right, not at current levels, so book some profits is what you're saying. But Nirav, Shaina, on that note, we have to take a quick break, but we'll continue to answer all of your stock queries on the other side. Stay tuned. Welcome back. You're watching Your Stocks. We still have with us Shaina Mukaddam, independent market expert, and Nirav Chedda, the AVP derivatives and technical analyst at Nirmal Bang Securities, to answer all of your stock queries. So the next query is coming in from Piyush, who writes to us from Delhi. He holds 2,000 shares of Jio Financial Services at 270 rupees. He's making a loss on the stock right now. How long can he hold this stock? He is looking for a short-term view. So Shaina, from a short-term perspective, what's your view on the stock?
Well, shorter term, I think the stock can correct a bit more. But I think for the longer term, it remains a decent hold and then average at lower levels. The issue out here is that if you compare it with peers, it definitely looks much more expensive because it's relatively newer in the, to come into the market. Also, in terms of their AUMs, they have this joint venture with BlackRock, which has recently launched its fund, and they have already been about an AUM of 20,000 crores. But if you compare it with their EV, it is expensive compared to its peers. But I think, this being a growth phase, they're also, I think Jio is also looking to get into newer areas like credit finance, where it has recently put in another 2,000 crores into its subsidiary. And I would believe with its very strong digital execution, it could garner a decent market share, but it will take time. I would say it would take about 2 years. And so downside for the stock from here, I would say would not be more than 10 odd percent. So I think you can average it at those levels because the investors already got in at decent levels. And if you look at profits and earnings, they're doing very strong numbers, growing, of course, the fastest on a smaller base compared to its peers. So I would say give it some time and hold it for a longer term period.
So give it some time and hold it for a longer term period. Nirav, the stock has gained about 16% in the last 1 year, right? So what are the levels he should watch out for at this point? And should he look at it, should he exit in the short term or stay and keep it for the long term?
He can, hold on from a short-term perspective as well. See, basically, this stock has a very good support area around 245, 250. You can keep a stop loss of 245 for longs and, hold on. I believe slowly and steadily the stock will start to come up. The consolidation phase seems to be over now. It should move up from here. It can go up towards 285 to 90 odd levels, which is where I would suggest to book some profits.
So you would suggest to book some profits on Jio Financial Services. All right, the next query coming in from Amit Gupta, who's writing to us from Noida. He has 83 shares of Lemon Tree at 125 rupees. He is making a loss on this stock and wants to know what he should do with his holdings. So Shaina, what would you suggest to him?
Oh, a lot of hotel stocks we're discussing today, but all three are decent, bets for the, I would say, medium to longer term. Lemon Tree, in terms of valuation, is almost, similar to that of ITC hotels. But here, there is a lot of change happening in the last 1 year. Starting April 2026, they have actually, I would say they are doing some sort of a major restructuring, wherein they are first of all, debt was the major issue with this company. Okay, so what they're doing is restructuring, and I believe that Warburg Pincus is going to bring in about 960 crores into the company, which is actually going to be they're going to split the company into two parts. And one will be where there is going to be an asset-light model in which Warburg Pincus will bring in about 950, 960 odd crores, and Lemon Tree will become debt-free, the rest of the business. And this is done so that they can actually fund their growth plans aggressively because of the high leverage that is there currently. And the growth plans are pretty heavy. They are talking of doubling their keys over the next 2-3 years. So I would say you continue to hold, and you could see some small bit of correction, but those levels you can average.
All right, continue to hold. Nirav, what's your technical view on the stock?
See, the stock has broken important support levels. First, the very important support was 140, which was broken. Its initial target was around 118 odd, which is also broken, which was a very important support as well. I believe until it, again moves above that 118, 120 levels, one should, continue to, this stock can continue to witness some more selling pressure, up to the 195 odd levels. it still has some downside left. I would suggest if you're holding, just exit it at this point, and you can enter when the stock comes towards the 100 or 95 levels.
All right. The next question coming in from Pradeep Patil, who's writing to us from Bangalore. He holds 30,000 shares of Suzlon at 7 rupees. He's clearly making a good profit on the stock. Should he sort of hold the stock for the long term? Shaina, what's your view on the stock in the long term?
Well, in the long term, I think valuations will start looking a bit more attractive because they're doing very well in terms of growth. Very big order book position. They've got 6.4 gigawatt of orders in hand, and it's reflecting in their numbers actually. Very strong growth in both profits as well as revenues. At the same time, I think if you look at pure valuations for the shorter term, maybe 1, 2 quarters or 3, 4 quarters, whatever for the next year, I think in terms of valuation, it will still remain expensive while it has become more. It looks better now after the correction. EV by EBITDA 20 times, price to book 10 times. I would say that you could see a bit more correction. Even at these levels, I believe you could still sell half your quantity and average out again if it comes lower.
All right. And Nirav, what's the technical view? Like, Shaina pointed out, Suzlon has made some management changes. They're confident of growth going forward. What are your the technical view on the stock?
See, again, just looking at levels, there is a breakdown which has come in below the 46 levels. The stock can now correct a little more up to the 35, 37 levels, which is not very far, but yes, it can come down. So if you're holding on and your view is a little longer term, then you can look to average around 37, 35 levels when it comes there. But before that, don't average. It is likely to come there and then witness some bounce up to the 50, 55 levels. But as of now, the view is negative.
So as of now, the view is negative. Shaina and Nirav, thank you so much for joining us on the show and answering all of our viewers' queries. And with that, it is a wrap on this edition of Your Stocks. But do remember to email us your queries and we will address them with our experts. Stay tuned for Closing Bell to take you through the last hour of trade.
go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The GIFT Nifty is suggesting no relief as of now.
You know, the trading action, it's been painful. So no follow through on the upside, one day up, one day down.
The pure play MFIs like your Fusion, Spandanas of the world, they do stand to be negatively impacted.
25,450, it's about 0.25% down. I mean, you know, this essentially been one day up and one day down.
I think the new news now is this rotation within the AI theme.
Bihar is a reasonable part of our portfolio, but obviously we are spread all across the country. It's about 17% of our portfolio.
Portfolio is completely different, and that has perhaps ensured that we have been on a high volume and a revenue kind of a trend for the last couple of years.
So my feeling is that there's nothing to fear really about AI. I think the market is at this point just throwing the baby out with the bathwater. I don't think there's, but there will be new winners and new losers.
It's a tough Friday, right? A little unexpected from, it just looked like it would be another session of consolidation. But today we've breached the range that we've been holding on.
We are expecting a strong set of numbers on the wholesale front.
We are expecting, our poll said that it will be 7.7. That is the third quarter GDP, which is a little lower than the second quarter's 8.1.
It's still selling off. We're not out of the woods. There is no sign of formidable recovery from the lows hormones.
Well, the market's off the lows by just a tad bit, a pinch basically, nothing very much beyond that. This is Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. Next 60 minutes coming up, last 60 minutes of the week. It's not going well so far. So at 25,300 on the index. I'm Prashant. With me, my colleague Rima. Rima, hi.
Hi, Prashant. So today the 200-day moving average has gone on the Nifty. That was 25,350. But we haven't materially deteriorated below 25,300. We went down there, but we seem to be hovering around that. For the week now, the Nifty is down 1%. The mid-cap index, which was holding up in the green, has now given up all gains. Mid-cap index is flat, minor negative bias so far this week. And banks today are weak in trade, along with the frontliners.
Yeah, capital market index is down 2%. I'm just looking at sectorally where things are, right? I mean, so 2% lower on the capital market space. The real estate index is another loser, just about 1.7, 1.8% in terms of losses. And even though the IT software stocks all sort of jumped last night, here the recovery is feeble. I mean, just 1/3% gain on the Nifty IT index. But with that 1/3% gain, I think it is the third largest gainer. The consumer index is up 0.6 and the oil and gas space is up about 0.5% as well. So those are the three areas where there is a little bit of green. Otherwise, I mean, it's generally both on the upside and downside, volumes are thin. It's not unlike, last couple of days, volumes perhaps. We'll see what they are as by the end of it. We'll have a better sense. Let me just quickly run you through what's coming up here. So markets, of course, is in focus. And we'll talk about that. Broader market may be slightly better off. The auto index, auto sales are in focus because when we come back on Monday, we'll have the auto sales numbers for February. Remember, Sudarshan pointed out the Vahan sales registration numbers 2 days back. So recovery is expected to continue. NSE CEO Ashish Kumar Chauhan is pitched for a qualification criteria to curb over speculation in F&O names. Brokers are taking a bit of a hit. I think BSE is down about 3. And microfinance, of course, is the other story with regards to the news which came out of Bihar. And Utkarsh and Credit Access and Ujjivan and L&T Finance are seeing a bit of a slump at this point. So we'll cover all of those stories in a bit. How should you position yourself in the last hour? Mitesh is with us to run us through his thinking now. I mean, this is... it's been, as I was saying in the morning, one day up, one day down, and now it's down, Mitesh. But is it breaking down? Is the question. Is there likely to be follow through, which has been missing in either direction?
Good afternoon, Prashant. So I think you raised a very important point that will there be follow through, because we have seen Nifty, go through some sell-offs in the last a few occasions it's done that. It's kind of failed to close below 25,400. Today, we are doing that most likely. I mean, we still have an hour to go. But the way the charts are shaping, we are doing that. And therefore, I think we should now, work with the assumption that the Nifty is most likely heading lower. The first support is around 25,100, which is the high before the US-India trade deal was announced. And then we had a big gap up. So that's the starting point of the gap. And then we have a trend line support coming in closer to about 24,900, 925 zone. So I think these are the two targets which I'm working with. On the stock side, I have a sell on Kotak Bank. Keep a stop at 425, half 426. Look for targets of 404. And LIC Housing Finance is on the buy side, long trade with a stop below 530 for targets of 565.
What about Nifty IT? It's been higher for the last 2 days. But are you seeing enough momentum for further buying here and the continuation of the uptrend?
Not really, Rima. I think, the Nifty IT, it's higher, but it's like 0.3, 0.4% higher. And it did open higher in the morning, but failed to sustain. See, it's very oversold. So, I think there'll be these days when you'll have some short covering bounce and some pullback to the 10, 20-day averages. But the first supply pivot is around 31,500, which was the gap which happened on the 24th of Feb. Even if you cross that, I think very difficult for me to believe that Nifty IT, because on the medium-term charts, there is strong supply around this 32,400, 500 zone. So I think that's the maximum which I think the Nifty IT could do, but looks like more of a pullback or a bounce back after a heavy sell-off of the last couple of weeks.
Okay, Midesh, we'll connect again in the show. For now, let's turn our attention to the automobile companies, which will release their wholesale numbers for the month of February next week, starting next week, Monday onwards. Sudarshan joins in to tell us what to expect.
Come Monday, we'll have the auto wholesales for the month of February 2026. And like the indication we got from the retail data, we are expecting a strong set of numbers on the wholesales front also. And CVs and tractors will continue to perform. But we'll have to take a look if there is any impact from the commodity price rise that we have seen in the last few months. As far as the expectation is concerned, PV is seen growing by 12%. Two-wheelers may see a growth of 33%. M&HCV is likely to see a growth of 28%, and tractors may increase by 29%. Now, talking about the company-wise, Bajaj Auto sales may increase by 29%. Similar growth can be seen for Hero Motor, where growth can be of 34%. TVS Motor can see a growth of 26%, and even Royal Enfield can report a growth in the range of 13 to 14%. In the four-wheeler space, especially talking about the passenger vehicles, Maruti Suzuki can see a growth of 10%, Hyundai 12%, M&M Auto 17%, and the outperformer will be Tata Motors passenger vehicle. So the same indication we had got from the retail data also, and Tata Motors PV can see a growth up to 37 or 38%. In the commercial vehicle space, Tata Motors commercial vehicle can see a growth of 28%. Ashok Leyland can report a growth in the range of 23 to 24%. And in the tractor space, Mahindra & Mahindra tractor can see a growth of 29 or say 30% for February 2026. So like retail data, February auto wholesales can also be like very strong, and auto companies remain on a strong footing.
Thank you very much for that. Gurmeet Chadha is now joining in from Complete Circle on the last leg of this trading day and the week. Gurmeet, sluggish market, 25,300. What are you all making of the way the markets moved, not moved, headed lower?
Yeah, it's it's a touch surprising, Rima, considering that most headwinds are out. I think the macro dashboard of India is looking pretty solid. Whether it is banking credit growth, whether it is M3 supply, whether it is gross fixed asset formation reflecting private capex. The Q3 GDP numbers will be out, and I think there is a sense that it may outperform the estimate, maybe closer to 8%. And we'll also have the new series coming. Earnings growth has been pretty good if you take these one-offs through labor code, etc. So it is, but this is how markets are. I think it's also led by some weakness in some large names. It was IT most part of the week, and today it is more Bharti and some of the auto names, which is also, in my view, a little bit of an overreaction, and especially in case of Bharti. But this is what markets are. In bull markets, you don't react to negative news, and when sentiment is bearish, you don't react to good set of news. So that's how it is.
A bit of a slow burn. So on the auto sales numbers, good numbers expected, as Sudarshan was telling us. So we know now, you've spoken in the past about Sandhar Tech, Uno, Minda, M&M. You were looking at TVS Motors also previously. Any new ideas in the auto ancillary space beyond these?
So we are adding more to M&M, considering the recent, I would not say weakness, but minor correction in the stock. We've added one more small auto ancillary name. It's called Rajratan Global. They make actually bead wires. Their Thailand business got impacted post-COVID because of dumping from China. That stabilized. They've added another plant in Chennai that should contribute meaningfully next year in terms of both operating leverage and getting some scale. Valuations are very reasonable now. And I think the looks like we could get a 30% kind of an EPS growth. So that's the recent addition to portfolios. We are adding more to Sandhar as well because 60% now is TVS. And overall, numbers look very good across die castings, across cabins, which they do for trucks and commercial vehicle, as well as locks and some of the EV portfolio they are making. So all four verticals look pretty good to us. And again, as I said, valuations are reasonable. In fact, valuations are reasonable. A lot of pocket, almost 60-70% of BSE 500 stocks are down almost 30%. So it is a great time for stock picking. Probably, needs a little bit more patience and grinding.
This Tejas Networks, Gurmeet, have you all been analyzing it? Beaten down, stock has fallen from almost 75% from its peak levels. This NEC order, have you all managed to get in touch with the company or any idea about how material it's going to be? Because the stock has skyrocketed in the last 2 days.
You talking about Tejas?
Tejas Networks, yes.
I think the we have it in the portfolio. It's very small weightage, around 1% odd in the portfolio. We did add at slightly higher levels when the stock had corrected, and then it meaningfully corrected. I think one big order which can obviously is done too well through the recent orders. I think one big order was the 5G microsite order from BSNL, and typically it could be between 3 to 5 lakh sites, and one site is about 2 to 3 crores is what we understood in terms of when we spoke to a lot of vendors. In fact, one of our client is a sub vendor of Tejas, which in turn deals with that. But market needs to see numbers. Last 2-3 quarters have been very poor. They've been reporting losses, and some of there've been some misses as far as the overall digital infrastructure is concerned. So let's see. I think the big turnaround will happen once you get that 5G order from BSNL, and more clarity is awaited as on that.
Yeah, I think it's almost nearing 30% gains in 2 sessions, had fallen to about 300, now 434. So that is Tejas. It's Tata Group company, but it's of course suffered. We'll talk about more ideas because, as you said, lots of things have become more attractive valuation-wise, Gurmeet, in a bit from now. But there are comments from NSE CEO Ashish Kumar Chauhan, which we want to just highlight, which I think the market in the capital market space, I highlighted how the capital market index is perhaps the top loser today. Yash is here with what was said. Yash, take it away.
Well, Prashant, very interesting comments coming from the top boss at India's largest stock exchange, the National Stock Exchange, Ashish Kumar Chauhan, the MD and CEO of NSE, saying that it's high time that India adopts a minimum qualifying criteria when it comes to F&O or derivatives participation. He goes on to say that minimum qualifying criteria needs to be adopted so that the lower strata of the society doesn't lose money in F&O or derivatives trading, and India as a country, which is a developing country, cannot allow over speculation when it comes to this coming from the lower strata of the economy. Concluding this, he also mentioned that more regulations will come from government regulators to curb this very over speculation that became a center of this particular set of comments coming from Ashish Chauhan. He was speaking at the FIA conference in Mumbai while making these important comments.
Okay, well, I think the effect is there in terms of what we are seeing. Gurmeet, talk to us about what's on your mind. I want to ask you capital markets. We've discussed quite a bit, but that list in terms of what looks attractive.
So I think, Prashant, more action will come on some of the HFTs, extending what you said. I think look at what's happened in US on Jane Street. I think this is becoming a bit of an issue. Imagine 10% of North America volumes being done by one quant trader. I think this is concerning, and as I said, it's now spreading to silver, crypto, etc. So I think regulators across the world would be concerned on this, and I think more, and that's what is leading to uncertainty. Especially on exchanges and brokers and depositories. So while it's a great structural story, we continue to add more clients. I think for now it is good to be in the wealth management and asset management space. For example, Aditya Birla AMC is available at about 20 times forward versus the better ones like Nippon and HDFC, which are 30-35 times. Post Harish coming in as the CIO, there's been a great turnaround in equity schemes last 12-18 months. Almost, I think 8 out of 10 schemes are quartile one, and they also benefit from surge in gold and silver ETFs. The fund houses, because that's one category which is growing very fast, and the business is fee driven, less transaction driven, right? So that's something we've added recently to the portfolio. We are looking at some of the we have already have Noama in our small mid cap portfolio, so we are looking at more opportunities there. We have Grow, and on transaction side, Motilal and Grow look very attractive to us because there's been, as I said, at some point of time, Motilal, especially on valuations, because the AMC business would now be almost equal to the broking business a year from now in terms of EBIT contribution. So you got to be a little patient in this. It's a more long-term thing. But for now, I think better to be overweight on the fee and annuity-based business versus high transaction revenue proportion in the revenue mix.
Gurmeet, many of these recent IPOs have corrected. Like Urban Company is pretty much close to its issue price. Ather we've been talking about. Swiggy is below the issue price as well. But there's one company, Lenskart, which continues to attract so much buying. Year to date, Lenskart is up 20% in a weak market. And market capitalization still, what, 95,000 crore rupees. Clearly there were valuation concerns, but it's been shrugged off now by the street, and numbers were fine. They're showing operating leverage. Where do you stand on Lenskart?
We don't own it, Rima, but as I said, the unit economics is pretty impressive. We also want to see whether they can pivot from eyewear to other segments or not, because the network they are building, both digital and the otherwise, it's great. I mean, I personally ordered some lens, and I think everything got serviced within 48 hours. So the experience is pretty good. We need to see if they can do the same thing what, let's say, Eternal did, right? Moving from food delivery. So I think it's on our radar. But for now, we are adding more to Eternal. I think the little bit of weakness, one due to the Pinder's exit, second all this AI narrative, I think looks a little stressed to us. I think this business has a strong growth legs. Also Paytm, I think there's been a healthy correction despite very good earnings, largely because of the RBI discontinuing that innovation scheme which they had. So I think these are two things we are adding more to it in terms of the current price correction.
Yeah, no, absolutely. Gurmeet, you know the BL Kashyap chaps, Delhi-based company.
Yeah, we track Prashant, but we don't own it in our portfolio.
Yeah, it's up at 9%, 10%. We don't discuss it. I mean, it's a small name, very small actually. But they've built some of the most well-known marquee sites in Delhi in terms of buildings and so on and so forth for the last 20-25 years. But they ran into financial trouble back in 2007, 2008. So we'll see if there's anything happening here in that sense. Gurmeet, out of the other out of stocks that you watch, what else? Like Raj Ratan that you mentioned, what else is looking attractive?
So chemical space is looking very attractive, Prashant. I mean, almost like a 50% correction, most names maybe, except Naveen Fluorine. So we've added JG Chemical, which is into zinc dioxide and zinc recycling. 75-80% is end users tire, and automobile seems to be doing well. We have added more to Bharti, especially today. I think they continue to do very well. I think even if you see the data consumption per subscriber, that was almost up 11-12% quarter on quarter, almost 29 GB. They are adding very high pace in terms of broadband, which is the non-wireless business. Almost 1.2 million added last quarter, even in the broadband. So enterprise, wireless, broadband, all looking good. Nextra, I think they are already saying that their market share should go up from 12 to 25%, targeting 1 gigawatt. I think that's the best data center play. And if you see the operating cash flows now, it's upwards of 60,000 crores. So I think this concern on the injecting some money in Airtel Money over a period of time, looks a little overdrawn to me. So I think that's one stock where you will not see much cyclicality in earnings. And I think this is something we are getting over it now at these prices. I think it's really looking good.
Gurmeet, anything in the hospital space? I was just looking at, not large corrections, but some have fallen 20-25% from the highs.
Very expensive. Prashant, we do own Narayana, a small proportion in our portfolio. That also has run up quite sharply. And if you compare the metrics of, let's say, revenue per bed, and you compare it to hotels, not a fair comparison. It's almost 3 times now, right? So it's getting in that range, and this is one space, Prashant, where you can have regulatory intervention because healthcare is a sensitive subject. So, and with PE funds entering most hospital chains. This could become at some point of time a political issue. I'm not trying to speculate here, but the valuations are extremely rich. You're better off, as I said, in moving into branded generic, CDMO, etc., which are more structural in my view.
Okay, all right. We'll leave it there, Gurmeet. Thank you very much for joining us. Good chat as always. Appreciate your time here on CNBC TV 18. So that's the picture from Gurmeet on markets and what he likes. Well, we are back in just a bit. Rajesh Bhatia of ITI AMC on the other side for a conversation on markets. Rajesh, of course, looks at some of the micros, but has a strong view on the top-down macro picture as well. Stay tuned.
Fly Emirates, fly better.
Welcome back. Let's go across to Nigel now to find out what the F&O trends are.
Well, the Nifty is down close to around 200 points, but we haven't seen any big move up in terms of the India VIX. So you just pull that up. That's telling you that, the cause of worry is not that high in today's trading session. It appears it's routine profit taking and maybe the weaker hand still getting shaken out. At least that's the indication you're getting. The Nifty Bank, that's been under pressure. The last few trading sessions, it's bounced off 60,700, 60,800. Today, that's not happened. If you just look at the trend all through the trading session, it's remained around those levels. The tech index, that's trying to fight back, but it's not building onto those gains. Ideally, you like that to build onto gains to give you a further confidence. But Reliance Industries, at least intraday, that stock that was down 1.5%, that's moved towards the flat line. And that's one of the stocks is fighting for the bulls. Now, the PCR, that's normally one of those indications. Remember, it's moved to around 1 odd. That's come down to around 0.73 approximately because there is action on both sides. But the call writers, they're feeling very confident. 25,400 call. Just take a look at the premium. It's down to 67 rupees. At the start of today, it was 190 rupees. 25,300 call. The premium is down to around 100 rupees. At the start of today, it was 260 rupees. While what's giving you some kind of hope is that lower levels as well, there is some writing. 25,300 put. The premium out there, there is some sense of writing just in the last hour or so. The premium is around 90 rupees or thereabouts. It's important that the Nifty doesn't go too far off from the 200 EMA. Currently, we're trading below those levels, 50 points below the 200 EMA. So you'll want to close actually closer to that level and in fact above that level. Individual stocks in focus. On L&T Finance, you're seeing fresh shots being added onto that particular counter. Stock down, open interest up, as is the case with Angel One, some fresh shorting out there. There's a bit of a short covering bounce that's taking place on KEI Industries. And, post that interview that the management had with us here on CNBC TV, the street is building in that data center opportunity as well. So a bit of a short covering bounce to that one. Saman Capital has been gone to the F&O ban. And there is some mild unwinding of positions. So we'll have to keep an eye out on that one. But it continues to remain in the F&O ban. Back to you all.
Nigel, thank you very much for that. That's the positioning and where things stand right now. Well, I think Rajesh Bhatia of ITI AMC is with us with a quick perspective on things. Rajesh, good to have you with us here, and it's been a while. So let's just get the phraseology right, if I can use that term, which is this still a bull market, or this is bear market or a bearish market or a bearish phase? How are you describing it?
Yeah, Prashant, I think if you look at the price action, you could be forgiven for thinking that India probably is in a tough spot. We are probably lower than where we were 18 months ago in September 24. And in fact, we are probably at the same level where we were 8 months ago in June 2025. And mid caps and small caps are lower. You would be forgiven, therefore, to think that India must be in a very challenging spot as far as economy or earnings is concerned. Quite to the contrary, our nominal GDP is kind of bottomed out and growing. If you look at credit growth is very strong. The macro is extremely strong. We have had a very controlled fiscal deficit. Automobile sales are strong. So on and so forth. So if you look at the economic numbers, there is a good chance that actually earnings are bottomed out and are actually recovering. But yet the market is kind of lackluster. I think the problem is not of the fundamentals. The problem is really of the technicals of the market. First, I think the FIs are not as interested in India. You would have heard the phrase, India is an anti-AI play. I think Nvidia reported earnings 2 days ago. Their revenues grew 73%. Google reported an earnings growth of 18%. Emerging market earnings are growing at 20% plus. In that context, India kind of pales in comparison to the earnings growth trajectory that we have. So the excitement globally is more centered around the AI theme. Of course, also commodities are going up, which means that Brazil and resource-heavy countries are doing well in that regard as well. So to that extent, the FI positioning in India has probably become a reasonable underweight. So there is a technical challenge from their side that they're not as interested in India. And I think to some extent, given the lackluster market for over 18 months, I think there's some kind of saturation from the domestic investors as well. I'm not saying that they're redeeming in any very large numbers, maybe from some PMSs, etc. But definitely from the H&I space as well, you can see some kind of a saturation in demand kind of coming in. So it's a more technical challenge. I think on a fundamental platform, we are very, very well placed.
So technical bearish phase, Rajesh?
Yeah, I think that's what we're going through. And that's really the one which is difficult to call because, the earnings momentum, like I pointed out, 40% of your earnings is financials, and financials are definitely looking reasonably good now that there is greater clarity that interest rates have kind of will stop falling and may probably start rising as well. That bodes really well for banks. So, and that is a very large portion of the earnings picture. Telecom, capital goods, there is a lot of action on the data center, T&D side, defense capital expenditure side. So there is a lot of propensity for earnings to kind of accelerate as you move forward. But I think it's not even valuations which are for large caps at least, which is a challenge. I think we are moderated there as well because we've had 18 months of consolidation where earnings have grown. So to some extent, our earnings picture, our price earnings picture is also looking reasonable. So more of a technical challenge rather than fundamentals.
But then every bear phase can be described as a technical challenge, right, Rajesh? You would agree, you've seen markets enough. I mean, we'll come back and talk, we'll get your thoughts on IT, etc. as well, in terms of what to do if there is something to be done, and of course other sectors. But allow me a small detour. Hormuz is standing by as always with what stocks are moving. I mean, the unusual stuff with volumes, etc. But of course, the returns that we've seen in the month of February as well is what he's starting with. Hormuz, take it away.
Well, this was a month of extremes, and the biggest extreme is in a month that had the biggest single-day gain for the Nifty in point terms after the trade deal was announced. The returns this month on the Nifty is 0. Now we closed on the 30th of January at 25,320. We are at similar levels even as the month is coming to an end. But the breadth of the market has been the talking point, right? Even at the end of the month, the 34 stocks on the index have delivered positive returns this month, and it is only because of the underperformance of the IT names and other select large heavyweights is the fact that the Nifty return this month has been 0. The broader markets have fared slightly better. Almost 60% of the mid-cap index is positive. The small-cap index is split right down the middle with a 50-50 return ratio this time around. You take a look at the best Nifty mid-cap performers this month and you see Hitachi Energy making a comeback. It's not all gloom as it has been projected to be. There are certain pockets that have done really well. Hitachi Energy is up almost 40% this month, the best month it has had since April of 24. Bharat Forge is up 33% this month, the best month it has had since July of 2009. And KEI and Polycab, as Nigel was highlighting as well, best month since March of 22 and July of 23, both of them among the top performers. And Cummins as well, that capital goods theme making a bit of a comeback this time around. But take a look at the underperformers. Of course, we know for a fact that both the small cap and mid cap, the worst performers have been IT. But ex-IT, Bharat Dynamics was down 17%, the worst month since February. Of course, that was after its results. Muthoot Finance has seen some profit booking from record high levels, and IDFC First Bank, after the recent fiasco that happened, the worst month that the stock has had since October of 2023. Now, take a look at the small cap names, the top performers here as well. Amber Enterprises, while Dixon has been a bit of an underperformer, Amber is up 40% this month, the best month it has had since January of 24. Tejas Networks, the worst performing stock in 2025 among the small cap space, is the second best performer this month with 26% returns this time around. Aarti Industries is up 21, Data Patterns is up 19, Natco is up 18 as well. So there are mid-cap pharma as well has done fairly okay this time around. And the one common theme among the underperformers ex-IT in the small cap space is that all of these names have had their worst month since February of last year. All of them had a terrible February of 2025 and they have had an equally bad February of 2026, if not worse. And Ola Electric now down to 25 rupees, Brainbees, Jupiter Wagons, Hindustan Copper after that record run in January has seen some profit booking from higher levels. So all in all, if you can summarize the month gone by, choppy, yes, returns not quite, but then there are select pockets that have done really well.
Okay, thank you very much for that. Rajesh, you want to come in on this data that Hormuz has presented? Very elaborate, lots of numbers to pour over and think about. But anything that stands out for you?
No, I think, as he clearly pointed out, the data center story stocks have done extremely well. He talked about one stock which has done well, which is linked to the commercial vehicle and defense industry as well. Again, commercial vehicle numbers are extremely strong. And one is on the HVDC capital expenditure, where the visibility seems to be extremely strong for a multi-year period. So yes, those themes have kind of done well because there is a lot of visibility on how those businesses are doing, not only now but for the next 3-4 years as well.
Just a quick word on the market. If you can just quickly look at it. Wow, there is a very sharp sell-off which has happened. If you can pull the intraday up, I think 25,300 to 25,200, I think in a flash, literally a flash. So 301, there you go. That's I don't know if you can expand or show you, a close-up. You'll be able to see what I'm talking about. So 301, that's 3:01 p.m. We were at 25,310 and we've lost 100 points in 1 minute. I'm not sure what has happened, but this is a very, very sharp cut.
I'm not sure if it's connected, but the MSCI India adjustment is supposed to take place because there is no expiry today. The monthly is done. There is no weekly expiry. But the MSCI India February 2026 adjustment is today, and the net expected outflow was estimated to be $260 million. And some stocks which got added were Aditya Birla Capital, L&T Finance, weight up in AU Small Finance Bank, a deletion of IRCTC. So I'm not sure if it's connected, but that's one event, the adjustment taking place starting 3 p.m.
Possible. The Bank Nifty at 301 was at 60,790. And here we've lost about 200 points. 200 points on the Bank Nifty in about a minute straight, and about 100 points on the Nifty as well. So these are very, very sharp cuts which are coming through. Rajesh, any thoughts, any idea what's going on?
No, not really. But as I said, probably it's a technically challenged market. It falls on small volumes also. That's what we have noticed. And therefore, at least in the last 2 months, what I've been noticing is the volatility in the market has certainly accentuated.
Yeah. Volatility on the downside, unfortunately, that is the problem, right? So 300 points now on the Nifty. We were down 200, we are down 300, and all of it, the entire picture has changed completely, very, very quickly. Look at the market breadth, a clean 2:1 now in terms of declines to advances. So some near 2,000 stocks are lower, and about 1,140 stocks are higher at this stage. And maybe I just quickly look at the index movers, right? Maybe the Nifty, which are the stocks which are exerting the maximum pressure, contribution-wise. So it's ICICI Bank, it's largely banks, ICICI and HDFC, top contributors on the downside. But you also have Bharti, Reliance, Mahindra, Sun, which are in.
Reliance intraday should come up because it mirrors the fall that we're seeing. So Reliance was flat. And now it's down nearly about 1%. So that's one heavyweight dragging.
Yeah, we'll talk more about this as we kind of go along. But yeah, we got this is here or now. But Rajesh, as you said, right? Well, this is a market where there is, fundamentally things are not looking all that bad. So where are the opportunities in your opinion?
So I think auto is reasonably strong. All parts of auto are actually reasonably strong. I think it's time to get into private banks. My sense is they've underperformed relative to PSU banks and NBFCs. My sense is that there is not only value there, but there's good reason to be there as well, as you move forward. I think you talked about a telecom stock that has come down. I think there are some capital allocation issues that were bothering investors. I think the management had a call with global investors on Thursday, if I'm not mistaken. And I think they've assuaged some of those as capital allocation concerns. My sense is predictability is good there. And like I said, I think the capital goods space, particularly on the data center side and the T&D side, is also looking very strong. So again, those are good places to be in. That's where the predictability is. I think people want to be now in predictable business models and where they can see visibility of growth. I think these are good pockets to be in.
Thank you, Rajesh, for joining in. Bharti Airtel, the stock where there are capital allocation concerns, the telecom play, now down 14% from its high that it hit in the month of November. So some unwinding visible there. The company has committed to 20,000 crore of capital for its NBFC push over the next couple of years. Of that, 70% comes from the company, 30% from the promoters. Mitesh is now back with us because the market is unraveling very fast, 25,150. Mitesh, are we approaching support levels? I think you spoke about 25,100. As the immediate level?
We're not very far away from that. So I think, as I said, that trading below 25,400, was slightly suggesting that this decline could possibly accelerate. Now, even I'm trying to figure out what's happened because the last 10-15 minutes have been very violent. But broadly, 25,100 and then 24,925 are the two levels which I'm watching. I think looking at the speed, 24,920 also looks like a possible target over here. So be prepared for, I think, slightly a bit more of fall over there.
But now that we have only 20 minutes to go and then a weekend, there is no trade which is advised.
The idea is that the trend is on the downside. So if you're taking any trades, take them on the downside. So I'll have a STBT on LIC of India. Keep a stop at about 857. Look for a target of around 830. And L&T Finance also appears to be breaking down. There's also a big jump in volumes today. So that's an STBT with a stop at 286 for targets of 277.
Mitesh, if you can stay with us, right? Let's get in Nimesh also because he's also been making phone calls. And Nimesh, this is last 5-7 minutes. I mean, we were down 200 and then another 100 now, 150 actually. So what are you picking up?
No specific reasons so to speak, for the last 30 minutes of fall, because even from a flow perspective, there was no sense of that there is a last MOC sell or a big selling or something of that sort. Today, the volumes will be on the higher side because of the MSCI rebalancing. A lot of the flows which have been reported in the morning was because of the MSCI flows as well. So really no sense as to how the flows are going to pan out because there's a lot of MSCI angle to it in today's flow perspective. But X of MSCI as well, my sense is that while the Nifty Bank is down almost 450-500 points, there is buying in select private bank stocks in today's market from a flow perspective. So that's clearly the feedback there. The broader market breadth has been a bit weak today, and there is a general sense of lack of buying interest from larger HNIs and large family offices in the broader market, and that's been because of the March factor as well. So maybe for the next 2 weeks, you might see that pressure in the broader markets to continue because of the unwinding of the book and all. If you look at for the last couple of days, the institutional data is strong, but still the market has fallen off late, largely because of the supply, because of the MTF book unwinding and the retail and HNI selling out. So that's clearly playing out in the broader market, so to speak. And also the fact that the supply of paper has picked up, right? Today we saw a large block in Vishal Mega Mart, 7,500 crores block. In the last couple of days, some large blocks have happened. So that's sucking a bit of liquidity from institutional investors. But broadly, today I guess the volumes are largely because of the MSCI rebalance. So no specific intel, except for the fact that a bit of buying in private bank stocks.
So no discernible reason at this point in time, and no real big headlines which we've been able to pick up, which perhaps, so there's not news based in that sense, at least not we can see right now. So 25,170 on the Nifty right now. In terms of specific names, Nimesh, what's on your list?
Well, for the first on my list is Bank of Baroda. It's been buzzing off late. The PSU Bank as a basket has outperformed, and so is Bank of Baroda. But now I understand that there could be a QIP very soon. So watch out for a big fundraising in Bank of Baroda in days to come. So that's the first name. The second name is IDBI Bank. In a very volatile environment, the stock has been rock solid and consolidating in that range between 110 and 115. But again, the street is anticipating that the government stake sale should get announced very soon in IDBI Bank. So that's a trigger as far as IDBI Bank is concerned. The third stock is GMR Airports. It's actually recovered post the Q3 earnings. The numbers were strong. But now I understand there could be a large block deal in GMR Airports very soon. The non-promoted entity is a likely seller. So the promoters are not involved in the stake sale, but one large FI investor could be a potential seller in GMR Airports. And the last is a couple of stocks where there is delivery-based selling today, Ashok Leyland and JSW Infra. Both the names will see high delivery volumes on the sell side because I understand some large funds are sellers in both Ashok Leyland as well as JSW Energy today.
Yeah, okay. All right, so Bank of Baroda, IDBI, GMR, Ashok Leyland and JSW Infra. some of the names. Nimesh, thank you very much for that at this point in time. Well, I think we'll take a quick commercial break here, and we'll continue to report on the sell-off that we're seeing. We're down 300, so a little bit of recovery from the lows. Come back in just a bit. More coming up.
Welcome back. The sell-off seems to have stalled around 25,150, now trying to climb above that level, but it's still down more than 300 points for the day so far. And the major part of the selling coming through in after 3 o'clock, half of it. But one big segment of the market which has been weak has been the MFI stocks, and they slumped after Bihar introduced the microfinance lending bill, which as per IIFL Capital is more stringent compared to what was introduced by Karnataka. Listen in to IIFL Capital's analyst Viral Shah on the impact on individual stocks earlier today.
So the pure play MFIs like your Fusion, Spandanas of the world, they do stand to be negatively impacted. You have SFBs like Utkarsh, you have even Ujjivan who have higher exposure in those geographies. So they also stand to be negatively impacted. Even L&T Finance has 20% of its MFI portfolio there. Basically the recovery that we all were anticipating in MFI, because of this kind of gets pushed back by a couple of quarters.
Okay, that's at the analyst view. Let's get a management perspective as well, right? L&T Finance management was with us and we asked them about Bihar, their exposure. Listen in.
Bihar is a reasonable part of our portfolio, but obviously we are spread all across the country. It's about 17% of our portfolio. If you see our collection efficiency, for example, our collection efficiency this month, we're just one day away from the close of the month, we are upwards of 99.7. So overall, I do not expect a major impact on L&T Finance's go-forward strategy as well as our collection efficiency in Bihar. But the fact is that we'll have to study the statute in greater detail together with our and await guidance from the MFIN, our SRO, and then take our according steps. I do not expect any major impact on L&T Finance.
No major impact, but the stock is down close to about 5.5%. And even the other ones that Viral was talking about, Utkarsh, Spandana Spurti, all have sold off sharply. Anand Tandon is now joining in. Anand, you want to comment on these stocks?
Well, what is there to comment? You know, whenever you hear a management say it doesn't matter, it means it matters a lot. You can't really expect them to say that, oh, you know what, we are going to be in dire straits because now we will not be able to recover and our recovery will fall below 90%, which means that we basically lost it. So, you know, you have to ignore what the management says, much like you have to ignore what fund managers tell you when the market is going down, that these are only technical factors. The fact of the matter is that despite the fall, you are still unable to find sectors which you would like to be in, which are cheap. You know, you want to be, let us say, in capital goods. You cannot find a single stock which is affordable. You want to be, let us say, in, for example, telecom. The telecom leader trades at 35 times, which may be okay from a historic perspective when it was growing at that kind of rate. But for it to continue to grow is going to be a little more challenging. But despite that, you know, those are the kind of companies you want to be buying into. Most of the other spaces that you're looking in, whether it is consumer and so on, are growing really slowly and don't justify the PEs they are in. So the only other place you go back to is things like banking and, as I said, capital goods and maybe some of the smaller space. Basically, the second-hand economy is the way I would define it.
Just want to play out a few more bites. Anand, coming to you. This is at the Rising Bharat Summit. So there was Ramesh Damani, Madhu Kela and Vijay Kedia with their perspective on exactly this. I mean, AI disruption. But of course, I mean, this is not limited to IT services, although that sector was also mentioned and discussed. Listen in.
My feeling is that there's nothing to fear really about AI. I think the market is at this point just throwing the baby out with the bathwater. I don't think there's... But there will be new winners and new losers. But as the Honorable Minister suggested, there's a multifold of opportunities coming up. And I just like to say what Charles Darwin said when he wrote the book of Evolution, The Origin of Species. He said it's not the strongest species that survives, it's not the most intelligent species that survive, it's the one that is the most adaptable to change. So if Indian tech industry adapts to change and don't ostracize, and there's some reason to believe that they are changing, I think the tech industry will come back bigger, stronger, more vital, as happened in so many industries before us, whether it's music or whether it's hotels. Digitization has been a huge power changer. So I think there's something to fear. It is a profound change. But I think the market is throwing the baby out of the bathwater. Having said that, other than the tech sector, whenever I go and visit companies or knock on doors, I see no reason to be bearish.
Technology has never made societies poorer, right? But at the same time, there will be Apple, Nvidia of the world which will come up, and there will be Blackberries and Kodaks of the world also, which will shrink, even though they being such significant large companies. So there will be clear winners and losers in this game, even within the IT companies. You know, people who can really adapt to this change, and the change is coming much, much faster than we can envisage, because see, AI is generating AI in itself, right? So pace of change is very, very fast. So I'm sure there will be winners and losers. So you can't paint everyone with the same brush.
There is it is like a catch-22 situation. I read somewhere, like if you are not investing in AI and all, then chances are that if you are investing, suppose blindly in AI and all, chances are that you will lose your capital. At the same time, if you do not invest in AIs and all, chances are that you will lose your company. Then you have to decide whether you are happy with losing your capital or you are happy losing your company. So this is certainly a wake-up call for India and for the entire world, and mainly for India. But I personally feel that ultimately we will rise to the occasion. I think we will also find our own way and to deal with this situation.
Welcome back. 3 minutes to go, and the tally for the week is down 1.5% on the Nifty. The mid-cap index is down about 3/4 of a percentage point. The Nifty Bank is down nearly 1%, and the IT index, despite the recovery yesterday and today, is going home with a cut of about 4.5%. Anand, you said hard-pressed to find stocks which offer value even after the sharp correction that we've seen. So many mid and small cap companies are down 40-50%. Tell us, maybe not, you can't find abundant, many stocks which offer value, but there must be a few. So tell us those.
Sector that you might look at is pharma and even perhaps commodity or specialty chemicals. One, because of the PLI schemes that have now come through, and because of the new set of generics that will be coming into the market, like Ozempic and so on, should be a reasonably strong growth that might be possible in that sector, and very hard to kind of worry about IT when related to these things. So that would be certainly an area one should look at.
So who's best placed to capture the generic Ozempic opportunity, weight loss drug opportunity?
I think the best place would be probably, again, the likes of Sun Pharma and so on. But there are smaller companies as well who are perhaps using slightly more riskier models, but are perhaps also not poorly placed and have some of those things, companies like Natco and so on. Remember, these are not recommendations. I'm just saying that, that's an opportunity that to me appears to offer a possibility of stable to increasing returns over the next few years.
And you want to tell us your commodity strategy?
Don't have a commodity strategy. There are very few companies you can play with in India which make any sense. Steel is totally protected, so you can buy domestic steel. Aluminum is still a global commodity, so I would stay away from it. You can't really buy anything else of any meaningful value.
So domestic steel companies would be preferred in the entire lot?
But, I don't like companies which make profit only because the government is protecting that. So, by and large, I try and stay away from those sectors.
Okay. We've got a minute and a half to go before we wrap up today's trading session. And it looks like the fall which took place, the steep fall, was between 3 to 315. After that, at least the correction has ebbed. But we're still down close to about 320 points on the Nifty, with large cap names like Adani Enterprises, Dr. Reddy's, Maruti, HDFC Life seeing a cut of about 2.5%. Add Bharti Airtel to the list, a stock which has fallen nearly 5% so far this week. Anand, any thoughts on Bharti Airtel? Big wealth creator, in a good position with sort of a duopoly between Bharti and Jio. The street has punished it because of this NBFC capital commitment that the company has made.
I think it remains an attractive position to be in. Like I said, telecom is certainly an area that can perhaps benefit. Also because of the fact that, whatever else we do, we will need ways to get data through if you're using any kind of AI, etc. And most of them have actually now, they will have capital. Now, whether they look at investing it somewhere else or returning it back to the investor is a different matter. I don't have a particular problem with companies investing capital to continue to look at new businesses.
Closing last couple of seconds, I just got a message from when it's obviously in lighter vein, but saying that market fell today because today is International Polar Bear Day. Apparently it is, but no real reason so far. There are also some reports that maybe with what's happening with the standoff between US and Iran, although talks are scheduled for next week, US personnel in Israel have been asked to leave. But, we're just trying to connect the dots. It's not as if global markets have sold off in any sharp way. The market, all this happened, the market was down 200 and it lost another 100 points in the last, 10, 15 minutes or so of trade. So that's basically it. 25,184, I think this is the final closing seconds. And we are down 312, 1.25%. Nifty Bank is down 1.25%. Mid-cap index is down 1.25%. Small-cap index, etc., will come up on your screen. So 2,700, 2,650 stocks are lower and about 1,870 stocks are higher. And, as I was saying earlier, the 4 days did not make a difference because still Monday, Tuesday, Wednesday, Thursday, it was 1 day up, 1 day down. And you looked at change from last Friday to Thursday, it would have been basically nothing because Every day got cancelled out by the next one, but today made a difference. And that's the reason why, if you look at the weekly change, which is Friday to Friday, we are down about 1.25% on the Nifty. By the way, the IT index managed a 50-point bounce, but guess what? For the week, the Nifty IT index is down another 4.5%. So absolutely damaging session, damaging week once again for the Nifty IT services index. And of course, I mean, lots of single stock movers as well. Some news related. IDFC First was down 12-13% for the week. UPL was another big casualty. Markets did not like that deal which had happened. Tejas Networks over the last 2 days rallied about 30%. That turns up on the NSE 500 as one of the top gainers this week. So yeah, I mean, single stocks, some action, but otherwise, Friday, I mean, really turning that ranged trading that we've been in a more decisive way on the downside. We began this session and was saying that we are in a lower high, low kind of a framework. So perhaps the weight of evidence suggests that the market perhaps has got some downside, but that showed up in a real way. 25,178, and we are done this Friday. It's a wrap on this edition of Closing Bell. Editors Roundtable will discuss what lies ahead in just a bit.
The Wall Street ends the week lower with all the major indices seeing cuts. The Nifty and the Sensex fall 2 percentage points each. The mid-cap and the Nifty Bank do mildly better but still lower. IT realty stocks were the top sectoral losers, fall 4% this week. Now, over the next 30 minutes, we'll decode the week on the Wall Street. We'll put the spotlight on the FIs and inflows, and is there hope of a turnaround in the FI outflows? Do they become inflows? Hello and welcome to another edition of Editors Roundtable. I am Reema Tendulkar. With me, our animation Nigel, and joining us here in the newsroom is Sanjay Parekh, founder and CIO, Soham Asset Managers. Hi guys, afternoon. If you'd seen the market till Thursday evening, the tally on the Nifty was absolutely flat. And then came Friday and the entire picture changed. 200-day moving average gone on the Nifty. And there was a big correction in the market, 300 points down.
Broadly, in fact, not only Nifty, Bank Nifty, broader markets, everything was down in this market.
So Friday just changed the picture
specific
completely.
reason, right? Yeah. In fact, the fact that today was an MSCI rebound flows, it was supposed to be positive flows and all, but still, it's a very confusing market. I talked to so many investors, HNI desk and all. I guess it's fairly lack of buying interest now. I mean, everybody seems so tired now. They've seen lower levels, and then from there it goes further lower down. So I think it's a bit of sentiment as well, which is clearly playing out in the broader markets. Maybe it's a March factor as well. You see a lot of MTA book getting unwind. The retail and HNIs, sell their positions. So I guess that's playing out in the broader market. So hopefully by third week of March, things should settle out in terms of the adjustments as well for the March.
So one guest said that, on the channel, he said the DIIs, HNIs, the big family offices, there's just saturation in terms of buying, as you said, right? And the FIs are still seeing better growth opportunities elsewhere. We had so many big tech companies, for instance, reporting numbers, and they're all, Nvidia is growing 65, 70%. So then you are getting better earnings prospects outside.
That's right. Sanjay, let's find out how are you feeling about the markets. The broader pulse you were getting just a couple of weeks ago was that economy is doing better.
Yes.
So hopefully earnings as well pick up. And quarter three wasn't as bad. So quarter four will actually be better.
Yes.
But it's not matching up with what we're seeing in the market. FI flows were good as well. But the market is not moving up. That little fatigue is setting in, it seems so. How are you feeling?
I think first on the earnings. So the earnings Q3 for Nifty was like 8-9% growth, which was in line broadly. But the macro indicators were starting to look better.
True.
So if you take CV, we met Ashok Leyland said in certain segments the growth is 60% in certain segments.
Yeah.
Passenger vehicle, credit growth at this inflation rate.
Right.
14% is at this inflation rate. So
Right.
it's pretty good.
Beautiful.
So we met ICICI, HDFC Bank, they're also talking of slow recovery. So, and you take cement, steel, things are slowly getting better.
Yes.
So this should logically show up in fourth quarter earnings growth rate is what I feel. The behaviorally, yes, clearly within EMs, EM has done quite well from April 25. But all the money has gone to South Korea and Taiwan. It's an anti-AI trade which is on. And then we had this whole carnage of IT stocks, which would certainly have a rub-off effect on other markets.
Right.
So that's what I think is happening near term, but actually fundamentally things are getting better.
We have to talk a lot about IT, and I'm sure Reema will have a couple of questions on that front. And talking about Korea and Taiwan, we were talking about how a couple of stocks there have 30 to 40% of the index. But we'll get to that in just a bit. Yes. Just a quick question with regard to the economy looking better.
Yes.
If I look at your portfolio construct, I think 70-75% is in large caps.
Yes.
And around 20-22% is in mid as well as small caps.
Yes.
Now, if things start looking up on the economy front and if earnings come back, will you be tempted actually to put more money into the small and mid-cap names? Because they have got smashed out of shape and they could relatively do better. Your take?
Yeah, I think, it's bottom up. It's only, I was just talking to Nimesh and I was telling that now just that, when there are B2G companies where cycles are longer, you're not sure about the high leverage in mid caps and commodities, clearly no. But the rest of them, there would certainly throw up opportunities. So we are surely looking at it right now, but we are just saying that let's keep a margin of safety higher because somewhere somebody is redeeming, somebody has pressure, then why not take advantage of it? And just go slow on weightages. So our weightages that we'll put on the block will be more like slowly nimbling into mid and small cap, but there's clearly next 3 to 6 months you'll get opportunities.
Okay. So Sanjay, within large caps, what are your top bets? Like where are you putting your incremental money to work? It's banks or commodities?
So our positioning has been domestic overweight, global underweight. It's been almost 3.5 years.
Yeah.
IT has been a big underweight, which has helped us. Oil and gas is underweight. FMCG, we are zero. The rest, domestic discretionary, we are overweight. Financials, we are overweight. Neutral, banks just mild underweight, but NBFCs, we are overweight. Telecom, we are big overweight. Ports, logistics, we are overweight.
Sure.
So, and industrials, we are overweight. And cement, we are overweight.
So your portfolio has done well? I mean...
Yeah, I mean, luckily, we've been more like 21, 22% on 1 year. But more than that, the longer term, we've done more like 20.5% compounding with 6% alpha.
But the question on, technology, we keep asking everyone, right? The conversation starts and ends with AI right now. And the thing is that over so many tech cycles, you've had companies which have gone bust because technology makes certain businesses unviable, like Kodak, BlackBerry, or whatever, BlackBerry also. Okay. The fear is right now you don't know which one is going to be the winner, which one is going to be the loser.
Absolutely.
When there is that kind of a question mark on who's going to survive, what do you do?
Yeah, I mean, see, the honest answer, as Howard Marks says, you should know what we don't know. While we did a lot of work on both the sides, whether it's benefiting IT services, and on the other side, what are these IT? 4 hyperscalers are going to spend $600 billion. They have contributed 50% of the GDP growth in US. So it's a pretty large spend they're doing, and the business models are evolving, according to me. At least, the revenue is what they're expecting. There are huge losses, and market shares are changing because there are new players coming in. So those, at least, it's not in our domain, but they will affect our companies like what did Cloud did or to our IT services company. So there, at least, I would respect Mr. Nandan's presentation where he did say that we're looking at it as an opportunity more than, cannibalization. The opportunity is pretty large. And we just, as you said, we're just trying to understand the piece. There certainly will be tailwinds and headwinds. But for now, at least...
Have you been able to identify any stocks?
Yeah, so what we are seeing is, today Infosys is at an implied growth rate of 2%. TCS has an implied 10-year growth rate of 2%. Now, we have to ask questions that, is that so bad? So one broad comfort we are getting from all the meetings that we did recently in conferences that we don't see a downside from here, at least, with 6%, yield, FCF yield, and I don't know the tactical positioning of bouncing back, but at least we believe downside is limited. But having said that, we don't have the courage to increase our weight.
No, but Sanjay, you all have been spot on with regard to allocation. Yeah. Because on tech, I think you all have 4-5% weightage. Yeah. The benchmark is at around 10-11%. Yeah. On metals, you all are overweight. Yeah. So kudos on that call, because I recall, asking you many months and not much was happening, and then boom, you made some good money. Yeah. Since you're so underweight, and if you believe the downside is protected from here on, yes, will you be looking to at least go more to a neutral stance rather than being underweight on these tech companies?
Yeah, so I'll be honest, Nigel, it's very difficult of how will it shape up in terms of earnings. It's not easy. And I'm telling you, we met enough experts. Those who have invested in cloud, there was an authority invested 1 year back at $58 billion, and now it's $300 billion, right? And he put a $300 million check, and we met him. And you see that side, and you feel you will not touch IT. And then when you hear Nandan, you feel no, there is, and so it's a dilemma we are also going through. But at least we believe that downside from here
could be
is quite limited.
Argument a lot of people are saying that the downside is limited, but if there is no potential upside, and that happened with a lot of stocks, like the blue chip of blue chip, HDFC Bank, from 2020 to 24-25 has given zero returns. Yes. Blue chip of the blue chip, and they made tons of money in the last 20 years for a lot of investors. Right. Is that going to be the case for IT as well? That it's flat and it just languishes for good 2-3 years with zero returns?
Yeah, I mean that's exactly why we're not trying to increase weight. Yeah. That we're just trying to understand. Let's understand more. Let's get a better grip of it. I mean, I've looked at IT for 20 years, but I yet feel I need to still understand it better in this change, So while we got it right first time, but now it's more important to get it right again. So we're looking at persistence.
What would be the inflection point? Yeah, exactly. So what would be the inflection point for you to really turn positive, especially in mid-caps like Persistent, Coforge, or for that matter, Mastek, has now come to almost 10 times 1 year forward earnings, right?
Yeah,
so
I think
one is,
look for? One is once we have a quarter, there will be a proper commentary. They've had several calls done, but one is that, and it will not get to know in 1 or 2 quarters, because this is not a problem of 1 or 2 quarters. It's about terminal growth rate, and after 2 years, as you also cover it. So I think one is engaging with them. That's the only way you understand. And then, then at a point, even markets will give you some signals, right? And then pick up that point.
Okay. Nimesh, one signal, one data actually that the market is telling us that the FIs finally turned buyers in the month of February.
Oh, absolutely. So that's a big data. In fact, it's not about India turning, FIs turning positive in India. Since the beginning of the year, the flows have been quite strong in the emerging market as a basket. Only point was that India was not getting that fresh allocation. That has turned in the month of Feb. So month of Feb till now, the FIs are putting close to $2.5 billion into Indian equities. So it's been a remarkable change from what the stance has been. And I guess one of the reasons for that is the fact that India saw both the deals got done, right? The India-US deal got done, and even the EU deal got done. So from a tariff point of view, that big overhang for the global investors was not there. And I guess that was a key trigger for the flows to turn positive. So having said that, if you look at Y2D, just from January to now, FIs are still net sellers of close to $800 million in the Indian equities. The biggest inflows have gone into Taiwan, which is $10 billion Y2D. Since January to now, Taiwan has seen $10 billion, and that's the reason why Taiwan has actually outperformed as well across all the markets. And South Korea, on the other end, has been the biggest outperformer of close to $7.5 billion of net outflows from the South Korean market. So that these two markets stands out, and India, of course, has turned a bit positive on that side. As I said, even if you look at the global, global markets, whether it's US, Japan, Europe, and EM has been seeing inflows for the last 3 to 4 weeks, and that's close to $3.6, $3.7 billion. So net, EM was seeing inflows. Now, for the first time within EM, India started seeing inflows as well. And as I said, one of the triggers has been the EU and the US deal. I guess earnings have started picking up. Q4 is going to be strong, so that's also a bit of a kind of support for FIs to turn positive. And now what is happening is you're seeing that supply coming in from domestic, either DIs or retail investors, which are feeding into the FI buying. So I think that's also helping FIs to easily buy without any impact into some of those large cap names. So that typically says and turns up that FIs have turned net buyers for Indian markets.
Do you think this trend will sustain, this FI buying, or it's
a tough one? Because still EM, I really hope it happens, because domestics have been stabilizing it. But when you see an EM price earning, it's 13.5 times. Yeah. And of course, concentrated by few bets, and historically the price earning have been 8 times in certain markets. So we will always be at a premium, which has been more like 50-55%. But it's important we get our growth back, and there is still not enough evidence of it. But if we get growth back,
and 15-16% is good enough, you think, if we get there?
I think for us 15-16% on this base for the next 2 years, because the base is low, and next year when I see earnings, there can be real contributors. So you have a tailwind of both the trade deals. Then you have banks whose NIMs were under pressure, interest rates almost is bottomed out. So we can be a big contributor to growth. Of course, IT could be a drag on earnings.
So Sanjay, this entire earnings argument, one of the argument is that the next year earnings are largely going to be driven by commodities.
Yes.
And in a typically commodity-driven earnings growth, you don't get the P.
Yeah.
So, because it's cyclical.
Yes.
So I think that's again going to be a challenge, because IT will drag, a lot of domestic cyclicals will drag because of rising commodity prices.
Yes.
Autos will drag a bit. So how do you map this? And also the fact that this, even in Q3, the strongest earnings came in the broader market. The small caps grew the biggest in terms of PAT growth and top line growth. So it makes more sense to get into small and mid cap now?
Yeah, first is I agree that the composition of index and the valuation, and from growth, where is it coming is important. Yeah. And we do it simple. For us, growth at reasonable price, our portfolio price earning has to be lower. And it's luckily we are 16 times. On mid and small cap, I again feel that, bottom up. Now it's the time, while we have a large cap bias, but one should certainly look at plays, because there are certain plays, and we are having a list ready where we want to buy at a price, but we want to have a higher margin of safety.
Okay, all right. Sanjay, request you to stay with us. We'll just slip into a short break, come back, and we'll continue talking about the week gone by and how Sanjay views things going ahead. Stay tuned. Welcome back. You're tuned in to Editor's Roundtable here on CNBC TV 18. Well, Sanjay, we're talking about a couple of sectors where you're underweight. Capital goods is a sector that you've been overweight.
Yeah.
You're like that space.
Yes.
Give us the thesis out there. You've got some unconventional calls as well in there, besides the big boy L&T.
Yeah.
You continue to like that even from here?
Yeah, I think, for the government to recover, the problem was not center or RBI also supportive, the states. So there, it's already in a base which is very low. Things only get better. But there we are cautious that the working capital cycle, we don't want to get stuck up. So we have one Larsen & Toubro, which is a large conglomerate, which is a play on domestic and global, which has worked very well for us. And then we have Interarc.
Bilcon.
Yeah, Bilcon is a small weight, where I think there's still worries around working capital cycle. While we own it, but I'll still feel there are worries there. Interarc has a very short cycle, very, very efficient. There's a huge opportunity. A small player can get really large. Return ratios are good. The project gets over in 9 months. So that is what we like. So overall, and then utilities, we are overweight. So through transformers and JSW Energy is what we
Merchant power.
Sanjay, you spoke about, you've identified the list of stocks that you might look to buy. But just the learning of the last 1 year, I know some of the mid-cap names that you've been owning did well, and then it collapsed big time.
Absolutely.
What are the key learnings for you? What to watch out for in these kind of mid-cap companies, especially the companies which are too dependent on the government, the state governments for the release of money?
Yeah, I mean, it's always, while we would have made money, but, after the fall, I was telling my team that, we've gone wrong. While we were nimble to sell off, but anything on B2G, particularly state government, is a red flag. We will be very, very cautious now. That is one. Anyway, debt levels being high, we avoid. Commodities in mid-caps, we avoid. Promoter stakes being very low. Unlike the digital players, we are very uncomfortable. We want their skin in the game to be high. And then broadly, most of them we bought also, which were B2G. There was almost no debt. So we were on the right side of it, but working capital cycles are more important. The balance sheet is more important, is a learning for us.
The other part of accident came in the IPOs. Most of the IPOs came with a lot of frenzy, and it just fizzled out. They are down 60-70% from the peak highs. What's the call on IPOs now? I mean, are you avoiding IPOs?
No, we were lucky to have really not got into FOMO there. We avoided almost none of them. Very large, we didn't participate, and some of them you do get hit at times. But in hindsight today, we were comparing with our portfolios are the best 5 Nifty stocks.
Sure.
We do that today also. When I look at a mid cap, I say, okay, this stock in large cap is going to give me 25% return. Can I get more? And that has helped us a lot, So we do that, and then we said, okay, why do we want to go there,
Go there, right.
So by and large, we didn't get hit by that.
What about defense? HAL I think is something that you like.
Yeah.
And I think you'll own it as well. You could correct me on that.
Yeah.
But of late, suddenly the news flow is not very, very good.
Yeah.
The counter argument is they've got a great order book. Now we have to track execution.
Yeah.
What is your view on it?
Actually,
it's 35% down from the top.
Yeah. No, I'll be honest, we just sold HAL because, and it was just, we bought around current levels and we sold because we realized we don't have a visibility. And we had a very small weight to start with because we realized we were late. We're not early identifying HAL. We wanted to participate in the theme, but when we saw the G engines uncertainty and then AMCA approval for them not coming while it's a 10-year story, but we realized that it's better to accept and move out. And that's why we moved out of HAL.
This quick commerce stocks have corrected very sharply,
Yes.
both Eternal and Swiggy.
Yes.
Are they looking attractive?
Yeah, so, again, we used to look at very high growth rates and looking at 2030, getting into NPV, and yet our entry price was not coming to the level it was. Now, when we just see them, they look reasonable. But the only caveat is, and they themselves are telling, Zomato themselves are telling it's getting intense.
Yeah.
The competition is very intense. Now, we need to hear to them as well. And this 80, 90, 100% in growth rate in quick commerce, if they don't sustain, then they are not cheap. So we are saying, we are watching them. We don't want to preempt. Let it grow for 100% for some more time, and it's okay.
But you generally get a good price or good news, right? You never get both of them hand in hand.
Right.
So right now, maybe the news will be bad with the kind of investments, but the price is good. But you're still not willing to buy it.
Yeah, so here, when the management is saying, and they're very respectable, right?
Yeah.
There's intense competition. There's cash burn by my peer. And at that point, we better listen to him than to get... And then, when you look at the numbers, you put at 30 numbers, get them 40 times multiple, and then get to NPV, then you get your entry price and you make 15% return. Yeah. So at our framework, it still is helping. I mean, but having said that, I still feel that now they are really nearing the bottom and somewhere it will become very attractive.
Any word on EMS companies? All are down 30-40% from the peak. Still expensive, but any thoughts there? Either Dixon or Ember or any of these names?
Yeah, so one of the names, as you saw, 2 quarters back, there was 60% growth.
Yeah.
Last quarter, it was 15% growth if you take the minority interest after minority interest.
Yes.
This quarter, it was 0.
Yeah.
Right, and now it's still 40 times. So we are a little uncomfortable with valuation. Some of them we are tracking, like Sirma we had sold off, and it's moved off from there. We bought and sold second time in last 4 years. We'll watch it, but we still feel they're not cheap.
Okay, out of time. Sanjay, this has been such a great conversation. I hope all our conversations are with you in person.
Thank you.
But thank you very much for joining in. And we've got a full cricketing weekend coming up. So we're going to cheer for India and come back Monday morning bright and early with all the global and local news flow to prep you up for trade. Well, thank you for watching Editors Roundtable. Don't go anywhere. On the other side, more news and updates will follow.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Equities see a sharp cut in the last hour of the session after trading in the red for most of the day. Weak global cues and jitters ahead of GDP data sparked broad-based selling across sectors. All major indices end over 1% lower. It's the third worst weekly performance for the markets this year. Canada's Prime Minister Mark Carney lands in India for a 4-day visit as he tries to exorcise the ghost of Canada's chaotic relationship with India under Justin Trudeau. He will meet Prime Minister Modi for the third time in 10 months as both countries look to boost economic affairs and bilateral trade. Anthropic CEO rejects the US Defense Department's ultimatum demanding unrestricted access to the company's AI tools. An 800-word note highlights that the company would rather not work with the Pentagon than agree to use that may undermine rather than defend democratic values. Commerce Minister Piyush Goyal says the India-United States joint statement highlights that should the circumstances change, the trade deal would be rebalanced. Says India is closely monitoring developments in the United States days after the Supreme Court struck down Trump's tariffs. Telecom Minister Jyotiraditya Scindia says the government is only a 49% stakeholder in Vodafone Idea, adds that the management would be able to chart its own course following the relief on AGR dues it got from the Supreme Court. Also rules out any fresh intervention for telcos beyond what's permitted by the Apex Court. That's Network 18 exclusive. A Delhi court acquits Aam Aadmi Party chief and former Delhi Chief Minister Arvind Kejriwal, Manish Sisodia and others in liquor excise case. Pulls up the CBI for implicating them without any material evidence or witness testimony. Says it found no overarching conspiracy or criminal intent in the excise laws. The CBI says it will challenge the verdict. Aviation regulator allows passengers to cancel or amend their flight tickets within 48 hours of booking without paying any additional charges. This provided the flight is scheduled at least 7 days later for domestic and 15 days later for international routes. Refunds must be processed within 14 working days. Netflix drops out of the race for Warner Brothers Discovery, refuses to hike its offer to meet Paramount Skydance's renewed $111 billion bid, says the deal is no longer financially attractive, but the Paramount deal still has to clear multiple regulatory reviews. Former Twitter co-founder Jack Dorsey blocks plans to lay off 4,000 people or nearly 40% of its workforce as it pivots towards an AI-centric future. Dorsey admits that they overhired during the COVID-19 pandemic. The stock rallies 25% in extending trading. Pakistan declares an open war against Afghanistan after both nations trade cross-border fire overnight. Islamabad bombs Taliban targets in Kabul and several other cities. Claims around 133 fighters were killed. Taliban says its air strikes hit military targets in Pakistan. All right, the big story this hour, India's third quarter growth under the GDP series has come in at 7.8%. Let's go across to Lata Venkatesh for all the analysis. Lata.
Well, I think the big number that you are reading out, third quarter number coming in at 7.8, is better than our poll of 7.7, but it is not outlandish. You know, in Q2, we had got an 8.2% number. That actually has now been upped to 8.4%. So, Q2 still, according to the new GDP series, is a damn good number of 8.4, and Q3 at 7.8 is also an extremely, not just decent, robust number of Indian growth. So what we have is for the current year, the GDP estimates have been upped. If you look for the full year GDP, then the second advance estimates comes in at 7.6%, exactly as our poll also forecast. The original first estimate of the MOSPI was 7.4. So clearly, it is higher than the MOSPI's own old estimate. This year, FY26, the country is growing at a very robust 7.6%. But there is more good news, and that comes for the previous year. Last year, we had the old series telling us that we had grown by only 6.5%. Now that has been revised higher to 7.1%. So again, a damn good number. And the year before that, the numbers have come down very drastically. FY24, we were given a 9.2% number, and that has now been rolled down to 7.2. So disappointment about a 2-year ago number, we can take that. Last year's number is 7.1, and this year at a very robust 7.6. Now, these days, we worry more about nominal GDP because that's what is aligned to how much taxes is paid and how much the government makes, what percentage of GDP it is. Well, nominal GDP, which the MOSPI's old estimate was 8% for the current year, has now been up to a fairly decent 8.6%. So we have a very good nominal GDP number, and that comes on the back of a 9.7% nominal GDP number last year. Last year, we were under the impression, under the old series, it was 9.8. That has been trimmed down to 9.7. But on top of it, we are getting a fairly decent 8.6% nominal GDP growth. Now, I'm only going by the overall growth numbers. I'm not yet confusing you with the aggregate numbers. But my sense is, if the nominal GDP grows by 8.6%, then, you know, the fiscal deficit has to be 4.4% of this nominal GDP. My sense is the government would have got a little more elbow room to do fiscal spending. I still don't have the aggregate numbers. We should get to it in a bit. But the short point is that the differences in numbers that we have got are not very huge. More importantly, where they are different, they are actually to our advantage. That is, the current year growth is 7.6. The current quarter itself is coming in at 7.8, better than we ever anticipated. And the previous year's revisions, especially for the year just gone by, is fairly significant. We have gone up to a 7.1% GDP growth. So, you know, that makes it 3 years in a row of over 7% growth. FY24, 7.2, FY25, 7.1, FY26, current year, 7.6. So it's a very decent growth, and nominal GDP, like I told you, at 8.6. We will come back to with the aggregate numbers and the advantages it throws up in terms of fiscal deficit for the government, even in the current year, and other nuances as to what exactly is different and why we have been able to get a far better nominal GDP number than we started with, 8.6, far better than the 8% that we originally thought. These are the preliminary numbers I'm presenting to you. We will give you the details in just a bit.
All right. Thank you, Lata, for that update. Let's talk about the day's market action. The last street witnessed a broad-based fall, with all major indices falling over 1% each. Nifty fell below the 25,200 mark, dragged by financial heavyweights. 45 Nifty stocks closed in the red. Sensex fell over 950 points for the week. Market ended lower, and all major indices closed in the red. Benchmark indices fell nearly 2%. Mid-caps and Bank Nifty dropped nearly 1% each. Nifty Realty and IT took a beating this week and dropped over 4% each. Nifty IT has now fallen over 19% during the month, its biggest fall since September 2008. Prashant Nair joins us now with the days and the week's market action. Prashant, bad day and a week for the Wall Street.
Well, a tough week. The market remained in a range for the first 4 days, and then it broke below that range trading on Friday. And that's the reason why, if you look at the weekly, if you look at the daily change on Friday, which was the most consequential, and then you look at, you know, Friday to Friday change, that is the weekly change, numbers don't change that much. Look at the Nifty, look at the Nifty Bank. I mean, 1.25% lower for the day and for the week as well. Because the prior 4 days, it was 1% up, 1% down. Basically, 1 day up, 1 day down. So it netted each other off. So the day which counted was Friday with that sharp break lower in that sense. Now, mid caps and small caps, actually for the day they did better, but for the week they were also down about 1.25% or so. You know, lots moved, and of course, IT services and IT software stocks, some hints at a recovery on odd days when Wall Street software recovered, but feeble, very, very feeble. And Friday was a case in point where, you know, the prior night, overnight, we woke up with strong software bounce. But, I mean, the IT index on Friday was up just about 1/3%. Of course, I mean, if you look at the IT index for the week, we lost another 4.5%. So That was the big sector last week, and that continues to be the big sector this week as well. I'll come to straight away individual sectors, stocks now, and I'll start with the Nifty. Eternal lost 9% for the week. Friday to Friday, Tech Mahindra was down 7, Bharti was down 5, Trent was down 4.5, Wipro and ITC were down about 4% or so as well. On the upside, Apollo Hospitals, NTPC, JSW Steel and Titan were the 2% plus gains as far as Nifty 50 stocks are concerned.
All right, thank you, Prashant. A tough day and tough week for markets there. Shifting focus now, Commerce Minister Piyush Goyal has said that the India-US joint statement highlights that should the circumstances change, the trade deal would be rebalanced. Speaking at the News 18 Rising Bharat Summit, Goyal said India is closely monitoring developments in the US days after the Supreme Court struck down President Trump's tariffs.
They have many other tools that they could possibly use. They've already used one of them, Section 122, by which they put a 10% tariff. I think they are on record that next week they may increase it to 15% for the first 150 days. So there are different evolving dialogues that are going on. We'll have to watch. And by the way, you must have read my joint statement that we had finalized with the US. It has categorically said that should the circumstances change, the deal would be rebalanced. At 50% tariff, we were at a huge disadvantage in our exports. And the fact that we were able to bring it down to lower than the rest of our competition was a huge win for India. It would have opened the doors to a lot of agricultural exports also.
And staying with the Rising Bharat Summit, Telecom Minister Jyotiraditya Scindia said that the Vodafone Idea's management will be able to chart its own course following the relief on AGR dues it got from the top court. He also ruled out any fresh intervention for telcos beyond what's permitted by the Apex Court.
As you're aware, we have a 49% stake in Vodafone now, with the conversion of the AGR dues, which is close to about 38,000 crores. We have also followed the Supreme Court verdict and executed on that. And I think things look quite promising as far as Vodafone is concerned. But let me be very clear, we are an equity holder. Now, when you are an equity holder, that does not mean that you are in management. We are in management vis-a-vis BSNL. It is for the management of Vodafone now to be able to chart their course going forward. In the case of Vodafone, the decision was taken by the Supreme Court, and if there are other telcos that want to follow suit, they must follow the same route.
IT Minister Ashwini Vaishnav has reiterated that digital platforms and news media outlets must fairly compensate content creators with the revenue that they generate. Speaking at the News 18 Rising Bharat Summit, Vaishnav added that India will need 2 lakh GPUs to stay competitive in the AI space.
And we have content creators across the country who are creating such huge amount of good quality, high quality content, whether it is music, whether it is cooking, whether it is traditional culture, whether it is traditional folk songs, whether it is science, technology, very interesting ways of explaining things to the young generation. All that is happening today. So therefore, when this Gen Bharat, when they are the content creators, they must get the fair share of the revenue. We'll have to scale up our investment, we'll have to scale up our compute to a significantly higher level. When we started the AI mission, that time 10,000 GPUs was the target. We have achieved already 38,000 and another 34,000, another 20,000 we are adding. But I think we'll have to go somewhere near 200,000 or even more than that. Then only we'll be able to do real, the kind of demand which is coming up. And that is why the recent budget announcement of tax break till 2047, that's very important, because that basically provides that huge momentum to bring the entire world's data to India.
The race to buy Warner Brothers Discovery Studio and streaming assets is coming to an end. Streaming giant Netflix has pulled out from the deal after WBD's board said Paramount Skydance's revised bid was the superior offer. Earlier this week, Paramount had revised its bid to buy Warner Brothers assets to $31 per share in an all-cash deal. Remember, Netflix had granted WBD a 7-day waiver to re-engage with Paramount, and this has now resulted in the higher bid. CNBC's Karen So brings us more.
Netflix has announced it will rescind its offer for the studio and streaming assets of Warner Brothers Discovery after the WBD board signaled Paramount Skydance's latest bid for the whole of the group was actually a superior offer. Paramount's new offer of $31 a share came after Netflix granted a 7-day waiver for Warner Brothers to re-engage with Paramount for the company to, as co-CEO Ted Sarandos told CNBC, quote, put their money where their mouth is. Netflix then declined to raise its offer of $27.75 a share for WBD's studio and streaming assets, describing a deal to purchase them as no longer financially attractive. You may recall that very hostile tactics deployed by Paramount trying to re-engage with the Warner Brothers Discovery board. They'd already thrown their weight behind Netflix.
All right, time for a short break. Coming up next, Delhi court acquits Aam Aadmi Party chief and former Delhi Chief Minister Arvind Kejriwal, Manish Sisodia and others in liquor excise case. Details when we return. Welcome back. A Delhi court has discharged former Delhi Chief Minister Arvind Kejriwal, Manish Sisodia and others in liquor excise case. The court also slammed the CBI for implicating them without any material. Ashmit Kumar brings us all the details. Ashmit, please take us through the court's observations.
Well, the long and short is that the former Delhi Chief Minister Arvind Kejriwal and Manish Sisodia have been exonerated by the Delhi court. The focus now, of course, will shift to CBI whether or not they choose to appeal this order. But here is the meat of it. Here is the big takeaway from the Delhi court order. The Delhi court has very clearly held that this indeed was a faulty probe. While discharging Arvind Kejriwal and Manish Sisodia, the choice of words used by the Delhi court has been scathing with respect to the conduct of the CBI, going on to say that this entire investigation, the entire charge sheet that has been submitted by the CBI will not stand judicial scrutiny. In fact, what the court goes on to say is that this is not, the allegations that were made against Arvind Kejriwal, Manish Sisodia are not backed by cogent material. They're not even backed by sufficient statements by witnesses, that this was more a case of conjecture rather than evidence, and also going on to say that the CBI has struggled even to manifest, even to demonstrate a prima facie case as far as Arvind Kejriwal and Manish Sisodia is concerned, and towards the end goes on to conclude that there is no case made out for the alleged liquor policy scam as had been put forth by the CBI. So on that note, a clean sheet being given to Arvind Kejriwal and Manish Sisodia. But bear in mind that there are two aspects which are yet to play out. Number one, of course, we'll have to see how the CBI chooses to deal with this and whether or not they choose to appeal this before the Delhi High Court. That's one. The second aspect that we need to see how it plays out is there were two cases, there were two investigations pending against Kejriwal and Sisodia. One was CBI, which now has been quashed by the Delhi High Court. The other, however, was the Enforcement Directorate. That investigation, that case, that trial is still continuing. So the pain is not over, but nonetheless, relief coming in on the CBI front.
Absolutely significant development there. Let's also take a look at Arvind Kejriwal's reaction. He got a little emotional when the media spoke to him. Let's take a look.
हमारे ऊपर कीचड़ फेंका गया। 24 घंटे टीवी चैनलों के ऊपर डिबेट चलते थे, खबरें दिखाई जाती थी केजरीवाल भ्रष्ट है, केजरीवाल भ्रष्ट है। अरे हो गया संभालिए सर, अपने आप संभालिए, हिम्मत सर, पीछे लाओ मत भाई, पानी दो, पानी। केजरीवाल भ्रष्ट नहीं है।
All right, with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC TV 18. Thank you for watching.
Hello and welcome to this special broadcast of Indianomics. I'm Lata Venkatesh. The third quarter GDP growth under the new series has come in at 7.8%, pretty close to the 7.7% that our poll threw up. But the important point is the full year GDP growth has come in at 7.6%, exactly as our poll pegged it. But if you looked at the aggregate numbers, there is a bit of a difference. The aggregate GDP for the current year, that is FY26, in nominal terms, was only 7 lakh crore. Now, the nominal GDP is estimated at 345 lakh crore. See, in terms of rate of growth, actually it is higher. The rate of growth is 8.6%. But because the base has changed, we are actually dealing with a smaller GDP for the current year. We thought we had 357 lakh crore, now it is 345 lakh crore. So just from the point of view of fiscal deficit, it will be 4.4% of 345 lakh crore, not 4.4% of 357 lakh crore. So the government has about 50,000 crore less in terms of fiscal deficit elbow room to spend. I just want to tell you that this is an advanced way of calculating. They have included, service taxes, e-Vahan data. They've been able to use the as-used data, which is the annual say of unincorporated services, which is, until now you calculated the formal sector and created the informal sector number through a multiple. Now you have primary sources to calculate even the informal sector. There is also double deflation, which the Secretary Mosby, Dr. Garg explained to us. That is, the government, the Mosby deflates the input price and the output price and calculates the value add. Until now, for many entries, they used to just take the value add and deflate the number by, the inflation, the WPI. So this is a more sophisticated way. In very many ways, the calculation of the GDP has been made broad-based and more sophisticated, more international standards, and much more important, the base year has changed to 22-23. Important for us, the growth rate, real growth rate, remains robust at 7.6% for the current year and 7.8% for the quarter just ended, October, November, December. The nominal GDP growth rate also is fairly decent at 8.6%. But importantly, and I think that will be a matter of some confusion in the government, that the nominal pool, the actual aggregate number, is lower by, about 11 lakh crore. That can be a problem for the fiscal deficit. With those initial remarks, let me invite our galaxy of economists. I'm joined by Soumya Kanti Ghosh, the Chief Economic Advisor at State Bank, member of the Finance Commission, and a material member in some of the revisions, like for CPI and IIP. I also have with me Abhishek Upadhyay, the senior economist at ICICI Securities Primary Dealership, and Sakshi Gupta, Vice President, Senior Economist at HDFC Bank. So in a way, all the three banks are represented, the top ones. Soumya, first to you. What are the initial takeaways? Does it look like this year is a robust year of growth with 7.6% full year and 7.8 for 3Q?
Yeah. Thank you, Lata. I'm just seeing the number for the first time. Actually, I was away. But whatever I could gather in the last couple of minutes, I think I will talk first about the overall growth rate. I think for FY24 and FY25, the numbers have undergone significant revisions because as per the new methodology, the FY24 growth rate is now 7.2%.
Yes.
And the FY25 growth rate is 7.1%. So we have maintained, and the growth rate was a revision downwards of 200 basis points and 60 upward one. And for FY26, I think if I am correct, the growth rate is around 7.6%.
Okay, I'll just explain this to my viewers. Soumya, you're pointing out a very important thing. There are major revisions in FY24-25, that is last year, and FY23-24. 23-24, we were originally given to understand that we grew by 9.2%. Actually, we have grown by only 7.2%. And 24-25 last year, we thought we had a bad year. We grew only by 6.5%. Now we realize that it is 7.1. So that's a major 60 basis point increase in GDP. For the current year, from the first advance to the second advanced estimate, it's not a very big difference. 7.4 we thought, it's now 7.6. Go ahead, Soumya, any other observations?
Yeah, the second observation is, I think, the India's Q3, the quarterly growth rates, if I understand by the new methodology, are now less volatile. And India's Q3 GDP growth rate is basically now 7.8%. It was 8.4% in Q2 under the new series. So there has been also some decline in the Q3 GDP numbers as per the new series.
Okay.
But
fair enough. It's not as, but it was never expected to be as strong as the previous quarter.
But Lata, the third important point is that, and this is, I think you were talking about the ratio. The good thing is that the savings, the gross savings in the economy, if you actually look into it, in FY29, FY25, they are now at 33.5% from 31.5% old, 32.8% in FY24, and 29.8% in FY23. So I think that's a very big jump in terms of the domestic savings. Domestic investment is now actually at 34.3% in FY25. So from that perspective, I think the logic of saving and investment not increasing proportionally as we were expecting, that I think that needs a little bit revision in terms of the overall number, because savings at 33.5% is overall saving in FY25 and investment in 34.3%. So these numbers actually are significantly upward revision from the earlier estimates, around 200 basis points.
Fair enough. I think that's very important and also a little satisfying that the savings rate has recovered so much. But to look at GDP from the expenditure angle, we've done fairly well in the current year. I mean, these are advanced estimates for the full year. But as the first advanced estimates indicated, consumption is growing by 7.7%. And capital formation is growing by 7.1%. Both not factors to complain. Good numbers, consumption and capital formation. Abhishek, now over to you. I mean, my eye went to the fiscal deficit. The overall pool of nominal GDP has shrunk now to 345 lakh crore from the original budget estimate of 357 lakh crore. Will that be a major policy issue? Now they have less fiscal deficit.
Well, Lata, so based on the new nominal GDP levels that we have for the current fiscal year, the implied nominal GDP growth required to hit the government's assumption for nominal GDP level for next year will be somewhere between 13.5% to 14%, which is a tall ask. At the same time, because government was anyways not targeting a very major fiscal consolidation in the next fiscal based on optimistic tax revenue assumptions. I don't think the broader messaging or the broader ability for government to stick to somewhat lower fiscal deficit that they are targeting should be called into question. In any case, what we know is the fiscal deficit fall next year was mainly premised on non-tax revenue growth, including disinvestment receipts, etc. So we have to see how that part pans out. But I would not be too worried about the government's fiscal arithmetic at this stage. But other details are interesting. So what the Q3 numbers and full year numbers are consistent, but quarterly distribution of growth has changed, as you would have noticed.
Yes.
In the first half of the year, growth was earlier seen to be around 8%, and in the second half of the year, below 7%. What we have now is in the first half, growth is somewhat below 7.5%, and in the second half, it is a little higher than 7.5%, which is consistent with what we are seeing in the high-frequency data also, as we have seen in the October-December period. In fact, data available for Jan also seems to indicate robust growth in high-frequency data, especially the key ones, including auto sales, credit growth kind of numbers. So second half growth should be supported vis-a-vis the first half growth that we have seen in that light, and that is what we are seeing. Also, overall, past data, as you pointed out, both real and nominal GDP growth on average, it seems, has been revised down for FY24-25. Although FY25 growth is slightly better. So from growth momentum perspective, what we are seeing is growth has been picking up from broadly, if you look at the key components, including on the nominal GDP level, right? So that is, I think that is a positive. We are entering next fiscal year with a growth, with stable growth of around 7.5%, which gives us confidence that we should be able to again hit growth, which is closer to 7% perhaps.
Okay, I take your point that we have maintained a steady 7% plus real growth, and at 7.6 done far better than last year as well. So those are, of course, the positive, done far better than last year and the year before, because now that 9.2, as Soumya pointed out, of 2 years ago has been revised down to 7.2. So we have a, if we do 7.6, we are doing the best in 3 years, which is heartwarming. But as Abhishek, the main point that Abhishek has made out is next year at this rate, to reach what the budget had said about the nominal GDP, the budget was estimating next year's nominal GDP at 393 lakh crore. And from 345 lakh crore this year, it will mean a jump of 13.7%. That is a tall ask. So, they will have to make some adjustments to the fiscal deficit. Perhaps some new numbers will come. We do not know, or these could be revised when the final numbers come in May. Sakshi, what have you taken away? Anything internal from the Q3 numbers or the full year numbers in terms of agriculture, industry, finance? I think trade, transport and communication has been doing very well.
Yeah, Lata, I mean, beyond the headline numbers, I think 3 broader points that I noticed in this GDP data. One is on the expenditure side, as you pointed out. I mean, consumption momentum, if I look at the full year number for FY26 or the last 2 quarters, Q3, Q2, consumption clearly is showing, very, very strong numbers, right? And if you look at FY25 number for consumption, that has been revised down, which kind of confirms, that in FY25 from high frequency indicators where we were feeling that consumption was very patchy, right? So clearly a better capturing of economic trends. Secondly, if you look at the supply side, I think what stands out is 3 major sectors. One is mining, the second manufacturing, and third, as you rightly said, trade, transport, hotels and communication. You will see that average growth and growth even for this year is significantly higher than what the earlier series was suggesting. So for instance, manufacturing is 11.5% growth in real terms. I think, with the capturing of the informal sector and the change in, the deflator, as you explained, moving from single deflation to double, I think clearly has kind of led to an upward revision in manufacturing growth. In just a final point, on trade, transport, and communication, MOSPI in its earlier, some of its papers had suggested that this particular segment was being underreported because particularly for information and communication, because prices had gone down, the volume growth effect was not being captured. So I think now with this higher number, clearly perhaps that's something that is being captured in this date.
Yeah, and that's very important because if I remember right, some time back, there was an analysis done of the employment intensity of the various sectors. And employment intensity of trade, hotels, transport, communication and information is fairly high. I mean, all our Udupi hotels, everything come in that category, I would assume, ST buses. So the fact that that has grown at 10.1% in the current year is a matter of some satisfaction. I would only worry, public administration, defense and other services are also included. That part has grown only by 5.8%. In fact, it's been a laggard all the 3 years. Even last year, it's only 5%. We have to wait to see whether that is a point of bother. We'll do one thing. We'll take a quick break. We'll come back and give our experts a little more time to pour through the bunch of numbers that has been thrown at us. Back in a jiffy. Welcome back to this special edition of Indianomics, where we are looking at the spate of changes in the GDP numbers announced by the Ministry of Statistics. The change of numbers is obviously because the base year has changed from FY12 to FY23. And what we have is a fairly consistent rate of growth as per the new series, whereas in the old series we had 9.2 in FY24, 6.5, a very poor number in FY25 last year, and 7.4 in the current year. Now we have a basically 7% plus all 3 years. FY24, 7.2 last year instead of 6.5. It's a robust 7.1. And this year, the anticipation is a 7.6% growth. When we come to the quarterlies, again, the previous number, first quarter 6.7 remains. The second quarter, which was originally 8.1, has been made even more robust at 8.4. And for Q3, we have the first time number at 7.8. The Q3 numbers are interesting because we have, in the new series, we are getting very good manufacturing numbers. 13.3% growth in manufacturing and 11% in trade, hotels, transport and communication. All very good numbers. The secondary and tertiary sector are doing extremely well. We have been discussing with economists Soumyakanti Ghosh, Sakshi Gupta and Abhishek Upadhyay. Gentlemen and Sakshi, thank you very much for staying on. Soumya, if you've been able to go through the details, anything more in terms of this robust performance of manufacturing or trade you want to add, or any other significant observations? No, you're on mute.
Yeah, actually, Lata, if we look into the numbers, the mainstay of the growth story is actually now looks the manufacturing sector. And importantly, the manufacturing sector has been the story of the resilient story. If I have the numbers in front of me, and one of the possible reasons which I can clearly see is the deflator over here, which has been newly constructed. It has been negative all through the 3 years. It was minus 1.7 in FY24 and it is now minus 0.2. So that is one of the reasons where the manufacturing sector has been doing quite well. I think on the services sector also it has been doing quite well, but there has been some volatility in the service sector's growth rate within the sectors. If I just pull up the numbers a little bit, I think one thing is very clear. I think if I look at the numbers, the trade, hotels and transportation sector and the finance services sector's growth rate has been quite volatile over the years. For example, the trade or the transport sector growth rate was in double digits in FY24, but it slipped to 6.6%. Yeah. The story is exactly the opposite for the real estate sector. So it means that there has been the story where the story of the manufacturing sector has been fairly consistent. The story of the financial services is not that consistent. Yeah. And finally, on the agricultural sector, the agricultural sector is benefiting from a negative deflator this year. And as you know, there has been decline in the food prices. Okay. And finally, the story of the fiscal deficit, I think it's actually coming at 4.9% as per the new GDP series. So it's quite close to 5% and not 4.3%. So I don't know how that is going to be managed, but overall, the numbers in terms of growth rate are quite satisfactory, and on an average, they're actually more than 7% in the last 3 years. But if you look into the internal...
So we have to rush because we are coming to the end of the show. I take your point about fiscal deficit. That is the big thing we will want to hear from the government. Sakshi, is there anything else? I mean, this manufacturing has been a sterling story. Actually, if you look for the last 2 years, and what has been particularly depressing actually is public administration and other services. For the last 7 quarters, it's not done all that well, and particularly bad in the third quarter.
Right. Latif, just 2 points on manufacturing and the public administration, defense and other services. For public administration, defense and other services, they have again made a change in terms of the deflator, that they would be using, right? Earlier, they were using CPI general, which was, the overall index, which we know was very low. So perhaps was pushing up the real numbers for this year. But now they'll be moving to a different indicator. Moreover, what the government is saying that we will also be including imputed, value of government provided housing, right? That is going to come in this particular segment as well as in your government expenditure, consumption expenditure category. So we'll have to see how those elements are pulling down this number, if at all. On manufacturing, of course, the thing is that we were not able to capture the informal sector at all earlier, right? So the fact that this number is strong, with a better understanding of the informal sector, perhaps to me suggests that the informal sector was actually doing much better than what the old series.
It is also possible that the double deflation is actually working to our advantage. It's quite possible that the input deflation was actually deeper than the output deflation, and that is why the value added is higher. We have to understand exactly, go into the mechanics and see why manufacturing is looking very good. I mean, that's good news. Abhishek, final comments.
Well, yeah, I mean, so we all expected the manufacturing deflator to be higher, and therefore real manufacturing GDP growth to be somewhat lower. In contrast, what we have got is consistently strong manufacturing growth. Agree with Sakshi, that is a pointer potentially to better informal growth component in that sector, where we have more information which is available. Also, other sectors, trade, hotels, etc., where informal sector component is quite high, has done well. So again, that is positive broadly. If you're assuming that informal sector has also done well, that means consumption broadly should be on has consistently done well. Consumption should be on a better footing than we had assumed earlier, and provides more conviction about the outlook for growth, therefore, heading into the next year.
Fair enough. Thank you very much, Soumya, Abhishek and Sakshi, for your initial comments on the GDP numbers. The tragedy really is, if manufacturing is so good and so are, trade, hotels and construction, then why is it that corporate earnings all these quarters did not show up? The good numbers, especially the heightened nominal GDP numbers, take away the excuse why corporate earnings have not followed suit. We won't get any revisions there, but we hope that growth turns for the better as we get to the fourth quarter. Thank you very much for joining us. We have to wrap up this edition of Indianomics on the note that the main message from the GDP is that we are growing at a very robust 7.6% in the current year, over and above a fairly decent 7.1 last year as well. Last year was not as bad as 6.5. The puzzle on the government's table is next year the fiscal deficit actually comes to 4.9% per the calculation of the GDP, and therefore how are they going to reduce the fiscal deficit in the current year and more so next year? There is a mathematical problem here, because the overall nominal GDP has shrunk for the current year from 357 lakh crore to 345 lakh crore. That's a puzzle for the government. Otherwise, all good in terms of economic growth. Wrap up on this edition of Indianomics. Thanks for watching.
Hello and welcome to News Center. I am Ashmit Kumar. In what comes as a big win for the Aam Aadmi Party's top brass, a Delhi High Court has discharged former Delhi Chief Minister Arvind Kejriwal and his erstwhile Deputy and Finance Minister Manish Sisodia in the liquor policy case. All 23 accused in the case were acquitted by the court. The court also pulled up the CBI while highlighting that there was no cogent evidence against Kejriwal and no prima facie case against Sisodia or the other accused. The court has also said that the CBI charge sheet contained many lacunae and was not supported by witness statements. It said that there was no overarching conspiracy or criminal intent in the excise policy. Following the decision, Aam Aadmi Party leaders lashed out at the Bharatiya Janata Party, accusing it of building a fake case against them. The CBI has said that it will challenge the order in the Delhi High Court. Let's break down the case. For the benefit of our viewers, a brief history. The corruption allegations were first flagged in 2022 when then Delhi Chief Secretary Naresh Kumar submitted a report alleging procedural irregularities in the formulation and implementation of the 2021 excise policy. The policy was later scrapped in 2022. The policy shifted to fully privatized model. The report termed this decision taken by Sisodia, who was then the excise minister, as arbitrary and unilateral, alleging that it caused a financial loss of 580 crore rupees to the exchequer. Following that report, parallel probes by the CBI and the ED were launched. While the CBI case has now been folded, the ED case still stands. A visibly emotional Kejriwal broke down after the court verdict. He said that he had faith in the judiciary.
हमारे ऊपर कीचड़ फेंका गया 24 घंटे टीवी चैनलों के ऊपर डिबेट चलते थे खबरें दिखाई जाती थी केजरीवाल भ्रष्ट है केजरीवाल भ्रष्ट है हो गया संभालिए सर अपने आप संभालिए हिम्मत सर पीछे लाओ मत भाई केजरीवाल भ्रष्ट नहीं है.
Well, speaking at the press conference just hours later, Kejriwal threw a challenge to the BJP. Here's what he said.
पूरी दिल्ली का बेड़ा गर्क कर दिया. सबसे बड़ा खामियाजा मोदी जी और अमित शाह जी की सत्ता की हवस, उसका सबसे बड़ा खामियाजा दिल्ली के 3 करोड़ लोगों ने भुगता है. दिल्ली के लोगों से जाके पूछो. आज मैं चैलेंज करता हूं मोदी जी को. मोदी जी, हिम्मत है दिल्ली में दोबारा चुनाव करा के दिखा दो. 10 से ज्यादा तुम्हारी सीट आ जाए, मैं राजनीति छोड़ दूंगा.
Well, for more on this, we're now joined by Senior Advocate Dushyant Dave and Supreme Court Advocate Vikram Hegde. Gentlemen, thank you so much for joining us. Mr. Dave, coming to you first. The court is very clear that there is no overarching conspiracy at play here, raising questions about the investigation itself, saying that it's based more on conjecture, not supported by evidence, not supported by material, and taking a dig at the conduct of the CBI. To your mind, with this investigation having started in 2022, 4 years later, the Delhi court now showing that investigation the door, what message does it send out with respect to the conduct of the CBI?
Well, before I answer that, Smith, I must say one thing, that it is a 558-page judgment which you forwarded to me. And I quickly glanced through it. I must confess, I didn't have time to read it thoroughly. But I quickly glanced through it. And I must say, hats off to the judge, Mr. Jitendra Singh, special judge of the Delhi court. Outstanding judgment. That judgment considers every aspect of what is expected at the stage of framing of the charge, whether the accused is prima facie guilty or not, whether there is a strong suspicion to proceed against the accused or not. The judge has considered every aspect. He has considered the law. He has considered, the facts. He's considered the excise policy. He has considered how excise policy moved from, department to department, including discussions with then Lieutenant Governor. He has discussed, the opinions which was produced by all kinds of people who were objecting to the policy because they were likely to lose out. Opinions from former judges like Justice Gogoi, Justice Balakrishnan, and others. And judge has, has threadbare considered the entire evidence, including the evidence of the, oral evidence of some of the witnesses which were recorded under many provisions of the law. And the learned judge then comes to a conclusion that there is here no conspiracy, there is no illegality. Everything has happened openly, transparently, and it has been discussed by everybody across the board. And therefore, he says that the policy was not vitiated by any kind of a fraud. There is nothing, a violation of the Prevention of Corruption Act. If PMLA provisions are not retracted, and the judge therefore says, which he concludes, that it would be really sad to continue this prosecution even for a day long when there is no evidence whatsoever. So judge has really brilliantly analyzed everything. I must say, these kind of orders, these kind of judges really restore our faith in the judicial system at the lowest level. And I therefore must say hats off to the judge. Having said that, I must say one thing, that this shows the abuse of power and the misuse or misuse of the investigating agencies against your political opponents. It is sad. We are in a democracy. It's a vibrant democracy. And, there is no reason why government should use these kind of powers to run after opponents, because ultimately healthy democracy needs opposition. It needs multilateral parties. And if you don't respect multilateral parties and multilateral governments at the state level, then I think it's really going to result into some kind of a dictatorship, which we don't want, and I don't think even the Bharatiya Janata Party wants. So this it shows that the abuse which took place, the CBI's failure, I mean, the judge is very right that the investigating agency, CBI, has not been able to bring out the case, even an iota of material, which is so right. Therefore, I think it really reflects very poorly. And I mean, far from CBI making a statement that they are going to appeal, they should say we will not appeal. They didn't appeal in Mr. Amit Shah's case when he was discharged in a far more serious case. So why should CBI file an appeal against this order? I mean, it would be travesty of justice if CBI were to pick out, people and file appeals when they choose, and when they don't choose, they don't file appeals. So I think this is a judgment which doesn't deserve to be, appealed against, and it should be accepted in all grace by the CBI and other authorities.
Well, the CBI, at least for now, is indicating that they will be knocking on the doors of the Delhi High Court. But let me also bring in Mr. Hegde. Mr. Hegde, coming to you again, a lot has changed between when this investigation was started, 2022, and now. A sitting chief minister was sent to jail. In the interim, we saw the elections as well. The political complexion of Delhi NCR changed. And now we find that the court is saying that this investigation was actually quite not. There wasn't enough material and substance behind that. Does this then raise the question of accountability of some of these officers, of the investigation officers of the CBI?
I think this is a fit case for raising that question and going into the question of what sort of culpability should be raised on officers who mount investigations which are not really sustainable. In fact, in this very order, the court has directed the initiation of appropriate departmental proceedings against the respective investigating officers for having brought in some of the accused persons despite there being no material against them whatsoever. Now, that may be on a slightly more focused version, but considering the sort of larger political impact that these kinds of prosecutions have, perhaps this is a good case to start looking into these things as to what is the responsibility of officers, what is the responsibility of prosecutors when they mount these sorts of prosecutions. And this is a concept that has been sort of recognized in all sorts of law commissions or the commissions for reform in criminal law as well, where they say that even if there is a travesty of prosecution, that is also bad. That is, if there is only 2% convictions, it means that we are prosecuting 98% of the people very wrongly.
Fair enough. Speaking of the conduct of the CBI, Mr. Dave, let me come to you again. The one practice that the court has frowned upon is the practice of CBI deployed in this case, flagged by the legal team of Arvind Kejriwal as well, that there's an accused in this matter. Pressure is applied in the form of interrogation. He's then flipped into an approver. And then as an approver, that statement is used to corner the other accused. This is a practice that has been frowned upon by this court. Does this again raise more questions about how the investigation was conducted by the CBI in the manner of flipping of accused persons into approvers?
well, I think CBI and its investigating officers knew that there was no case, there was no material, and therefore they latched on to this approver. And as we all know, the approver also gave some financial reward to the Bharatiya Janata Party through electoral bonds, as were reported in the newspapers. I think it was a gross misuse of power by the CBI and the investigating officers. And the learned judge is absolutely right that these kind of investigating officers should be proceeded against. But let us understand one thing. The CBI is, as Chief Justice Lodha once very rightly remarked, it's a caged parrot. CBI here was acting at the instance of, the Bharatiya Janata Party at the center and the Home Ministry. And the CBI therefore had very little discretion. They were given a brief that you have to frame these people. And the whole idea to frame these people and Aam Aadmi Party and its leadership was to ensure that in the next elections in Delhi they lose. And they lost because of that. Because you try to destroy their credibility, their personal character was assassinated, and you used entire media to really go after them, which we saw. So therefore, this case does reflect a very, very serious, kind of erosion in public life, particularly in criminal jurisprudence. This is happening again and again and again and again in large number of cases which are today being filed by central investigating agencies like CBI and the ED and income tax authorities, as also the state policies where the Bharatiya Janata Party is in power across the nation. So it should stop. Frankly, I really feel that this is a time when perhaps people like the learned Attorney General, who is very highly respected, should step in and should advise the government that this kind of nonsense must stop, because it doesn't give us a good picture. See, everybody across the world is watching this. Don't forget, people think that this is only confined to India. No, it's not confined to India. World over now, these news travels and people understand what's happening in India, what's happening to its beautiful democracy. We are the largest democracy in the world, and we must sustain it in every form. And therefore, to target your opposition in this fashion by using this kind of raw power really reflects extremely poorly on the part of government.
On a slightly different tangent, Mr. Hegde, if I may come to you, another aspect that the court has spent some time on is cautioning that only because an intended policy doesn't quite play out the way it was initially aimed at, that should not be reduced to a criminal conspiracy, that will paralyze governance going forward. Just want to get your thoughts on that caution being given by the court.
In fact, that caution is very well placed, and it is even in keeping with the legislative policy of the union government as well, which has brought in 2018 an amendment to the Prevention of Corruption Act, where some sort of protection has been brought in for decisions taken and recommendations made, which are of a policy nature. The court in this order has also identified that just because there is a private party who's making a profit, that does not mean that this is an outcome of corruption. So on that perspective, yes, there is a set of decisions that is taken administratively. There is that decision may even have gone contrary to some other recommendations that have come previously, saying that all of this should be kept in government control or whatever other recommendation was there. But overall, a government is free to take, or it should have the sort of play in the joints to take a decision where some sort of profit will be made by some parties. But that does not necessarily mean that all of this is arising out of corruption. And that is an observation that this court has made in this order. But there's also the other aspect that what then is the standard that needs to be met? That over here, when they were prosecuting for offenses under 7, 7A and 8 of the Prevention of Corruption Act, they ought to have shown, the CBI ought to have shown that not only is there some profit being made by some private parties, there is some sort of quid pro quo being demanded and accepted by the public servants who have been implicated over here, either directly or indirectly. That is where the CBI failed to demonstrate before the court that it failed to show any material which satisfied the court that yes, there has been some kind of quid pro quo, as a result of which this policy came to be tweaked
I'll just have to come in for want of time. I'll just have to interject for want of time. We're completely out, but that's clearly something.
I just want to add one thing, Asmi. Smith, I want to add
yes,
one
Mr.
thing.
Dave, just a quick 30 seconds.
Yes.
Quick 30
I must,
seconds.
as Hegde rightly points out, Supreme Court has consistently held that in policy matters, a writ court should not interfere. Two, that this was a policy which had gone through various departments, and Supreme Court has said in Nandalal Jaiswal way back in the 80s that if there is an interdepartmental discussion which results in policy, you can't say it was discriminatory or arbitrary. And three, most important, as a result of this case, Delhi citizens have suffered loss of thousands of crores of rupees in last 5 years. Who is going to compensate? The alcohol which people want to consume is not available. People rush to Noida and Gurgaon to buy it. And Delhi, government and Delhi's people have therefore suffered in terms of revenue. So these are all aspects which should be taken into account by the CBI before it really thinks of filing an appeal. And I would hope and pray that CBI is well advised not to file appeal.
Well, a strong push there by Mr. Dave that no further action should be taken by the CBI, but nonetheless, sources within the investigating agency saying that they will be knocking on the doors of the Delhi High Court. We're completely out of time. I'd like to thank both of our panelists for sharing their perspective on this critical judgment. But with that, it's time now for slipping into a very short break. But coming up on the other side, streaming giant Netflix has pulled out from the deal after Warner Brothers Discovery Board said that Paramount Skydance revised bid was the superior offer. That and more on the other side. Welcome back to News Center. Now, the race to buy Warner Brothers Discovery's studio and streaming assets is coming to an end. Streaming giant Netflix has pulled out from the deal after WBD's board said that Paramount Skydance's revised bid was the superior offer. Earlier this week, Paramount had revised its bid to buy Warner Brothers assets to $31 per share in an all-cash deal. Remember, Netflix had granted WBD a 7-day waiver to re-engage with Paramount, and this has now resulted in the higher bid. CNBC's Karen So brings us more.
Netflix has announced it will rescind its offer for the studio and streaming assets of Warner Brothers Discovery after the WBD board signaled Paramount Skydance's latest bid for the whole of the group was actually a superior offer. Paramount's new offer of $31 a share came after Netflix granted a 7-day waiver for Warner Brothers to re-engage with Paramount for the company to, as co-CEO Ted Sarandos told CNBC, quote, put their money where their mouth is. Netflix then declined to raise its offer of $27.75 a share for WBD studio and streaming assets, describing a deal to purchase them as no longer financially attractive. You may recall that very hostile tactics deployed by Paramount trying to re-engage with the Warner Brothers Discovery Board. They'd already thrown their weight behind Netflix.
Well, with that, it's a wrap on this edition of News Center. More news and updates will continue right here.
perhaps there could not have been a better lineup. We have, of course, with us Mr. Ramesh Tamani, a calm, macro-aware, long-term compounding believer. We have Madhu Kela, a sharp allocator, a thematic investor, an early trend spotter. And of course, we have Vijay Kedia, always smiling, always singing, and always picking the best possible multi-baggers. So let's get this conversation going. And of course, we're talking about, Rameshji, a long-term story for India, right? A long-term story which, from the market point of view, perhaps is going through a bit of a speed bump. How do you think market right now sits in a rising Bharat context?
I thank you, Anuj. Thank you for inviting me to this beautiful hall and this beautiful discussion. Thank you so much. I think the last few weeks, the market has been dominated by AI concerns, and is that going to take away the love affair we've had with tech to becoming a leper? So let me just address that first. Contrary to popular opinion, Anuj, a lot of people believe that NSE started the computerization program in India. But actually, in the middle 80s, the BSE started the computerization program. What happened was that there was an election, and the people who wanted the computerization to go forward lost the election, and the jobbers and the old-time brokers gained power at that time, and the computerization was pushed aside. But the lesson in that story is that at that time, on a busy day on the Bombay Stock Exchange, you do 400 crores worth of turnover. Today, India does collectively about $14 billion worth of transactions in a single trading session, just in the cash market itself. The point is that the market opportunity expands as new technologies come into place, as computerization happens, but the old people get left behind. So my feeling is that there's nothing to fear really about AI. I think the market is at this point just throwing the baby out with the bathwater. I don't think there's... but there will be new winners and new losers, but as the Honorable Minister suggested, there's a multifold of opportunities coming up. And I'd just like to say what Charles Darwin said when he wrote the book of Evolution, The Origin of Species. He said it's not the strongest species that survives, it's not the most intelligent species that survive, it's the one that is the most adaptable to change. So if Indian tech industry adapts to change and don't ostracize, and there's some reason to believe that they are changing, I think the tech industry will come back bigger, stronger, more vital, as happened in so many industries before us. Whether it's music or whether it's hotels, digitization has been a huge power changer. So I think there is something to fear. It is a profound change. But I think the market is throwing the baby out of the bathwater. Having said that, other than the tech sector, whenever I go and visit companies or knock on doors, I see no reason to be bearish because people are expanding, people are optimistic, and people are happy.
Oh, absolutely. So let's discuss a bit more on that. Madhu, is the risk that these companies are now fighting for survival? This is a question of existence. Astitva ki ladai. Where do you stand on that? Because since Ramesh, started with that topic.
Anuj, first of all, thank you for having me. I deeply appreciate you remembering and calling. Anuj, I think, first of all, in a lighter way, all 8 billion people have a view on AI today. There is no one in the world who doesn't have a view on AI. And everyone, the pace at which these changes are happening, every week something new is coming. So we have to be very alert and really monitoring these changes in a very careful manner. The other thing, as Rameshji said, I would say not only one example of BSE, NSE, but if you look at the 50-year history of civilization, technology has never made societies poorer, right? But at the same time, there will be Apple, Nvidia of the world which will come up, and there will be Blackberries and Kodaks of the world also, which will shrink, even though they being such significant large companies. So there will be clear winners and losers in this game, even within the IT companies. People who can really adapt to this change. And the change is coming much, much faster than we can envisage. Because see, AI is generating AI in itself, right? So the pace of change is very, very fast. So I'm sure there will be winners and losers. So you can't paint everyone with the same brush. However, one, let's say, the short-term worry. In medium term, it may get sorted out. Employment is a real issue that, because of the pace of change, the training which is required to get to the new jobs might take time, while the disruptions may happen in the short term. So these are things that are very dynamic, Anuj, but I remain very optimistic in the medium to long term. We have a fantastic skilled labor force, and as the so many people who are much more knowledgeable who came in the AI summit, and the normal consensus was that India has the capability to become kind of the AI layer provider and the solution provider to the world, and that opportunity is gigantic.
Okay. What do you think? ऐसा एक सेंस बन रही है एंथ्रोपिक जैसी कंपनी 2700 एम्प्लॉइज और उसका मार्केट कैप, एंथ्रोपिक जैसी कंपनी 2700 एम्प्लॉइज के मार्केट कैप के साथ आज हमारे पूरे आईटी सेक्टर से ज्यादा मार्केट कैप है उसका. इट्स लाइक इट वाज आई ओपनर फॉर मी आल्सो. व्हाट्स योर व्यू? आईटी में एंथ्रोपिक 2700 कंपनीज के 2700 एम्प्लॉइज के साथ आज मार्केट कैप इंडियन आईटी, पूरी इंडियन आईटी से ज्यादा. तो इज इट सम काइंड ऑफ वार्निंग साइन फॉर अस?
No, I definitely seen that what you are referring to Anthropic and all. Yeah. So what I read somewhere that they are having 2,700 or 800 employees.
Yes.
And the market cap of this company is the, combined all the IT company in the world.
Yes, yes.
More than that.
Yes.
So of course it is a wake-up call for India. There is no doubt about it. If you will shut your eyes, that means you are still sleeping, So this is certainly a wake-up call, and I think that obviously we should also do. Manoj, there is it is like a catch-22 situation. I read somewhere, like if you are not investing in AI and all, then chances are that if you are investing, suppose blindly in AI and all, chances are that you will lose your capital. At the same time, if you do not invest in AI and all, chances are that you will lose your company. Then you have to decide whether you are happy with losing your capital or you are happy losing your company. So this is certainly a wake-up call for India and for the entire world, and mainly for India. But I personally feel that ultimately we will rise to the occasion. I think we will also find our own way and to deal with this situation.
Okay,
let me just add one point to what he said.
Sure.
The interesting stat I found yesterday was we all talking about Anthropic and how it's dominating the world of computing now. Yeah. But what does Anthropic use for its CRM system? It uses Salesforce, which is an old enterprise-level software company. So they will coexist. I think both these AI will be used to make enterprise software much better. I think AI software, because of the scalability, auditability, and importance, will not be taken over. You're not going to get a 20-year-old kid to wipe code an enterprise system. And the fact that Anthropic itself uses Salesforce probably tells you that.
Yeah, overnight Jack Dorsey's company sacked about 40% people. So there's a bit of a risk that are we looking at some kind of jobless growth going forward? So
I think it's just headline news. I don't think that's going to happen.
2007. Then we had the post-COVID bull market. Post-COVID bull market is when retail investors really came into the market. And this is something that you always envisage, that you want to see a bull market where retail participates. That happened. But when I walked in this room, a lot of people were disappointed, despondent, because they have not made money in last 2 years. The market's been very tiring. And the Nifty might be at 26,000, but people's portfolio here might be at 22,000 if they're lucky, and some people's portfolio may be around 18,000. What's your message in that case?
Yeah, Anuj, first of all, the idea that in the equity markets you get linear returns, like 15% a year, go into fixed deposits if you want to do that. The returns are by definition lumpy. They will never be linear out there. So you'll have 4 good years and maybe 3 bad years. That's part of the game. But what is the CAGR over 7 years? You have to look at it from that perspective. Secondly, I believe there's some rotation going on in the market, that we're moving from the favorites of the market to other sectors. So I think sectors that are still performing well are defense, perhaps, materials and mining, all the physical goods that are being manufactured. Because the two trends that are very obvious to me, that all countries want to localize the defense. We can't rely on a rules-based America hegemony defining the world. So whether it's Europe, whether it's Japan, whether it's Asia, or whether it's America, each one will promote their own defense industry, and B, everyone will promote their own local manufacturing. So local mining, metals, local sourcing of supply will do good. So I think they're disheartened because perhaps they're looking at some wrong stocks, and we start looking at metals, pharmaceuticals, defense, you're probably seeing some appreciation.
Oh, absolutely. So Madhu, फिर पैसा कैसे बनेगा इस मार्केट में? Because we are stuck with only 10 or 12 stocks that are moving every day. Otherwise, it's been a bit of a downward journey for broader market in particular.
So Anuj, again, the question is that you can choose the point from where you want to make a judgment about your investment returns, right? I will choose a low point of COVID and said if I stayed invested in the markets, I've still done reasonably well, right?
Very well.
And if you choose a point of time that, let's say, last 12 months mein nahi bana, 18 months bhi nahi bana. So I've been around for 35 years and we have seen much uglier cycles of negative return or prolonged, if you may call it, bear market. But I think the time and again, these have always been proven to be opportunities. So let's say what has happened in the last 18 months, there's been literally no return. In 18 months, the small cap index is still down, maybe 11-12%. Roughly out of 1,000 companies, 350 companies are down more than 35-40%. And PE contraction between large cap and small cap index is between 15 to 35% in this time frame, while earnings are caught up. So I remain really very positive at this point of time about investing specifically in smaller companies. This is not random. You can't make a case that you invest in a small cap or any small company and you will make money. But I think there's been steep correction. Prices have fallen a lot. There's literally virtually no investor interest because every large mutual fund has compulsion to invest and look at only large companies, right? They don't have the bandwidth nor the intent to invest 50-100 crore rupees even in one small companies. So at this point of time, if you can selectively get it right, this is the best time to accumulate stocks for, whatever, 3, 6, 9 months. And we have seen whenever we have bought stocks in this kind of environment is when we have really made serious money.
Okay, of course, the three gentlemen here are some of the best stock pickers, generating returns of 1,000 times, 2,000 times, 16,000 times, Mr. Kedia. Of course, is it getting tough to pick up multi-baggers now in this kind of market because of AI and because everything gets discounted so fast? Are you finding it tough to sort of find those kind of winners that you identified, say, 15 or 20 years ago?
So regarding the 16,400 times, whatever you said, Anuj, I would like to say that, as they say, कि खुदा मेहरबान तो गधा पहलवान, तो वैसे ही होता है. आप अगर टिके रहते हो, मेरा एक ही ये समझ में आता है कि जैसे आप एआई की बात कर रहे हो, whatever, आपको क्रीज पे पिच पे टिके रहने का आपको. ये सारी चेंजेस हम लोगों ने 100 सालों में देखते हुए आए हैं. टाइपराइटर यूज होता था, उसके बाद कंप्यूटर आ गया, फिर कंप्यूटर आ गया, Y2K आ गया, फिर इंटरनेट आ गया. तो ये सब अगर आप पिच पर टिके हो तो सब कुछ आप सब कुछ झेल लेते हो और अपना रास्ता आप निकाल लेते हो. I think that is what applicable even now also. And second thing, as you said, that finding a multi-bagger, there is a quote of mine that, bull market is like sunshine. It is always there somewhere. तो ये जरूरी नहीं है, लेकिन ये अगर आप एक चीज अगर देखोगे तो 1970s के अंदर में जो टॉप 10 इंडस्ट्रीज इंडिया के अंदर में थे, अगर उनकी आप अगर लिस्ट अगर देखोगे, समझो बिरला थे, टाटा थे, बांगड़ थे, साहूजन थे, गरवारे थे, लालचंद हीराचंद थे, सिंगानिया थे, वो सारी 90 आते आते सारी लिस्ट चेंज हो गई है. उनकी अब आज उनमें 2-3 लोग नाम है, जैसे बिरला है, समझिए टाटा है, नीचे की सारी 7-8 लिस्ट चेंज हो गई. टॉप 10 में नहीं है, ठीक है, बजाज एक है, लेकिन वो टॉप 10 में मतलब बाकी के नहीं है. ये लिस्ट वापस चेंज होने वाली है. 90 में वो ऑलरेडी चेंज हो गई थी. रिलायंस कहीं रडार पे नहीं था, कोई मालूम ही नहीं था रडार कहाँ पे रिलायंस ने. आज के दिन अदानी आ गए, अंबानी आ गए, भारती आ गए, ICICI बैंक आ गया, HDFC आ गया. ये सब 5-10 लाख करोड़ के मार्केट के पहले ये 10-15 कंपनियां. अगले आने वाले 20-20 साल में ये लिस्ट वापस चेंज होने वाली है. तो एज एन इन्वेस्टर हमको ये लिबर्टी है कि आज अगर हमको इसमें अगर इन्वेस्ट करना है तो हम अपना वो इन्वेस्टमेंट अपना बदल सकते हैं. तो मेरे को लगता है कि आने वाले 10-15 सालों के अंदर में इंडिया में इतनी बड़ी अपॉर्चुनिटी होने वाली है. ऐसा लगता है कि जो पैसा आपने पहले बनाया है उससे ज्यादा अपॉर्चुनिटी आने वाली है. लेकिन आपको अपने आंख कान खुले रखने पड़ेंगे, बायस्ड नहीं होना पड़ेगा, किसी चीज से वो नहीं होना पड़ेगा, और ग्रीडी होना पड़ेगा, फियरफुल आपको होना पड़ेगा उसके अंदर में, और लेकिन अनबायस्ड होना पड़ेगा. तो मेरे को लगता है ये सी चेंजेस जो है वो इंडिया के अंदर में अगले 10-15 सालों के अंदर में होने वाले. गोल्डन पीरियड इंडिया का है.
If I can add, what Vijay bhai is saying, आप इंडियन मार्केट मल्टीबैगर खोजने का परेशानी बोल रहे हो. Even in an American market which is like 60-70% of the world overall market capitalization, if you look at how many multi-baggers have been there in the last 5 years in American markets, you will be amazed.
Okay, what's
so
that
there will always be an opportunity to make disproportionate money in equities. It's only after 5 or 10 years we will realize what were the multi-baggers which were available today.
Okay. I mean, Anuj, Nvidia was earning 3-4 years back $4 billion a year. Today it earned $45 billion a quarter.
Yeah.
A quarter. So, opportunities always stare us in the face.
And it still kept, getting bigger. On this base, it's still giving 73% year on year.
And that's what I'm saying. If you can't say multi-baggers, you got Nvidia. 20 years back, go back to Google. You got MetaBook if you bought it at $100.
When will India create our own Nvidias? Huh? When will India create our own Nvidias? At Rising Bharat, I think it's a logical question.
I don't think that's going to happen. We're not really into a tech-driven research. We are better in services because of sheer population. We are better in conserving capital because we have a shortage of capital in India always. So I think we'll focus on what we're good at. Okay. Are we good in leading edge research? I don't see that signs yet.
Okay. So,
and Anuj, एक चीज जो अपने को करना ही पड़ेगा ना, which has not happened in this country, is our percentage of corporate profits being investment in R&D. It still remains 0.5% of the overall corporate profits. Because this country, even on a wealth creation basis, is not rewarding ideas or innovation, but is only rewarding validations. Wherever things get validated, even new age companies in the stock market, जब वो profit बनाता है तो ही उसको P मिलता है, तो ही market cap होता है. So hopefully over a period of time that will change. While in the past we have been able to live through without investing in R&D, but we have to invest in R&D. We have to progress.
Okay. We also don't encourage immigration. I mean, a lot of the companies in America that have created these fortunes were built by immigrants. This is a national economy, domestic consumption, large economy. So we'll play to our strengths.
Now even America is not allowing immigration.
Yes, yes. And so innovation, patents, research will go down.
Maybe we can have reverse immigration now.
It actually will happen. Yes.
Okay. Vijay, any particular theme that you're bullish on right now? We're running out of time, but any particular theme that is you're extremely bullish on right now?
तो इसमें ऐसा यार, मिले ने फूल तो कांटों से दोस्ती कर ली. तो मैंने अब AI का तो अपने हाथ में मालूम नहीं कौन सी कंपनी आएगी, कौन सी कंपनी AI में जाएगी या नहीं जाएगी, क्या होगा क्या नहीं होगा. तो उसकी जो प्रॉक्सी वाली जो कंपनी है, अगर हम उसको अगर पकड़े तो भी अपना जीवन सुधर सकता है. राइट. तो सपोज AI का अगर नहीं मालूम है तो जैसे लोग बोलते हैं कि पावर. मैं एक इंटरव्यू देखा, उसमें चाइना के एक मिनिस्टर ने अमेरिका को बोला कि तुम ज्यादा होशियारी मत लगाओ, चाइना तुमसे कई गुना आगे है, तुम जाकर अपने यहाँ पावर की कैपेसिटी बढ़ाओ, नहीं तो तुम्हारे यहाँ लोड शेडिंग होने वाली है. ये चाइना के एक मिनिस्टर यूएसए को बोल रहा है, हम उसमें से क्या पकड़ते हैं कि यहाँ पर पावर की डिमांड, जब हम तो वहां पर बहुत कम है अभी फिलहाल तो हमारा, तो मेरे को लगता है पावर वाला सेक्टर ऐसा है, उससे रिलेटेड जो सेक्टर है ये नया एआई बन जाएगा हमारे लिए। या मेटल के जो सेक्टर है, जो बातें कर रहे हैं कि हाँ चाहे डेटा सेंटर हो या उसमें क्या मेटल यूज होने वाला है, चाहे उसमें एल्यूमिनियम हो या जो भी हो, वोटेवर हो, वो एक नई स्टोरी बन सकती है। तो हमको ऐसी स्टोरी ढूंढनी चाहिए जो डायरेक्ट, अगर वो नहीं भी हो तो भी उसकी प्रॉक्सी हो, तो भी एक बहुत मल्टी बैगर हमको यहाँ पर मिले।
Okay, same question, 30 second for 2047. If we are looking at Madhubhai, 2047, 20-year horizon. What's the best theme to bet on for India, for rising Bharat?
I agree partially with Vijay Bhai ki AI infrastructure, essentially if we can call it, the companies which are contributing to AI infrastructure, which could be, there will be companies which will build data center, there will be companies which will participate in power, there will be various kinds of opportunities which will come up. But if I take a 20-year view, I am most bullish on people who will be able to use AI for either enhancing their businesses significantly or cutting the cost, right? And still being very, very relevant moat. And Anuj, एक नहीं मैं बोल रहा हूँ, हिंदुस्तान में कम से कम, you mark my word, ऐसी 100 कंपनियां आएगी which will be able to do this.
Okay. Thankfully, I am also using a lot of AI now because I don't want to be redundant. Ramesh ji, very quickly, the theme you are most bullish on currently.
You know, Anuj, I think what will happen is market will want the anti-AI themes. They'll want things that are not affected by AI because it's uncertainty. So infrastructure, it is not affected by AI, will do well. Pharmaceuticals, India is the medicine shop of the world. It will continue to do well. I think metals and manufacturing, which have always been treated very poorly as second cousins commodities, will do well because people want local source of supply. So I would say infrastructure, pharma, and metals and minerals.
Oh, absolutely.
Not 25 years, but next 5 years.
Thank you so much, Vijay Bhai, Madhu, Ramesh Damani. Thank you so much. Please, big round of applause for all our guests today. Thank you so much.
Thank you, Anuj. Thanks.
On the Rising Bharat stage with three gentlemen who are going to talk to us about the India opportunity and the India advantage. Thank you very much for being a wonderful audience. Hitesh, you talked about democratization of finance in the country. He wants to get people to open demat accounts so that they can make money in the stock markets, and then get Santosh Iyer sales so that people can go out there and buy a Mercedes-Benz and hopefully send business Rajiv Memani's way as an auditor. So you've got an example of India's circular economy in motion here. But Rajiv, let's start with the India opportunity and the India advantage at this point in time. We started our post-lunch session with the team from Dhurandhar and who've created quite a storm, not just with the movie, but also with that iconic song. What we've seen happen in the last 12 months is deal after deal, trade agreement after trade agreement. India has been out there batting on the front foot, saying it is time for us to get competitive. It is not time to be protectionist. It's time for us to do business with the world. That's been a sea change in our attitude, hasn't it?
Yeah, absolutely. I think if you look at last 12 months, and if you were to pick up three big changes, I would say the first one is the speed at which reforms are happening. And for scaling up, that's absolutely critical, whether it's on ease of doing business, whether it's improving the competitiveness. Lots of sectors, if you were to reflect back 3 years back, they were not there. Those sectors are there. And government is putting a lot of pressure, whether it's on data centers, electronics, nuclear. I mean, you can go on and on, medical devices, others, and I think that's been fantastic. The second is the way India is now re-engaging globally through FTAs, through bilateral agreements, and I think that's been fantastic. And you're right, I think earlier when we looked at FTAs, it sounded like, you were making Pakiza. It would take 6-7 years to make, 8 years to make. Everyone knew it would be a great movie. But it was taking a lot of time to do that. And suddenly in the last 12 months, 15 months, before one FTA is signed, the other is ready to go, then the other is ready to go, then the next sequel is ready. So I think the speed is just amazing. And
so we've gone from Pakiza to Dhurandhar.
Dhurandhar, yes, yes. And the second, I really feel that FTAs, while people only talk in terms of reduction of tariffs, but as we visit various countries, whenever FTAs are being done, I think it's creating a business platform, which just opens the engagement in terms of investments, mobility, trade, tourism, everything. And it's a government to government, government to business, business to business partnership. And I'm of the view that it'll make India, the supply chain piece that we were looking at, whether you call it China +1 or whatever +1, as we do the FTAs, as we do ease of doing business, as we do reforms, I think the whole thing of supply chain resilience, of manufacturing coming in India in a big way, I think this will provide great impetus. And the third big change, which I'm sure we'll talk about later, and he covered it, is AI. So I feel that if businesses are looking at scaling up and theme, I think these three are going to be great enablers for scaling businesses up.
I'll talk about AI in just a second. No conversation is complete without addressing the AI issue. But Santosh, let's start by addressing what we just heard Rajiv say, that we've gone from taking 10, 12 years to ink an FTA now to getting an FTA done virtually every few months, from Pakiza to Dhurandhar. That's the speed at which trade agreements are being inked. What does this mean for industry? What does it mean for companies like yours who are already making in India? What does this now do to your aspiration of making for India and also making in India for the world?
No, I think, thanks Shireen, and Rajiv made the most pertinent point. FTAs are not about duty reduction, because if you go to the social media, everybody expected car prices to come down, and
you've disappointed everybody.
It's not about me disappointing. We have invested in India, right? So we are already harvesting the India potential. We are locally manufacturing cars at a much reduced duty. So the FTAs cannot be looked at from a perspective of tariff rationalization. I think that's a bigger picture of two-way trade. We as MNCs always advocated open borders, and that's the fundamental reason for global economic growth as well. So I think the real potential of India able to participate in developed economies, and I think we have now prepared India already. The automotive ecosystem is very strong. Many of you may not be even aware the balance of trade for automotive components to Europe is positive for India, actually. So we are exporting exporting more parts to Europe than importing from Europe. So I think the stage is set. The Indian industry really took this time to also scale up, and now I think this is the right moment. Once, of course, it would take another 18 months for the deals to 55 for all the fine print to happen. But and then there can be only an upside, not only in manufacturing but also a lot of intellectual capital movement. There is a clear discussion about protection of investments for European companies in India. So that also means more capex, more growth momentum to come up. So FTA, I think, will be one of the biggest game changer in the next couple of months, if not years.
Well, it will be the biggest game changer, but let me just build on that. Now, when we talk about this India opportunity, and I want to, again, for the benefit of our audience, look at the India automotive market in the luxury car segment from Mercedes-Benz's lens. And you've been in India for over 2 decades now. In fact, going into, what is the latest number?
32 years in India.
32 years in India. And you're still selling a little over 19,000 cars in India. How many cars do you sell in China?
Close to 5 lakh cars.
Close to 5 lakh cars. Now that's the annual number. 19,000 versus 5 lakh is the annual number, India versus China. What's the headroom for growth? And to address Rajiv's point, what does that mean then in terms of further capex, scaling up your business from here on?
Shirin, this question is not only asked by you, but also by my colleagues back in Stuttgart saying what's happening, when is the inflection point. Let's understand that China's growth was very different. It was a state-led growth. A lot of capex, state subsidies, support. There was a target for production, and you build capacities. And whereas India's growth is consumer-led, consumer economy-led. So it's not a government intervention where production capacities are built up. And if you read the articles, you see what's happening in China. There is overcapacity now. So it's more structural, a bit more slow than what we would imagine. But the runway is there. The penetration of cars to people is hardly 42,000 compared to China at 250, Germany at 600. But these are all wrong metrics, because I think for the biggest change point in the last 20 years is decarbonization. China didn't have that agenda as much as what India has today to grow. So if we don't decarbonize the industry while growing, we will actually have a crisis on public health. We will have a crisis on our oil import bill, and the rupee already we know is under a lot of stress. So the challenges are different, and it's a very consumer-led economy with a very different government intervention. So we are pragmatic. We call always strategic patience. We were patient. The structure of the market has changed from a low-selling, cheaper cars to today our average selling price is going up to 1 crore of rupees. The mix has changed from...
You're now manufacturing the Maybach in India as well.
And India is the top 5 Maybach markets in the world. That shows the structure. So if you only look at the volume from one single prism, maybe it may not be right. But structurally, it's showing a very positive trend. We are quite optimistic, and we already localized the first car, and we have committed, you will hear very soon, further localization in India.
As far as the Maybach is concerned.
Not only Maybach, but some other car as well. We will do it in India this year itself.
Okay,
so we will continue on the localization agenda.
So localization and doubling down on that. Hitesh, you gave us a glimpse into what intelligence could mean as far as financial services are concerned. Through the COVID period and post-COVID, we've seen an explosion as far as financialization is concerned. We've seen record number of demat accounts being opened. Of course, the Indian mutual fund industry has grown in AUM, but it's nothing in comparison to the kind of AUMs that BlackRock is dealing with globally. Now, how do you see India, the opportunity, and what do you believe we could, your colleagues believe that we could double the size of the mutual fund AUM in the next 5 years?
No, absolutely. Good question, Shireen. So if India's economy is to double, and people double, triple, and people talk about time frames being different, 5 years, 10 years, 15 years, financial services typically grows at a multiple of that, at least 1.5 or 2x of that. While you're absolutely correct that during COVID period, there was suddenly a pole vault in terms of digital adoption in the country. The public digital infrastructure was set well in place before the COVID period, and it picked up, whether it's UPI, whether it's the account aggregator, etc. You think about insurance penetration in the country, it's still under 4%, significantly lower than where other developing economies are. I'm not even comparing with developed economies. Look at credit penetration, significantly lower. While our AUM in the mutual fund industry, and you're absolutely correct that it has grown from almost a very small number 10 years back to about 80 lakh crores right now, the runway is huge for us. And therefore, we believe that there is an opportunity in every area, and COVID has helped catapult the digital adoption in the country, which is frankly going to help us reach the length and breadth of the country much faster than what it would have been otherwise. So I think the opportunity is enormous in front of us across the spectrum, not just in investments or insurance, but even in the lending area.
Yes, absolutely. You're saying that there is a significant headroom for growth. Well, you can get Hitesh's app or any other app, but you have to watch only one channel when it comes to financial advice, and that's CNBC TV 18. So,
Get only our app.
And we should put us on your app. While, of course, the trade agreements are one aspect of the story, enhancing competitiveness, and that is going to be key to India upping its share of the global markets. The gauntlet has been thrown to industry. The government is saying we've done our bit in terms of structural reforms. Industry now needs to get much more competitive. What do you see as the next building blocks in that effort for Indian manufacturing, Indian industry to become more competitive?
Yeah. So I mean, I think reforms is an ongoing process. So I don't think we are done with reforms. We are probably 30–40%. I was talking to someone in the morning today, and he was telling me that to run a shopping mall, you still need to do 500 to 600 compliances every year. My only response is that government today is very open. If you want to go represent, change things, go with the problem, go with the solution and move. So I just wanted to say that that's very, very important. I think from an industry standpoint, a lot has happened, Shireen. I think the power energy costs are getting more competitive, but still I think we need to go through an active disinvestment of the distribution sector in India to happen so that the energy sector becomes more competitive, open access on distribution, the way on land, on other areas, logistics costs have come down, but still relative to what we see, it's still slightly higher. Interest costs, we still have a delta of 4 to 5% relative to some of the countries that we are competing with. So there are still lots of factor cost efficiencies that are required. Notwithstanding that, I think from an industry standpoint, what we are seeing is that if you look at India's imports today, we would still import $500 to $600 billion of merchandise goods. If you look at future imports, data centers where India will be investing like 13 lakh to 14 lakh crores over the next 4 to 5 years. If you were to look at it, 8 to 9 lakh crores of imports will still be made there. If you look at multiple things, nuclear will be another area, the entire energy sector that we are seeing. So I think India needs to be actively looking at those things where we can localize. So whether it is through technology partnerships, whether it's through policy initiatives, whether it's through things like PLI schemes and others, I think that if we can do, that will give a great impetus for growth. From an industry standpoint, I think there are two things, at least I think, that are very important. First is that R&D spends are a challenge. And I think Indian industry needs to see how we can build the moat around R&D. And when I talk to industry, one of the key things is the financialization of the Indian economy has happened much faster
than R&D.
R&D. So if today a company announces that I'm going to spend $1 billion on R&D, their stock price will immediately fall down. If the company announces that I have done out-licensing of my products and I'm getting $400 million for out-licensing my products, the stock prices moves up. So I think for a lot of entrepreneurs, especially in the startup side, I think it's a big issue, big decision. I'm not blaming the economy, but I think from an industry standpoint, given that a lot of ownership is concentrated in India, I think we need to be investing much more on the R&D and building moats, which will give rise to competitiveness in a very, very significant way. And you were saying something?
No, continue.
And I think the second thing that we need to do is also, in some areas, look at aggressive build-up, both domestically and globally. And I think that's something that we'll be seeing. So I personally think that from an Indian standpoint, if we can get the cost of capital also right. Today, the delta in the cost of capital is almost 4 to 5%. So for Indian industry to be competitive, getting the R&D investments, trying to see, obviously a lot of things around of cost of capital are led by either cost of debt, cost of equity, risk associated with India, which are macro factors. We need to reduce that. But if we, through governance, through other things, if we can reduce the cost of capital, focus more on R&D, try and see how we can take longer term bets. And in the meantime, if we can identify areas of manufacturing where there's massive scale available. I mean, in Indian infrastructure, Indian manufacturing, we are still not seeing so much of Indian companies coming into manufacturing in a significant way that if you put all those things together, I think the opportunity to scale today in India 5 years, 10 years from now with some of the companies, the scale that they'll be acquiring will be huge and very, very significant. I'll resist on the impact that AI will create, but I think it can tremendously enhance competitiveness.
Let's talk about AI. You know, Hitesh clearly is betting on AI being able to get him to his last customer, travel the last mile. But AI, both an opportunity and a challenge at this point in time. You were talking about stock prices and you said that if companies were to announce that they're making significant R&D investments, the stock price would actually fall. What we saw happen in the US last night, Jack Dorsey, the former founder of Twitter, his company's laid off 4,000 people. The stock price was up 20%. Rajiv Memani, what is this AI transformation going to mean for India, for Indian jobs? Are you worried? Are you optimistic?
Honestly, I don't know. So
maybe we should have a maybe box now.
What I know is that a lot of companies will undergo, especially those in the services sector per se, even some parts of manufacturing. A lot of companies will be undergoing massive change. When you go through change of this kind, some companies will fall by the wayside, and some companies will really double down and succeed. The nature of jobs that are being done today will change significantly. A lot of companies that adopt AI and are able to adopt, even in the normal manufacturing retail sector, the adopters of AI, also those who can adopt AI effectively and successfully will be very successful. I mean, I think the best example today that's given is you look at New York Times versus any other newspaper, the way they adopted technology, or you look at Walmart and versus, you know, other retail chains in the US, and the way, and you know, Walmart has crossed $1 trillion. One of the key reasons is the way they've adopted technology, AI and other things. So I think we are in times of massive change. I think there will be a few winners, maybe a lot more losers, but India has a unique opportunity because the talent that we have. AI also requires massive adoption. Yes, a lot of things can be done, but to industrialize that at scale, to ensure that the data is right, to ensure that it works at enterprise level, to look at the governance of the data and the risk that it creates, you need huge amount of people. So I think there also, there lies a big opportunity. At least what we are seeing today, the enterprise adoption in India is really scaled up. And I think what happened in Delhi the last week or week before last.
Last week.
Last week. I think that also gave rise to, I mean, at least we can see what's happened with in the last 2 months with Anthropic and others versus what's happening, what happened here. I think the adoption, enterprise adoption, the excitement, the urgency has really gone up. So I think the jury is out, but I do believe that those who are able to successfully adopt as organizations, as individuals, as governments, I think they will probably turn out to be, you know, the
the jury, as you point out, is still out. But Santosh, what is it going to mean from a manufacturing standpoint? Again, there's fear what happens not just to white-collar jobs, but what also happens to jobs on the factory floor. Are they going to be replaced completely by humanoids and so on and so forth? Hitesh is likely to replace everybody with agents, but what happens to manufacturing with AI coming in?
No, surely there is a disruption, and instead of resisting the disruption, we need to embrace it, because otherwise, the market won't be forgiving. You have to see AI is one spectrum, robotics, and then there is also quantum. A lot of development happening there, and it took 20 years to reach there, but it may just need 2 more years to do more when you take all the three together. I think for long, our manufacturing competitiveness as far as India is concerned was always on labor cost arbitrage. Then we were started to discuss about logistic cost and so on and so forth, interest costs and others, that we need to now take care of all of this to become more competitive. But actually AI and robotics can give a big leap, if you want to transition by skipping a certain prognosis. I think this is the time for manufacturing sector to adapt even more rapidly than others are doing and trying to create a competitive advantage.
So don't be afraid, you're saying.
I think,
embrace.
Yeah, embrace, and this entire fear of job loss, actually, that's what is causing a more panic than what it is. If you take it, there are large enterprise systems in organization. Somebody has to connect them with an AI agent. So I think there will be still requirement of service sector IT employees who can develop an AI-based ecosystem. So and that's also services. So maybe it will be a shift into what we do from coding to to linking AI-based services to enterprise solutions and so on and so forth. But the opportunity exists.
Hitesh, an agentic future is what you believe in?
Yeah, so my view is I agree with what Rajiv said, that the core of AI is going to be data. Organizations which are able to get their data stack in order, and therefore organizations without too much legacy are the ones which are likely to get slightly ahead on the AI race. That is one. And second, as far as job situation is concerned, the bottleneck in the value process is now not anymore analyzing the data. That is something that the machine can do. The bottleneck is going to be, how can you guardrail the data? Can we make AI work for the customer?
Yeah.
Most use cases that we see today, AI is working for the institution. Can it solve something for customer service? Can it solve for marketing? But can we truly make it for customer? And that is where I think the diffusion of technology is going to happen at pace, and society will see value. So, and human in the loop will remain. It's just that the choke point is not going to be in the job we were doing yesterday. The value creation is going to be at a higher level.
So human in the loop will remain. That is good to hear. Gentlemen, let me end by asking each one of you, since all of you are clearly bullish and confident and optimistic about the future. We started with Pakiza and Durandar. Santosh, let me ask you, if you had to sum up the India story in your favorite song or favorite movie, what would it be?
Actually, Durandar is all over the place because of what's happening. But but I think I'm just repeating. In the past, I had said once that we have this famous song, "Hum honge kamyab ek din ek din." That ek din is hopefully now and won't get postponed further. And
So
it
hum
should happen
honge
now.
kamyab aaj and ab. Okay,
Yes.
Rajiv Memani. No, but you have to give us the sequel, na?
No, I mean, honestly, I think I don't want to give us. I mean, I can't think of a song immediately. You put me on a spot. I thought of the movie.
You'll have to move your mic up so that everybody can hear you sing.
No. I can't think of a song right now. But I certainly said that it's a. I think most of the factors are lined up very well. I think the technology challenge is the real challenge, and how we overcome. Outside of that, macroeconomic, political stability, reforms, institutional strength, balance sheet strength, lots of new opportunities, scale up. I mean, most positive.
अपना time आ गया.
अपना टाइम आ गया है, पहले भी आया था, उसको कंसोलिडेट करना है.
अब उसको consolidate करना है. Hitesh, the final word to you.
Yeah, I think you said it. Apna time aa gaya hai. And 2 sessions back, I think we had this music of New India. I think that sums up everything. I mean, we will have music, that's for sure. It's just that the format of music is going to change. That's about it.
Well, the conductors have given us a prescription on what the road ahead looks like. The building blocks are in place. The question now is one of accelerated pace of adoption of technology, scaling up at a faster pace as well, and engaging with the world in a much faster way as well, and ensuring that India stands competitive and stands strong. Rajiv Memani, Santosh Iyer, and Hitesh, many thanks for joining.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. Defense tech startup Constelli bags $20 million in round led by General Catalyst. 361 Asset Management and Pravega Ventures also participate. Proceeds will be used for research.
EdTech major Unacademy initiates a 50 crore rupee ESOP buyback program to offer liquidity to its employees. Making the announcement on X, Unacademy says 8 employees are set to make 1 crore rupees through the buyback, while 17 employees will get over 50 lakhs.
Workspace startup Tablespace prepares for an IPO likely to comprise a fresh issue of shares worth 1,000 crore rupees and an OFS component raises 200 crore rupees in a pre-IPO fundraise through private placement.
Netflix drops out of the race for Warner Brothers Discovery, refuses to hike its offer to meet Paramount Skydance's renewed $111 billion bid, says the deal is no longer financially attractive, but the Paramount deal still has to clear multiple regulatory reviews.
Twitter co-founder Jack Dorsey's blocked plans to lay off 4,000 people on nearly 40% of its workforce as it pivots towards an AI-centric future. Dorsey admits that they overhired during the COVID-19 pandemic. The stock rallies 25% in extending trading. Well, those were the headlines we've been tracking for you this evening. India's wellness economy is flexing new muscle, moving from basic step counts and calorie logs to bio-tracking metabolic health, recovery scores, and full-stack data-driven longevity platforms. The shift from passive tracking to proactive, measurable health span gains. That's the play Gabbit is making. Founded by former Zomato co-founder Gaurav Gupta, the company is building an integrated longevity ecosystem, blending a smart ring, AI-powered health coaching, biomarker diagnostics, recovery analytics, skincare, and personalized science-led nutrition into one unified platform. Over the past year, Gabbit has doubled down, acquiring Sweden-born clean nutrition brand NAC to plug supplements directly into its real-time data loop and bringing on high-profile backers like Ranbir Kapoor and Badshah as investors. Joining me now to decode this full-stack health and performance play is Gaurav Gupta, founder and CEO of Gabbit. Gaurav, welcome back to Startup Street. You call Gabbit India's only fully integrative longevity ecosystem. So what are you building at its core? A hardware company, a supplements brand, or an AI health platform? Is the real moat, Gaurav, the ecosystem itself? And where does long-term defensibility lie?
Hi, it's good to be back. So at Gabbit, we are building a health ecosystem where you can actually track as a consumer, as user, 150 plus markers on one single platform. Because all this data is interconnected and you should be able to measure your data from the wearables, from the blood test, or from CGM or from a smart scale on one single platform and really see which parameter is impacting your health rather than that sitting on different platforms. So that's what we've designed, but we go beyond data as well, because at the end of the day, consumers are looking for health outcomes and not just tracking.
Yes.
So and that's where the integration with NEC, where we actually now offer supplements to customers to actually improve their health based on the tracking that they see. And I think the defensibility here comes from the fact that you can actually, the ecosystem has all the data which assesses you completely and comprehensively to deliver those personalized outcomes.
Sure. Gaurav, you acquired NAC last year. What strategic edge has owning the supplement layer given you, and what kind of demand and repeat behavior are you seeing? And will NAC remain a standalone premium brand, or will it be fully integrated under Gabbit?
Tracking and supplements are very, very closely related. One should only take supplements based on tracking, because all of us have a different disposition to absorbing supplements and what they do to you. And that's why we brought it together. And I think before you take a supplement, after you supplement, you should track yourself either using a wearable or blood markers so that you know that's working for you. NEC is already part of the Gabbit ecosystem, and we actually plan to launch many more products to help solve many more health goals for customers.
Okay, let's talk about the smart ring. It competes with global players like, Aura Health. How does Gabbit stack up on accuracy, validation, and pricing? And like you mentioned, you track over 150 biomarkers across ring data, CGM integrations, and blood work. So how medically validated is this data, and can it move beyond wellness into preventive healthcare?
So we have built Gabbit around the philosophy of the 4 pillars, which is fitness, nutrition, sleep, and stress. So we are the only wearable in the world which focuses on all these 4 meaningfully. And that's where you're able to get a very comprehensive assessment. A lot of focus, of course, is on usability as well. So, for example, it offers a 10 days battery life to you, which is much more user-friendly than most other products. And we use AI features to help you use it better. There's an AI health coach called Pep, which actually helps you understand all the metrics as well. So we've done all of that. In terms of accuracy, of course, that's hygiene today for health markers. And if you look at a heart rate, we've actually benchmarked with a chest strap, which is the gold standard. Or for VO2 max, it's benchmarked with high accuracy to a lab-based VO2 max test, where you can actually clearly assume and you can actually experience an over 90% accuracy for these markers.
Okay. You mentioned AI coach Pep. How are you building a predictive health engine that evolves with each user and with sensitive health data at scale? Gaurav, how are you handling privacy, ownership, and regulatory compliance?
So the good thing is because of these wearables, it's become so easy to track your health now. You just buy it online, put it on your finger, and you start your health journey. And the interesting part is that all of this is continuous data monitoring, which means this ring exactly knows when my heart goes out of rhythm. Now, if you look at this data over a period of time for individuals, we're actually working on projects where we will be able to give predictive insights about, let's say, an onset of a major illness in the future as well. Because, again, it's real-time continuous data, which is super powerful. And with AI coming in, it's become even more possible to do that. I think our philosophy on data privacy is very clear. The center point of everything is the customer. So the customer owns the data, and the entire system and entire features are designed around that. For example, we even have a feature where a customer can share their data with their doctors or their coaches or their loved ones, but they have to do that. And of course, we build all the systems and techs to make sure that we are actually secure. We're even GDPR compliant now because we started operating in a couple of European markets. So yeah.
All right. Like I mentioned earlier, Gaurav, you've bought on celebrity investors like Ranbir Kapoor and Badshah. You've also raised $9.5 million from marquee backers, including Norwest venture partners and founders like Dipinder Goyal and Kunal Shah. When do you see Gabit turning profitable? And give us a sense of current growth metrics and your revenue momentum.
So in a short period of time, we're very happy with the momentum that we've achieved. I think Gabit has become synonymous with wearables and tracking in India right now. A lot of people, when they see a ring on somebody's finger, they now assume that it's probably a Gabit. So I think we're very, very happy with the kind of love and feedback we've got from customers. And we basically want to continue to build on this momentum.
All right. So profitability by when? When do you plan to turn profitable?
We are early on our journey, and we want to make sure that we're actually building a strong ecosystem which can make India healthy.
Okay.
And I think as you understand, changing behavior takes time. So it's very early in our journey right now.
Sure. One final question. What's next? Global markets, deeper diagnostics, insurance partnerships, or positioning Gabit as India's preventive healthcare infrastructure layer?
So the good news is that Gabit is already moving to some global markets. So we're actually present in UAE and UK now. But I think the more important goal for us is to make sure that all of us in India get healthier and we live healthier and longer. And the most important thing is that we all need to understand that tracking is not for people who just go to the gym or think about health. Tracking is for everyone, because when you look at somebody from the outside, you really need to understand from the inside how your health is. And that is where the tracking, like blood test and wearables, come into play. So we want to make sure that India gets into the Gabit or good habit of tracking regularly.
Well, we hope so too, and wishing you the very best, Gaurav. Thank you so much for joining us on Startup Street today.
Thank you very much for having me.
And moving on, India's enterprise tech ecosystem is entering a new phase of maturity, and early stage capital is getting sharper and more specialized. Aquarius Innovatex Fund, the venture arm of Aquarius Group, has just announced the final close of its maiden 166 crore rupee fund focused on deep tech, SaaS and fintech startups at the seed and pre-series A stage. With over a third of the corpus already deployed across 7 startups, the fund is betting on founders solving structurally complex problems in enterprise tech. But in a crowded seed ecosystem, what truly differentiates operator-led capital? And can this model build enduring category-defining companies? Joining me now to discuss this further, Sadhika Agarwal, the leading investments at Aquarius Innovatex Fund. Sadhika, thank you so much for taking time out and being here with us on Startup Street. You know, Aquarius has traditionally been known for investment banking and financial services, right? What sort of led you guys to launch Aquarius Innovatex Fund, and what gap did you see in India's early stage B2B ecosystem that this fund is uniquely sort of positioned to fill?
Thanks, Arundhati, for having me here. So as you rightly said, Equirus has been a financial services group, widely known for various financial services. The reason we started this fund is because we just saw, a lot of great investment opportunities. Everybody who is involved with the investment team, with the investment committee, are people who come with operating or founding experience, who've been ex-founders, ex-operators. So we saw we saw a gap of early stage investments largely being followed by financial investors, and the idea was to basically come in and add a lot more value apart from providing financial capital.
Sure, and if you could quickly tell us, you're backing deep tech, SaaS, and fintech at the seed and pre-series A stage, right? Areas that sort of require patience and deep conviction. How large and durable is the opportunity in India's enterprise tech landscape today, and what are the kind of ideas you're looking at?
So broadly, we invest in B2B tech, and under B2B tech, we largely invest in software and deep tech opportunities, and selectively fintech opportunities as well. We truly believe that deep tech is the largest space to invest in this decade, and it's going to be as important to this decade in India as IT services or SaaS once was in the last 20 years. There is a very strong and growing pipeline of deep tech startups in India, extremely high quality, resilient pool of founders that were either operators or in research and have spent, half a decade or, a decade in complex R&D cycles. After they've proven out that science and built their core IP, I think this is a great time to invest in deep tech and SaaS opportunities in India.
So no worries over the SaaS apocalypse that everybody's been talking about?
I mean, honestly, AI is here and it's real. It's not debatable. It is, I think, the world's internet moment. What internet was 25 years ago is what AI is today. And I feel that the pace of change with respect to AI is partly blown out of proportion. Technology as we know it is being disrupted, and I think the pace of change in select layers or functions or workflows is going to be different from one another. With AI, what is very interesting is that even building or creating or founding companies and building on ideas is truly getting democratized, which leads us to believe that there will be a much larger pool of builders and creators that is not limited by technical skills anymore. And ultimately, AI is here, and it is only and only going to improve productivity in a lot of workflows that can be disrupted.
Sure. And you've sort of coming back to the fund, right? You've already deployed over a third of the corpus across 7 startups with a target of up to 15 companies, right? How are you sort of thinking about the portfolio concentration, follow-on reserves, and timelines for full deployment? Give us a few examples of the kind of companies that you've invested in and what you're looking forward to.
Sure. So we started investing, we launched the fund actually 2 years ago, and we started investing a year and a half back. We are now 9 investments down. We've invested in a fintech company, in 6 software companies, and 2 deep tech companies. Broadly, we expect about 50 to 60% of the fund's corpus to go into fresh investments and keep the remaining for reserves to double down in our portfolio companies. From our fresh investment corpus, we are, I would say, pretty much 50% deployed. We expect to invest in another 5 to 7 companies over the next few months. And post that, we expect to launch our next fund in the next 1 year.
So a new fund in the next 1 year and another 5 to 7 startups from the current fund. All right, Sadhika, thank you so much for taking time out and being here with us on Startup Street.
Thank you.
On that note, it is time for us to head into a short break. But coming up next, SkyAir Mobility has unveiled a network where drones, smart mailboxes, and autonomous rovers work in sync with no human in the loop for deliveries. Stay tuned for that story on the other side.
Welcome back to Startup Street. At the India AI Impact Summit, Sky Air Mobility has unveiled what it calls the world's first fully autonomous end-to-end commerce delivery system, a network where drones, smart mailboxes and autonomous rovers work in sync with no human in the loop. My colleague Aishwarya Anand caught up with the CEO and founder of Sky Air Mobility, Ankit Kumar, to understand how this no human, fully autonomous network could reshape the future of delivery. Take a look.
Imagine ordering something online and no delivery executive ever touches it. No rider, no warehouse handler, no last mile courier. Well, it is just a drone in the sky, smart drop point and a robot that brings it straight to your doorstep. Now, well, that's exactly what Sky Air Mobility is unveiling here at the India AI Impact Summit. What they're calling the world's first fully autonomous end-to-end commerce delivery system. After completing 3.6 million drone deliveries and saving over 1,000 tons of CO2, the company is now betting big on AI-powered air traffic control and robotic handoffs to redefine urban logistics. So, is this the future of quick commerce, or are we watching the birth of an entirely new delivery economy? Well, let's find out. You are launching something called as the world's first end-to-end autonomous commerce delivery system. So break that down for us and help us understand what's new here and why is this a global first?
So we wanted to make a difference in the world of physical AI. So what we wanted to do is we have brought in two partners with us, Arrive AI, which is building these smart mailboxes which are there, which are capable of receiving the packages. We still utilize this infrastructure in certain few pockets that we have installed and residential townships and things like that, which are essentially there. But we have also introduced autonomous rovers into the whole picture, where everything, so the drone, the pod and the rover are in sync with each other, and it creates an asynchronous end-to-end delivery without the man in the loop.
Now with a 10 kg payload capacity and all-weather capability, which use cases today is driving the most demand for you, whether it's e-commerce, retail, healthcare? Give us a sense of that.
It's primarily e-commerce, just because of how you see the advent of quick commerce happening in the country. The e-commerce companies do face a heat of that, because things that you're ordering from e-commerce platform, which were arriving in 1 day and 2 days, are now being ordered through the quick commerce platform. So the market has really shifted over there. It's not that suddenly a new market has emerged. Part of the market has shifted from e-commerce to quick commerce. Part of the market has shifted from the kiranas to quick commerce, right? And that's how the quick commerce is emerging and becoming better. The D2C brands, which are paying so heavily on quick commerce platform, or the e-commerce platforms, which are typically were delivering in 1 day and 2 day, are looking at a more speedier solution to come in for, which can do a 2-hour delivery, which can be a very custom-made deliveries which can happen. Like you may have heard about Myntra's M-Now, 30 minutes delivery, etc. The convenience is what people want today.
Now with this announcement and this launch, how do you expect it to change your business?
Our deliveries which are being made to the societies and townships, to the consumers living in a residential township, nothing is going to change there. We are not going to place the rovers immediately over there. There are walkers over there, which are a term for the gig workers that we work with, and they're going to be deployed over there. They're going to be utilized over there. Where we see a right utilization of the rovers coming in is places like Cyber City. It's places like Manyata Tech Park and large places, large office buildings, etc., where the riders are not allowed due to security reasons.
So you would cut down redundancy by what percentage with this?
We would cut down redundancies by almost 60 to 70%.
And with that, it is a wrap on this edition of Startup Street. From Shruti and me, goodbye and many thanks for watching. More news and updates coming up on the other side.
Hello and welcome to India Business Hour. I'm Ashmit Kumar. Here are the headlines that we're tracking this evening. India registers a growth of 7.8% in the third quarter as per data based on new GDP series. FY26 growth pegged at 7.6%. The new series indicates that India has been growing at a rate of over 7% for the last 3 years. However, a lower nominal GDP outlook may put some pressure on the fiscal glide path. Equities see a sharp cut in the last hour of session after trading in the red for most of the day. Weak global cues and jitters ahead of GDP data sparked broad-based selling across sectors. All major indices end over 1% lower. It's the third worst weekly performance for the markets this year. Commerce Minister Piyush Goyal says that the India-US joint statement highlights that should the circumstances change, the trade deal would be rebalanced. Says India is closely monitoring developments in the United States days after Supreme Court struck down Trump's tariffs. Canada's Prime Minister Mike Carney lands in India for a 4-day visit as he tries to exorcise the ghost of Canada's chaotic relationship with India under Justin Trudeau. He will meet Prime Minister Modi for the third time in 10 months as both countries look to boost economic affairs and bilateral trade. Anthropic CEO Amodai rejects the US Defense Department's ultimatum demanding unrestricted access to the company's AI tools. An 800-word note highlights that the company would rather not work with the Pentagon than agree to uses that may undermine rather than defend democratic values. A Delhi court acquits Aam Aadmi Party chief and former Delhi Chief Minister Arvind Kejriwal, Manish Sisodia and others in the liquor excise case. Pulls up the CBI for implicating them without any material evidence or witness testimony. Says it found no overarching conspiracy or criminal intent in the excise policy. Netflix drops out of the race for Warner Brothers Discovery, refuses to hike its offer to meet Paramount Skydance's renewed $111 billion bid, says the deal is no longer financially attractive, but the Paramount deal still has to clear multiple regulatory reviews. Pakistan declares an open war against Afghanistan after both nations trade cross-border fire overnight. Islamabad bombs Taliban targets in Kabul and several other cities, claims around 133 fighters were killed. Taliban says its airstrikes have hit military targets in Pakistan. Another round of talks between US and Iran end without a deal on Tehran's nuclear program. Iran's foreign minister calls the discussions intense. More negotiations to convene in Vienna next week. US advises its citizens in Israel to fly out if they want to. Well, we'll come to all of that and a lot more in just a bit. But a week to the day's market action, the Wall Street witnessed a broad-based fall with all major indices falling over 1% each. The Nifty fell below the 25,200 mark, tracked by financial heavyweights. 45 out of the 50 Nifty stocks closed in the red. The Sensex fell by over 950 points. For this week, the market ended lower and all major indices closed in the red. Benchmark indices have fallen by nearly 2% this week. The mid-caps and Bank Nifty dropped nearly 1% each. Nifty Realty and IT took a beating this week and dropped over 4% each. The Nifty IT has now fallen over 19% during this month, its biggest fall since September of 2008. Well, the big story that we're tracking this evening, India has registered a growth of 7.8% in the third quarter as per data based on new GDP series. FY26 growth has been pegged at 7.6%. Lata Venkatesh joins us now with more details. Lata, take us through the numbers and what the guidance for FY26 looks like.
Yes, that's right. The new GDP series indicates that India has been growing on a fairly robust pace of over 7% for the past 3 years. 3 years ago, that is FY24, the growth number has been brought down from 9.2 to 7.2. But no worries, last year, FY25, growth has been bumped up from the earlier 6.5 to 7.1%. And in the current year, which is what is most important, the GDP growth has come in at, the estimate has come in at 7.6%, better than the 7.4%, which was the first estimate of the MOSPI. So the new series indicates that India has been growing at a 7% plus pace for the past 3 years, which is very good. Now, within the numbers itself, manufacturing is showing a terrific rate of a pace of growth of 13% in the Q3, 13.2% in Q2, and 10.6% in Q1. Not just that, even if you went back to the previous 2 quarters, at least for the last 5 quarters, manufacturing has been growing by a robust double digit. So that is yet another positive from this. What has been growing slowly is actually agricultural growth, not doing too well. The latest quarter is only 1.7, and that's also because prices have fallen, and that has deflated the real GDP growth as well. The other positive that is coming from the numbers is that services growth, trade, hotels, transport and communication, which is an employment-intensive sector, it includes all the small restaurants, the bus services, that is growing at a fairly robust 11% in the latest quarter, that is Q3, 10.4 in the previous quarter. So that's another area of positive growth. What is worrisome? The nominal GDP in the new series shows that the current year's GDP is 345 lakh crore. The original estimate in the budget and as per the MOSPI was 357 lakh crores. So we are a good 12 lakh crore lower. What does this mean? Trouble for the fiscal deficit. A fiscal deficit of 4.3% of the nominal GDP now works to a good 50,000 crores less. This year, the government can run a fiscal deficit of only 15.2 lakh crore, not as they originally thought 15.7 lakh crore. So they may have to crunch their expenses. For the next year, the problem is even worse. The government had assumed a nominal GDP growth of taking the nominal GDP to 393 lakh crore, but from the current 345 lakh crore, it will mean a 13.5% growth, which is looking very, very difficult. Given the current nominal GDP, the next year's nominal GDP will be lower than what the government assumed, so they may have to tighten their belt a little more to achieve the 4.3% fiscal deficit. So everything good about the GDP numbers, except that there is a problem of belt tightening for the government.
The manufacturing growth rate has been quite exemplary in the last 3 years, and the share of GDP broadly remaining the same, with agriculture going up slightly, and these are as in the current price series. Services sector is slightly down. Growth rates of investment have held up. These are basically, let's remember that the FY26 numbers are second advanced estimate. We still don't have the full year's numbers. Overall, the private consumption growth rate is quite resilient. Rural consumption has been quite strong. Urban consumption is recovering on the back of the direct and indirect tax relief provided in the course of calendar year 2026.
Given the Q3 data that we had received.
At 7.8.
So at 7.8, that's right. So a combination of Q1, Q2, Q3 and the expected for Q4. So we are expecting a healthy 7.6% growth rate. And if you look at all the last 3 years, the real growth has been consistently over 7%, which shows that the economy is very resilient, despite the different external shocks that may have happened globally.
Now, Commerce Minister Piyush Goyal has said that India and the US joint statement highlights that there would be a rebalancing of the trade deal should the circumstances change. Speaking at the News 18 Rising Bharat Summit, Goyal said that India is closely monitoring the developments in the United States days after the Supreme Court struck down Trump's tariffs.
They have many other tools that they could possibly use. They've already used one of them, Section 122, by which they put a 10% tariff. I think they are on record that next week they may increase it to 15% for the first 150 days. So there are different evolving dialogues that are going on. We'll have to watch. And by the way, you must have read my joint statement. that we had finalized with the US, it has categorically said that should the circumstances change, the deal would be rebalanced. At 50% tariff, we were at a huge disadvantage in our exports. And the fact that we were able to bring it down to lower than the rest of our competition was a huge win for India. It would have opened the doors to a lot of agricultural exports also.
Big tech companies have written to the telecom department against the SIM-binding rules issued by the government. The Broadband India Forum claimed that the rules are unconstitutional and beyond the scope of the Telecom Act. The forum has requested the telecom department to reconsider the rules, taking in mind these legal considerations, citing risks like duplication and jurisdictional conflict. Telecom Minister Sindhia said that SIM binding has become mandatory from a security perspective.
SIM binding today becomes mandatory from a security point of view. Now, we've issued a regulation that stands, as I've mentioned in a few interviews before, and we do hope that all service providers come on board, because this today is my fiduciary responsibility to 140 crore Indians, which I cannot stray away from.
Well, Jio Financial Services has launched its AI-led Jio Finance app and introduced an early access initiative called Finsider. Speaking to Shireen Bhan on the sidelines of the Rising Bharat Summit, MD and CEO Hitesh Sethia said that the platform aims to cater to financial products across insurance and lending. He also said that the app will be customized to each user with agentic AI and neural networks.
Our thinking was we need to launch a marketplace which should cover the length and breadth of every product across investment, insurance, lending products. Now, if you offer so many products, obviously there is a lot of choice fatigue. To solve for that, we said we want to make it agentic, so that what is relevant for you as a customer is what is shown to you. Okay. And this is based on computation and mathematics. This is not based on intuition. This is not based on anything else except your context, your information.
So each app is going to virtually be different for every customer?
Yes, and that is the neural part of it. So that if your OTT and e-commerce app, Shireen, can show what you want, then why not your financial service?
Well, Canada's Prime Minister Mark Carney has arrived in Mumbai for the first official visit to India after assuming office. Prime Minister Carney will meet business executives and other stakeholders in Mumbai. He will visit the national capital on the 1st of March, where he will meet Prime Minister Modi. Both leaders are expected to hold delegation-level talks at the Hyderabad House. Prime Minister Carney is also expected to focus on trade negotiations, investment opportunities, cooperation in nuclear energy, and critical minerals technology. Well, the race to buy Warner Brothers Discovery Studio and streaming assets is coming to an end. Streaming giant Netflix has pulled out from the deal after WBD's board said that Paramount Skydance's revised bid was the superior offer. Earlier this week, Paramount had revised its bid to buy Warner Brothers assets to $31 per share in an all-cash deal. Remember, Netflix had granted WBD a 7-day waiver to re-engage with Paramount, and this has now resulted in the higher bid. Well, from Anthropic pushing back against Pentagon's demand for unrestricted access to its Claude AI to Jack Dorsey's block slashing 40% of its workforce for better efficiency, the AI space is seeing rapid high-stakes move as competition intensifies. Rachna now joins us with a wrap of all the key developments.
Well, there's a lot that's happening in the world of artificial intelligence, but the top two stories today tell us exactly where the industry is headed, and none of them are comfortable. First is Jack Dorsey's Block. The payments company behind Cash App and Square is cutting more than 4,000 roles, going from over 10,000 employees to under 6,000 in just one move. The business, however, is not struggling. Gross profit is still growing. Dorsey's explanation was direct. Intelligence tools combined with smaller, flatter teams have fundamentally fundamentally changed how the company can operate, and AI is not replacing a failing business. It is helping run a healthy one, but with fewer people here. Markets have noticed that the stock jumped up to 25% since that announcement. Jack Dorsey has added an important clarification. He says Block did overhire during the pandemic and admits that the company was running duplicate structures between Square and Cash App until mid-2024. All of this, and that he also made a key point that the goal now is much higher efficiency. So Block is now targeting more than $2 million in gross profit per employee, roughly 4 times its pre-COVID level of about $500,000 per person. Dorsey's message is quite clear, and this may be correcting past hiring, but majorly it is structurally running the company leaner in the AI era. eBay told a quieter but a related story when it came to layoffs. But now here's where the contrast that matters. While companies are cutting people, they're spending aggressively on the machines that power AI. Dell now expects roughly $50 billion in AI server revenue this year. Its AI server backlog already stands at about $43 billion. Infrastructure revenue surged more than 70%. The same companies pulling back on headcount are now pouring capital into compute. That is not a contradiction, but pretty much like a strategy. And then there's Anthropic, one of the fastest growing companies in AI right now, is in a very public dispute with the US defense establishment. The company says it will not allow Claude, its model, to be used for fully autonomous weapons or large-scale domestic violence on Americans. The Pentagon maintains that it operates within existing legal frameworks, but discussions over contract, language, all of them remain unresolved. CEO Dario Amodei says that he supports using artificial intelligence to defend democracies, but argues that frontier systems are not yet reliable enough for fully autonomous weapons. He has also raised concerns about AI systems aggregating large amounts of personal data. What makes this moment notable is the tension at the center of it. US officials have stressed the importance of access to advanced AI capabilities. Anthropic, meanwhile, is pushing for tighter written safeguards. Lawmakers have begun weighing in, and the dispute is quickly becoming as much as political as technological. Here's what Dario Amodei told Shireen Bhan in conversation on the sidelines of India AI Summit about regulations and helping Pentagon.
I think the main areas of concern that we have are, fully autonomous weapons where there isn't a human in the loop, and domestic mass surveillance of Americans. So, I think these red lines are fairly important for, making sure that AI is used in a way that's compatible with democracy and in line with the culture of our company.
And staying with AI, ChatGPT maker OpenAI has raised $110 billion at a $730 billion pre-money valuation. SoftBank has invested $30 billion, while Nvidia pumped in another $30. Amazon has also invested $50 billion in the AI major. The company has said that it will be using these funds to deepen infrastructure and strengthening its balance sheet. And with that, it's time now for a short break. But coming up next, Delhi court has acquitted former Delhi Chief Minister Arvind Kejriwal, Manish Sisodia and others in the liquor policy case. More details when we come back. In what comes as a big win for the Aam Aadmi Party's top brass, the Delhi court has discharged former Delhi Chief Minister Arvind Kejriwal and his erstwhile Deputy and Finance Minister Manish Sisodia in the liquor policy case. All 23 accused in the case were acquitted by the court. The court also pulled up the CBI while highlighting that there was no cogent evidence against Kejriwal and no prima facie case was made out against Sisodia or the other accused. The court said that the CBI charge sheet contained many lacunae and was not supported by witness statements. It said that there was no overarching conspiracy or criminal intent in the excise policy. A visibly emotional Kejriwal broke down after the court's verdict.
हमारे ऊपर कीचड़ फेंका गया। 24 घंटे टीवी चैनलों के ऊपर डिबेट चलते थे, खबरें दिखाई जाती थी केजरीवाल भ्रष्ट है, केजरीवाल भ्रष्ट है।
Well, the Supreme Court has rejected SpiceJet's plea against the Delhi High Court order directing the airline to pay 144 crore rupees to Kalanidhi Maran. The top court has also imposed costs of 1 lakh rupees on airline CEO Ajay Singh, observing that the litigation had been pursued endlessly. The airline has said that it will comply with the court's directions. Well, staying with the apex court, the Supreme Court has agreed to hear a plea raising concerns about the new law that reset India's nuclear energy policy. The plea claimed that under the Shanti Act, the cap on liability of private operators and the government is far below the real cost of damage in the case of an accident. The bench led by Chief Justice of India, Justice Surya Kant, said that the matter would be heard at a later stage. Now, three-time former Tamil Nadu Chief Minister and former AIA-DMK leader O. Selvam has joined the DMK just months before the state assembly elections. He said that his decision came after bitter experiences with his former party. Selvam was expelled from the AIA-DMK in 2022 and later unsuccessfully contested the 2024 Lok Sabha elections backed by the BJP-led NDA. Pakistan has declared an open war against Afghanistan after the nation's traded cross-border fire. Islamabad has said that it has bombed Taliban targets in Kabul and several other cities. The government has claimed around 133 fighters were killed. Meanwhile, Taliban says that its airstrikes have hit military targets inside Pakistan. Nuclear talks between US and Iran ended without an agreement on Tehran's nuclear program. Iran's foreign minister has said that both sides agreed to extend negotiations and described the talks as the most intense so far. Omani mediators said that technical level talks are expected to resume next week in Vienna. The United States has authorized the departure of non-emergency government personnel and their family members from its mission in Israel. The US government has cited escalating safety risks amid a volatile security situation in the region. And with that, it's a wrap on this edition of India Business Hour. Thank you so much for watching. News and updates will continue right here on CNBC TV 18.
Hello and welcome. We are in conversation with the Ministry of Statistics Secretary, Dr. Saurabh Garg. He is the man of the moment. The new GDPI series have just been rolled out, and we are given to understand that the current year's estimate stands revised higher at 7.6%. Sir, thank you so much for giving time to CNBC TV 18. Sure. It's always a pleasure. Just wanted to first understand, put the number in perspective. So 7.6 versus I think 7.4 earlier.
Yes, that's right.
And you had earlier also indicated that we are not expecting too big a change. So could you just come again on that?
Yes. So we've done the revision into the base year of 22-23. There has been a slight change in the level of the economy as of 22-23. And the subsequent growth rates have been extremely good, both in 23-24, 24-25 and 25-26. In the first advance estimates for this year, we had indicated a growth rate of 7.4, which is now kept at 7.6, given the Q3 data that we had received.
At 7.8.
So at 7.8, that's right. So a combination of Q1, Q2, Q3 and the expected for Q4. So we are expecting a healthy 7.6% growth rate. And if you look at all the last 3 years, the real growth has been consistently over 7%, which shows that the economy is very resilient, despite the different external shocks that may have happened globally.
Okay, but for 23, 24 and 25, check me if I'm wrong, haven't the real GDP growth rates come down a tad?
No.
Okay.
For 23-24, the real GDP growth rate has come down slightly, but both for 24-25 and 25-26, there has been an increase. 24-25 growth rates real are at 7.1%.
High by almost 0.6%.
0.6%, and 25-26 at 7.6%, high by 0.2. But what I'm saying is even 23-24 at 7.2%, which is slightly lower than the earlier numbers, are still above 7%, which is what is a very, very healthy rate of growth.
Okay, okay. Also for the current year, I suppose the nominal GDP base has been revised downwards by say around, the absolute number is down by around 12 lakh odd crores.
Yes, for 22-23, if you see, the actual drop is about from 269 to 261, about 0.8 lakh crores.
Okay.
So that's the drop in the GDP in 22-23. But subsequent growth rates are good. But yes, if you look at a particular year, there would be slight drop from the earlier numbers.
Right. So 23. So for FY23, it's on slightly on the lower side. 24 and 25, the nominal numbers.
It is slightly lower than what was projected earlier.
Okay.
Because
for
of
each
the
of
base,
these years,
for each
including
of these
26.
Including 26.
Okay.
But given the stronger growth rates, we can expect that there will be a very early catch-up.
Okay, okay. Also, sir, would it mean, I think it was there in your presentation or the CS presentation, I'm not, I don't recollect very clearly, but the fiscal deficit had been set at 4.4% for this year by the Finance Ministry. It's going to be at 4.5 now.
That's right, that's
right.
So there's a very slight change in the fiscal deficit because of the change in the level of the economy. As I mentioned, there's been a slight dip in the 22-23 figures. But as I mentioned earlier also, that our figures have become so much more robust and accurate, and we are able to capture the economy much more efficiently, and that is reflecting in the increased growth rates from what they were earlier. So I'm sure given the expected growth rates that we have, the economy will continue to do well.
Absolutely. In fact, next year's projection based on your revised estimates, the Finance Ministry has already raised it upwards. So
yes,
they're saying now 0.20 basis higher both at the lower end and the upper end.
That's right.
So next year they're looking at higher numbers, both nominal and constant, and at constant prices.
Absolutely.
Sir, having said that, why has the nominal number been on the lower side in the last 3 to 4 odd years? Can you explain the reason?
Yeah.
Is it to do with double deflation and all of that?
Partly that. There are 2 or 3 reasons. Number one is that we have a much better sense of the unincorporated or the informal sector because we are doing now surveys, regular surveys, the annual survey of unincorporated sector and the periodic labor force survey. So that gives us very granular picture of what is happening in the informal or the household sector. Earlier, we used certain indicators to decide what is the growth rate, but now we have actual growth rates. The deflators have acted differentially. Some sectors it has improved. Manufacturing, in fact, it has improved because of the deflators. Some of the other sectors, the growth rate. Some of the other sectors it has changed. In fact, so is the case in the informal sector numbers. In some sectors they have improved, and in some sectors they have changed. For example, if you look at the housing numbers, the housing services numbers have significantly increased because it is capturing the increase in the housing stock in the country so much more effectively. And the other is that now that we have GST data, which is a real-time data and captures data not only of the formal sector but also of the unincorporated or the informal sector, we have much better numbers. And it's a combination of having better data, having better techniques used, that some sectors have gone up, some sectors have gone down. Overall, though, there has been a slight dip.
Okay, but in real numbers, in constant numbers, the rates have been higher, the growth rate has been higher.
Yes, for the last 2 years, they have been higher.
So how do you explain this anomaly? Is it an anomaly at all?
No, it's not an anomaly.
Natural?
It's just a correction of data. It's a technical correction, partly due to the, as I said, methodological changes that we have done, and partly due to the fact that you have better data available.
Okay.
It just means that our numbers were always robust, but now they are even more robust than they were.
Okay, so going forward, this will stand the scrutiny of IMF as well, because there was a lot of controversy a few months back.
I think we've had discussions with the IMF.
Or was that just a storm in a teacup?
I like to think it is just a storm in a teacup, because I think the IMF also recognized that our data systems are robust. It's just that the base year was so old that because it was more than 5 years, they had no, as per their assessment, this is what the rating was. On other issues, there were no substantial issues in that sense. There were some statistical issues like a discrepancy and double deflation. Even those we have taken care of.
Right. So also you mentioned that, the discrepancy in terms of the difference between the production side and the expenditure side.
Yeah.
So very briefly, can you explain how have you plugged it?
Yeah. So the plugging has been essentially due to the granular data available. The two sides of the equation, it's like on the production side is what has been supplied to the economy, and the consumption side says how much has been used in the economy. Normally the supply has to be equal to use given the changes in inventory, etc. So now we are bringing out the supply and use tables, which will effectively show where the supply is, where the inventories are, and where the use has been. So this will get totally eliminated. It's a statistical and a technical way of doing it, but sometimes it leads to misgivings that why should there be a difference between what has been produced and what has been used. So that statistically those corrections have been taken care of, and we can do that now because of the granular data that's available.
Okay. Also, in terms of the usage of, say, for example, okay, fine. So basically, in terms of the the back series, the FAQ also mentioned very clearly that it's going to be out in the month of December.
Yeah.
So is that the kind of rough timeline that we are looking at?
Yeah. So we already have back series for 4 years, from 22-23 onwards to 25-26 for a comparative basis. You have both the old series and the new series. Going back to 11-12 and then further back requires a lot of work. So in the next 10 to 12 months, we are expecting. December 26 is our target. It might be a month or two earlier, it might be a month or two later, but we are hopeful that by the end of this year to have the back series, which is more required for researchers and academics who are doing some research on various topics. But in terms for the general public, it is more a matter of academic interest. And the last 4 years is sufficient to get a sense of what is happening.
Okay. And so these numbers more or less are on expected lines. I mean, I'm sorry, I keep asking that question. Also, how do you expect this to be, like Finance Ministry, of course, is a huge votary, and the CA already explained his view, as well as he has given projection for next year, which is on the higher side. How do you expect the RBI and the other agencies, like say the World Bank, the ADB and all of that, how do you expect the comments and the feedback to come in?
So we are regularly in touch with all the international institutions and of course the RBI. The RBI uses the inflation numbers very closely, GDP numbers of course. I think all these organizations realize that having more robust and more accurate data helps in their decision-making process. And that is in fact our objective of doing this base revision, that we have more accurate and robust data for decision-making. And data-driven decision-making is what the Honorable Prime Minister has also been saying, that the bureaucracy must move towards more data-driven decision-making, so that whatever policies, whatever programs that are set up, so much are closer to the felt experiences and the felt needs of the people. So this granularity of data that we are able to now produce gives that level of comfort to a decision maker to ensure that whatever programs and schemes that are built are actually reflecting the needs and aspirations of the people, and which is what the Statistics Ministry has the main objective, to ensure that we are working towards a Viksit Bharat, and that the decisions, the schemes that are made are based on clear data, which helps in this process.
So this was a remit that you had personally, and also
that's a remit of the Ministry of Statistics,
Yeah.
Data for Development.
Yeah.
We need to produce good data which will help development, and definitely that's a remit.
Ladies and gentlemen, the India-EU trade deal happened earlier this year, and it was really the mother of all deals. And it was followed up by what many call the India-US trade deal, or the father of all deals, as many are talking about. But clearly, the India-EU trade deal was extremely comprehensive, and it brings together 1/4 of the global economy. I won't waste any more time. I want to open this up to our panelists. All three of them have been working very closely on the India-EU deal and the India-EFTA deal as well. So let me begin with Ambassador Ackerman, the German ambassador to India. How would you rate the importance of this deal at a time when the relations between US and Europe are deteriorating? You've paused the ratification of the deal with the United States because of the Supreme Court ruling. Does the relationship with India now become doubly important?
So thank you very much, and it's great to be here. But I'd like to say the difference between all the trade deals with the US and the trade deals with Europe is that the deals with the US are no free trade deals. No? I mean, this is a deal with tariffs. With Europe, you have a free trade deal, and that's, I think, a commitment and a conviction that you are promoters and believers in free trade. And I think you cannot underestimate the importance of this deal between EU and India. It brings together an enormous market. 450 million Europeans and 1.4 billion Indians form one single market. And this is, a clear signal to the world, a message to the world that we are the promoters of and the believers in free trade. And therefore, I think the mother of all deals is a bit of, has a little pathos in the word, but it's not wrong. Whereas, whether the deal with the US is the father of all deals, I would be not so sure.
No, you're absolutely right, because it covers almost 97% or 98% of goods traded between both nations. It has a mobility partnership as well. Ambassador Heslev, how do you see this deal contributing to the growth of our economies? How is Sweden looking to leverage the fruits of the India-EU trade deal?
Thank you very much. I think you said it yourself. It covers almost 97% of all trade. But we should not only see it as a trade agreement, even though we call it the FTA, because it's a signal when it comes to investments. It's a signal when it comes to engaging with one another. It's a signal to develop together, not only make in India, but make with India, make with Europe. So that's let's say the broader signal, and that's actually the growth signal if we look ahead. And for those who are not yet in Europe or not yet in India, maybe the barriers were too high. Maybe the entrance ticket was too expensive in the past. With the free trade agreement, with what it brings, you lower those barriers, and I think that's where we will see the big growth and the big change. SMEs, middle-sized companies, those are the ones that create the jobs. Those are the ones that create the growth. And we will see it in India, we will for sure see it in Sweden.
Right. Ladies and gentlemen, while the India-EU free trade agreement will get ratified formally and will be off the block by sometime next year, because it will go through a period of legal scrubbing, then the text has to be converted in all EU languages, it has to be approved by the EU Parliament, so it is still a long process off. But the EFTA has already happened, it's operational. Ambassador Steiner, could you give us a sense of how this is benefiting Norway and India right now? And what is the kind of uptick in trade between India and EFTA regions that you see?
Well, that's right. The Trade and Economic Partnership Agreement between the EFTA countries and India entered into force 1st October last year. So it's already in force. The EFTA group, for those who don't know, there are 4 countries. It's Norway, Switzerland, Iceland and Liechtenstein. 4 small countries that are not part of the EU, but all rich countries, and altogether quite big economies. And for Norway, this trade and economic partnership agreement is a milestone in the relationship to India, for sure. It is very important, and as it's being said here, the trade agreement with the EU is not only a trade agreement. The agreement with EFTA is for sure not. It's called Trade and Economic Partnership Agreement. It also has a commitment from the EFTA countries to promote investments. So this is very important to us. Let me also say, though, I'm sitting here with my German and Swedish colleague. Sweden is our neighboring country, and Germany is the biggest market that Norway is exporting to. 66% of the Norwegian export is going to the EU. And therefore, I also think that the EU FTA with India is important for Norway, because a lot of the things that we are selling to other countries outside Europe, they're being designed in Norway and then produced in maybe another European country, maybe in Sweden, maybe in Germany. And therefore also this it will be a bigger ecosystem that will work very well together, and I also think will benefit the Indian economy.
All right, thank you for those opening remarks, Ambassador. Ambassador Ackerman, if I were to ask you, how does this bring the two economies together in the field of manufacturing? The reason why I ask that is because be it Europe, be it India, both have to now stand up for their own security, defense, economic security as well. In such times, how do we foster a closer economic and manufacturing partnership specifically?
So I think these are two elements to your question. One is the question of, will India grow in its manufacturing capacities for, delivering to Europe, for example? And I'm, as Jan said, convinced that this FTA will be a booster for investment, for FTA in India. I'll tell you one example. The Indo-German Chamber of Commerce had an online seminar on what the FTA would mean for companies in Germany. And we had 1,800 companies signing in for this webinar as we speak, and that's an enormous amount of companies being interested in coming into it. So I think manufacturing, you will see that once this thing is ratified next year, by the end of this year maybe even, we'll have a growth of FDI in India. Now, your second part is defense and security, and as you are aware, the EU has also agreed upon with India on a security roadmap and a security partnership. And I think in our countries, respective countries, we are all very interested in setting up a meaningful defense partnership with India that includes production, that includes manufacturing for German, Swedish, European defense interests. We still hope that this country to my right will join the European Union one day, so I cannot speak for Norway here, but one day hopefully I can. But with Sweden and Germany and France and Italy, I think India as a security hub for production is growingly interesting for us.
Right. If I may ask a follow-up question, Ambassador, and that would be about our defense relationship. We've had a close defense relationship in the past, but we see that the submarine deal between ThyssenKrupp and MDL it's in final stages. If that were to happen, how will this probably solidify or strengthen our defense partnership for the future?
So I think the submarine deal is, I'm very confident that in the coming weeks we'll see some movement on that side. This will be a game changer for our bilateral security cooperation, and you'll see here again that parts of this production, of course, will take place in India, the biggest part, the larger part. And that means that, ThyssenKrupp will set up shop here in India. MDL, its venture partner in Mumbai, will produce. And I think that's a wonderful example how, India and European countries can join hands and come up with a product that is to the use of all of us.
Right. Ambassador Teslev, to ask you about where we are right now with the India-EU FTA. Has the legal scrubbing begun? By when do you expect the first draft to be circulated among EU nations?
I know that the legal scrub has started.